Good morning. It is 9 a.m. on Thursday, January 20th. I'm Julie Hyman. This is Yahoo Finance Live. That is my partner, Brian Sozzi, as well. Let's take a look at what's going on in futures here this morning. We are seeing a bit of a bounce for the major averages here. All three are indicating a higher open at the moment, with the Nasdaq showing particular strength. Those futures are up by 1% this morning. Of course, this is coming on the heels of weakness, this tech comeback, the rebound in futures this morning after the Nasdaq yesterday entered a correction, down 10% from its highs reached back in November. The tech-heavy index is on track also for its worst January since 2008. Biden's first year, the president highlights the inflation fight as he faces a number of others, from voting rights to Build Back Better. We assess his position. And not quite cleared for takeoff, United and American Airlines sound a cautious tone on travel. We will have details. First, though, we did want to take a little bit of a look at what has been happening in stocks here. The setup this morning, Brian Sozzi, is not great in terms of what we have seen from technology in particular. As I mentioned, the Nasdaq Composite down 10% from the record high it reached back in November 19th to be exact. And the S&P 500 and not down as much in that period. The Nasdaq 100 even is not quite in correction. It's down about 9% in that period of time. But we are seeing the S&P 500 trading below its 100-day moving average. The Nasdaq, I believe, is below its 200-day moving average here. And I was looking, Saz, at some of the worst performers in the Nasdaq 100 since that high. And it's an interesting sort of mixed bag, right? Because you have stocks like Moderna on this list, by the way. It's number 3, the third worst performer after doing really well. And I think that's a little bit of a theme here, is it's stocks that had big up runs. DocuSign, for example, but then DocuSign, of course, came out with some disappointing numbers, sending those shares sharply down, which is also a bit of a theme from these companies that had been, the wind was at their backs. And then the wind died, and these guys started to go down.
Yeah, Julie, right now, really, this market, to me, reminds me of someone reminding you to cover your nose when you walk into the bathroom. The action just stinks. And you're looking at a lot of tech stocks here, like you mentioned in those charts. You've seen, I think, a lot of names that have completely detached from fundamentals here. And, Jim Reed over at Deutsche Bank reminding, I think, a lot of investors out there via his note this morning that earnings are going to kick off. You have Netflix after the close today, and it's now up to big tech to remind investors why you were investing or long these names last year. Netflix is probably going to come up today, probably show us still a pretty good quarter. Next 2 weeks, we're going to see probably some pretty good earnings out of Amazon and Apple here. So now it's tech's turn to regain that bullish sentiment that drove these stocks last year.
Yeah, we'll see if that actually ends up being sustained in any way. If you take a look at the Wi-Fi Interactive, the Yahoo Finance Interactive, we're taking a look at how the Nasdaq 100 has done in the past 41 sessions. That is since that high. And you see their DocuSign on the bottom, as I mentioned. Activision, the best performer in that period of time. No surprise, as it is agreeing to be bought, of course. So that's the equal weight look. If you look at the market weight look here, interestingly, Apple is the only of the really large stocks that is in the green in this period of time. So that's sort of an interesting phenomenon here as we consider which stocks have resisted this big downdraft that we have seen. So that's something we're going to keep an eye on. Netflix hasn't resisted it. You can see there's the intraday look at the stock. But if you look at over that 41-day period since that high, it's down by 24%. So definitely not a lot of high hopes. I guess that's a silver lining, perhaps, as to your point, Saz, as we go into this earnings season more broadly for technology. It's not like you can. If you look a few months ago, you could call many of these stocks overpriced, and some analysts and investors still would call them overpriced. But they're less overpriced than they were, if that's your view, than they were a couple of months ago.
Well, Julie, you're right. A lot of these stocks were very inflated, and I think what you're seeing is here just the market continue to be dominated by algorithms. And when these algos see the 10-year yield climbing essentially every day, or adding 50 basis points in about the past month and a half or so, climbing to 2%, they're going to make adjustments in real time. You see analysts making adjustments to their spreadsheets, coming or thinking there will be a land of lower expected returns for these high-tech stocks moving forward. But at some point, common sense has to kick in. And I was looking at Roku, and I tweeted out a stock chart from Yahoo Finance Plus this morning, looking at the move in Roku. It is down 52% in the past 3 months. And I understand, we are getting a little more mobile out here. Maybe we're not using Roku as much as we did a year ago at the height of the pandemic. But still, you mean to tell me Roku is worth 52% less than it was about 4 months ago? I would argue no. I mean, here's another company that's likely to report in a couple weeks, and their quarter's going to probably be pretty good.
One final thing I want to mention from the Wi-Fi Interactive here, and that's bond yields, because that is so inextricably linked with the action that we have seen, not so much down from the high, but more the most recent move that we have seen thus far in 2022. The 10-year yield staying pat here at 1.83%. And I should mention, by the way, we got jobless claims numbers this morning that came in higher and therefore worse than estimated, but not seeing a big reaction there. But of course, if you look at the year-to-date move in that 10-year yield, you can see a big upward move here of, let's call it 20 to 25 basis points, depending on where you're looking at it from and to the high. And that we have seen an increasing correlation between, or I should say an inverse correlation between up yields, down tech stocks. That's something we're going to talk to Mike Wilson about of Morgan Stanley. He's going to join us in the next hour, but that has been a big theme as well. A big theme more recently, as we mark this 1 year of the Joe Biden presidency, has been some of the challenges that he has been facing. And of course, one of them is reflected in those higher yields, and that is higher inflation. He spoke late yesterday and addressed that issue.
The Federal Reserve provided extraordinary support during the crisis for the previous year and a half. Given the strength of our economy and the pace of recent price increases, it's appropriate, as the Federal Chairman Powell, the Fed Chairman Powell, has indicated, to recalibrate the support that is now necessary.
Of course, him sort of getting on board with the Fed in its inflation fight is just one of a number of challenges that the president has been facing. Ed Mills is with us now. He's Raymond James Washington policy analyst. Of course, another very recent challenge and defeat that the president has suffered has to do with the Voting Rights Act. And in fact, his party as a whole has suffered that defeat. What's your assessment here a year on, Ed, as we look at the Biden presidency? It seems like a lot of the rhetoric around his performance thus far has not been terribly positive.
Yeah, so Biden came out last night and wanted to act as the winning coach of a Super Bowl team. The recent performance was that more of the Jacksonville Jaguars, who are going to have the #1 pick in the draft next year. But, it has been a lot of accomplishments in year one, but that comes with higher expectations because of the Democratic sweep that Democrats had in last year's election. As well as kind of expectations of Build Back Better already being signed into law, and Build Back Better being bigger than what is being discussed today. So with politics, as a lot in life, it's a compared to what conversation, and compared to the expectations, what's been accomplished, what looks like can be accomplished between now and the midterm elections are a lot less than what the progressives had hoped for.
And the president seemed to dump these inflationary issues right onto the plate of Jerome Powell. But could the administration do anything to help bring down these levels of inflation the country is seeing?
Yeah, Brian, it's a great question. And I think it was really interesting to see that the president did put this squarely in Powell's plate. We learned in season 1 of West Wing that there is no secret plan to fight inflation at the White House because a lot of this is in monetary policy. So that's a lot of political cover for the Fed to increase rates, to use the balance sheet more aggressively to make sure that we have some steepness in the yield curve. I do think that is going to benefit financials for this year, something we've worked with our financials team here at Raymond James. But the other part of the conversation that's being brought up, Brian, is that it's not only the White House's fault or Congress's fault or the Fed's fault. Democrats in DC really want to shift this to a conversation about competitiveness and about antitrust. So my expectation over the coming months is more aggressive stance from the FTC, from DOJ, from Congress I'm not sure how successful they will be, but from a sentiment perspective, if we have rising rates, we have tech under pressure, is this going to be something that adds to some multiple compression? I think that's going to be the debate I'm having with clients.
That's really interesting. And does that also then feed into the discussions around, for example, an approval of Microsoft's acquisition of Activision?
Julie, I think it does. And I think just the fact that size does matter, and just the colossal dollar amount of this deal, having Microsoft being the poster child of antitrust issues for an entire decade, they've largely avoided the larger conversation. The next step here really is getting the Federal Trade Commission up to full force. It's a 2-2 tie right now. So the Democratic lead is not able to do anything because she's not going to be able to break that tie with her 2 Republican commissioners. Democrats are prioritizing the confirmation of the 3rd Democratic commissioner. Once that occurs, expect a lot more headlines and more scrutiny, and at the bare minimum, delays on transactions being approved coming out of DC.
That is really helpful context for investors, Ed. I also want to ask you about Build Back Better, because we have talked to some investors who have called for, sort of structural change in the U.S. economy, more support for things like childcare, for example, that can enable people to get back to work. But what are the prospects for that or those portions of Build Back Better as we head into 22 here?
Yeah, Julie, I think what we're looking at right now is Build Back Smaller and Build Back Later. What is included in the package, at least in conversations right now, the core of it is probably the climate change provisions, some of the energy tax provisions on renewables, solar, nuclear, hydrogen, that has the support of all Democrats, including Senator Manchin. The social spending aspects of it are much more debated. The child tax credit's really expensive, so that has to be changed or significantly eliminated from the bill. Universal pre-K for 3- and 4-year-olds seems to be at the high on that list. More subsidies for childcare seems to be more kind of on the bubble right now. So it really comes down to the total cost over 10 years. Democrats are saying what they passed in the House costs about $1.8 trillion. It's probably closer to $4 trillion if you were to spend everything over 10 years. That has to be chopped up quite considerably to meet Manchin's number.
And finally, Ed, as we can, again, come back to this assessment of the presidency, what's the one thing that you think Joe Biden needs to do to sort of get momentum back behind him and maybe change around the perception of how he's done?
I think when I talk to Democrats in town here in DC, a lot of it they do believe comes down to messaging and about setting expectations. The polling data that we've been watching quite closely is the opposition from the other party. And so the approval rating for Joe Biden among Republicans is about 5%. Those are Trump level numbers. And so to send the message to Democrats that Joe Biden is disliked by Republicans in a similar way that Donald Trump was disliked by Democrats from an electoral perspective, that is a flashing warning sign going into the election. So improving those numbers and really generating kind of excitement among the Democratic base is going to be the way in which Democrats, if they are to limit losses in the midterms, they'd have to improve both of those scenarios.
Really interesting stuff. Ed Mills, always great to talk to you. Raymond James, Washington policy analyst, Ed Mills. Appreciate it. And we got a quick programming note for you. We're going to be talking much more about all of these issues. We've got a full hour of expert analysis as we weigh the administration's successes, failures, expectations for the future following Joe Biden's first year in the White House. That's today at 4:30 p.m. Eastern. And as we go to break, let's take a look at futures here. We're going to talk about what strategy you should be employing following that sell-off. Is it time to take a nibble of tech, for example? We'll talk about it next.
The Nasdaq in correction territory. Is it time to go bottom fishing? Victoria Fernandez is the chief market strategist at Crossmark Global Investments. Victoria, always nice to get some time with you here. You have liked tech coming into this year, but these prices have come down. I would argue not because of fundamentals, really because of just changing market dynamics. What's the move here?
Yeah, so Brian, you're right. We did like tech, and we were actually overweight the growth component for the majority of the last 12, 18 months. But we started trimming those names about the third quarter of last year. We started trimming and going into more of some of the cyclical and value names. And when we look at our expectations, the last week of the year, last year, we came out with our predictions, and financials and energy are the two sectors where we really wanted to focus. Now, we didn't know we would see such a move in the first, week or two of the year in those sectors, but we think that longer term, looking throughout 2022, those are probably going to be areas that will do better than tech as we see yields continue to grow higher. That doesn't mean that you don't want to have some exposure there, so you do want it in your portfolio, but just don't overweight it as we had been doing previously.
Maybe this is a simple question, Victoria, but if one is owning Apple right now, it's one of the most owned stocks in the entire market. What should you do? Should you buy more, or just given the selling we are seeing in the marketplace, do you lighten the load on a name like that?
So we actually had gone a little below weight on Apple because we had been trimming the name and it had pulled back a little bit. So we bought some on the last pullback to get us back to neutral on Apple weight. So many times Apple is really seen as more of a defensive stock. We noticed that over the last maybe 6 weeks when a lot of the other tech names were down, Apple continued to do well. So if you don't have it in your portfolio, again, we're longer term investors, wait for that pullback and add some of that to your holdings for more of a base holding in your portfolio.
Hey, Victoria, it's Julie here. So on the flip side, away from tech for a sec, I know that you guys have been looking at financials, some of the large banks, and it's been sort of an interesting and unexpected beginning to 2022 in that we have heard from so many investors who like the financials, and yet the financials as a group have kind of fallen flat here year to date, which has been a little surprising given those rising yields. What do you make of that? And do you think we're going to see them kind of bounce and recover here?
So, Julie, you're right. I mean, they have come back a little bit over the last week. Look at that first week to 10 days of the month, and we had a huge run up in financials as yields made that big move from around, a 151 or so at the end of the year up to the mid 180s where we are now. But it's not just yields that we think gives financials a little bit of a boost throughout this year. You look at their balance sheets, they are in a better position than they have been in a long time. We think we're going to see increased dividends into 2022. And even with the JP Morgan and the Bank of America earnings that came out, JP Morgan talked about the increased cost that they were seeing. And we understand that, but we're also seeing good loan growth. Bank of America talked about their loan growth. That's an area where they've been lagging over the last year. So when we look at all of the factors put together out over the next couple of quarters, we still think financials are going to do well. And the two names I mentioned, we own them both, and those are our favorite names in the financial sector right now.
Victoria, more than a few folks have told us they are looking for a pretty big correction in the markets in the first half of this year. And I can't say earnings season has done anything just to, poke holes in that thesis. Are you in that camp?
Yeah, so one of our predictions for this year was that we would expect to see about a 10% pullback. And as of yesterday, we saw that in the Nasdaq already with the tech names. But we do think there's going to be a lot of volatility this year. I mean, just look at the things that we're facing in regards to the Fed, in regards to rising rates. There's concerns over earnings and growth. So I think there's a lot of issues, geopolitical issues that are going on. There's going to be a lot of volatility. We've seen the VIX move quite a bit higher over the last couple of weeks as well. So with that, I think, though, you become opportunistic. Use those pullbacks to get names that are on your shopping list, names that have pulled back. You don't have to do complete sectors. You can find certain names in areas that you like, but use those pullbacks because we do think we're going to see some significant moves this year.
The only thing on my shopping list, Victoria, is a new set of golf clubs this spring. This market is very, very challenging. Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Always nice to see you. All right, coming up, United Airlines lost a boatload of money in the most recent quarter as the pandemic continued to weigh on travel. Yahoo Finance's Adam Shapiro is back next with an inside look into United's results and outlook.
Well, airlines are sort of pushing off their expectations for a full recovery here. That was one of the messages and takeaways from earnings reports from United and American. Our Adam Shapiro covers these companies. He's here now. So United in particular, Adam, sort of saying not so fast here. It sounds like Omicron is really giving them a setback.
Yeah, and we're going to hear from Scott Kirby and the team at United at 10:30 Eastern. But let me give you the quote that Kirby put out in the statement when they released earnings after the bell yesterday. Quote, Omicron is impacting near-term demand. We remain optimistic about the spring and excited about the summer and beyond. But for instance, when you compare United to what we heard from Delta last week, Delta said, look, January and February, we will not be profitable. We will be profitable in March. United not quite making that kind of promise. What they're telling us about the quarter is that revenue came in at $8.19 billion. That beat what everyone expected. But Omicron and the delays and cancellations in December from the booking public impacted the airline. Also, they're anticipating that their costs in the first quarter of this year will be up 15%, and that's excluding fuel. So United is facing some headwinds, the biggest of which, when you think about this, Julie, is that 50% of United's revenue before 2019 was tied to international travel, a lot of that Asia. And this Omicron wave and the slow recovery of the globe from the pandemic is impacting United. Then take a look at American Airlines. I want to tell you what Doug Parker is saying about American. Quote, over the past year, we have experienced periods of high travel demand countered by periods of decreased demand due to new COVID-19 variants. This is the key. The volatility has created the most challenging planning environment in the history of commercial aviation. Now, you should know for American, which of the big three, Delta, United, American, a lot of analysts will tell you American has the biggest debt problem. So take a look at what happened for them. They had the highest amount of revenue that they have had since the beginning of the pandemic. It was down compared, obviously, to 2019, $9.43 billion. In 2019, it was $11.3 billion. But they also have at this point, they ended the fourth quarter with $15.8 billion of total available liquidity. That's the highest year-end liquidity balance in the company's history. So that's a message to those who are worried about their debt. And the other situation that Doug Parker's pointing to at American is that they hired 16,000 people in 2021. They intend to hire 18,000 this year. Remember, the airlines did not lay people off, but thousands upon thousands of airline employees took early retirement and buyout packages, and that left the airlines short-staffed for the recovery, which the leisure travel recovery is here. When you speak to Savi Scythe over at Raymond James or Helene Becker over at Cowen, they tell you, look, Americans, despite the pandemic, that kind of travel, visiting friends and relatives, is back and better than it was in 2019. This slow recovery is really one international and business travel. Back to you.
Adam, we have you on the industrial beat today. I know you're also covering earnings out of Railroad Union Pacific, not United, yeah. Union Pacific.
Yeah, Union Pacific is going to be pretty interesting. They had, I'm looking for the specific quote here. The Union Pacific team concluded its most profitable year ever in 2021. We produced double-digit fourth quarter revenue growth by leveraging our great rail franchise to generate positive business mix and core pricing gains. Look, Lance Fritz is going to be on with us in the 11 a.m. hour. A couple of things, though, that we're going to talk to him about because they are such a bellwether for the U.S. economy. In the quarter, the volume, total revenue for carloads, business volumes, was down 4%. Also, the velocity of the trains was down 12%. These are issues that impact Union Pacific's ability to deliver. On the other hand, the average maximum length of their trains was up 2%. So we're going to ask them to put it in perspective for us and where we are headed. They also have a big deal that they closed that they're talking about with Schneider on intermodal transportation. And then, of course, there was Danny's article yesterday, Danny Romero here at Yahoo Finance, about, there are people who are breaking into trains. This is hitting all of the freight train companies, stealing stuff. So we're going to talk to Lance Fritz about everything, not only for the railroad, but the steps they're taking to protect the cargoes that they're shipping.
Yeah, those pictures of goods strewn around the tracks are getting a lot of attention. Looking forward to that interview again, and that's at 11:20 today. Lance Fritz of Union Pacific going to be joining Adam and the team, so don't want to miss that interview a little bit later on. All right, we're setting up for the opening bell in just a moment here this morning. There you have it, as we are looking at a bounce in the major averages, particularly the Nasdaq, after it entered correction. So the Nasdaq now down a little more than 10% since its high it reached back on November 19th. You can see the drop that we had yesterday in the Nasdaq. So wait in just a sec for it to open up. The Dow and the S&P 500. The S&P fell below its 100-day moving average. So effectively, what that means is that momentum has been to the downside. We've seen a tick up in the VIX, the volatility index. So those various trends are reversing themselves, at least for today. We'll see if that lasts. Jared Blickery taking a look at all the charts on the Wi-Fi Interactive for us here this morning in the wake of that correction entrance yesterday.
Yes, and I got some notes on that. Pretty interesting to see that play out. I just want to go to some heat maps here because we have another bounce. You'll remember 24 hours ago, looked like we had a fledgling rally, and then we just kind of sold off into the close, and it was a rather ugly close. A lot of green here. Tesla's up over 1%. So is Microsoft. So is Facebook. But really, the Chinese stocks are what is front and center here. And I just want to show our heat map. We got Alibaba up 6%, JD.com up 8%. And so this group of stocks has been trading kind of lockstep together and has been very volatile, up 8%, down 8% the next day. So interesting to see that. Yesterday, we had a huge breakout in gold, and a lot of the gold miners were surging along with silver miners. The big ones, we have Barrick Gold and Newmont Mining. Those are in the red today, but a lot of the other ones look posting some nice gains here. And then finally, not finally, but I do want to get to ARC because these components have been under a tremendous amount of pressure. And Julie, you were showing what's happened since that November 19th high. That's 41 days. And I just want to show what's happened since then in these components. You can see Square down 2%. I guess I should probably call that block. But it's been pretty nasty for Square lately. You can see on a one-year chart, they're down 42%. Energy front and center once again. Now, it is the worst performing sector of the day. It looks like that's down about 0.7%, but we've seen crude oil, at the highest level since October 2014. So 7-year highs there. And I do want to point out Baker Hughes Company just reported earnings. It was a miss on EPS, but strong revenue. And this is a stock that's gone largely sideways over the last year. You can see over the last 2 years, and this kind of captures pre-pandemic till now, up 15%. In fact, a lot of these stocks are only now just recovering those highs. Take a look at Halliburton here. You can see that's up 18%. Schlumberger, pretty similar deal. So let's check out the sector action. We got tech up the most. That's up 1%. Followed by communication services and consumer discretionary. So those are the three sectors that house all those big mega cap names. To the downside, we have energy and staples. Now, I want to get to the S&P 500 and the Nasdaq. Nasdaq entered correction territory yesterday, and I did a little calculation here. I tweeted this yesterday, and the Nasdaq entered correction today after recently setting an all-time high. It's been a buy the last 13 out of 14 times since 1997, with a median gain of 2.09% the following day and 2.97% the next 5 days. And here's this table, goes all the way back to 1971. You can see a lot of red concentrated in the upper half. That goes till 1996. From 1997, pretty smooth sailing. Also want to take a note that 2001 to 2015 didn't have any new highs, so that period is absent. But nevertheless, we'll have to see if this little bounce plays out, guys.
And Jared, you threw up a chart on Block/Square, and that stock continues to hover around lows. But it's, again, one of those, it's just indicative, I think, of what we're seeing in the broader crypto space. Some of these pure play crypto names, they have really been hammered during this NASDAQ correction.
Yeah, it's not only crypto, it's also payment companies. So that's what we're seeing in Block. And we can go to the Wi-Fi Interactive. In fact, I have a whole heat map on the payment system. Let's take a look at what's happened over the last 2 months here. And you can see a lot of these names down quite a bit. Affirm down about 50% over that period. And then also you take a look at the NASDAQ over that same period, going to see a lot of red in terms of some of those names as well. Guys?
Yeah, definitely. Anything tech, anything crypto related as well has been down. Thanks so much, Jared. And want to take a look at some other individual movers that we're watching. One of them is Ford. Now, Ford, of course, had a big rally And then it's been kind of giving that up. And that's part of the reason that we are seeing a downgrade this morning coming from Jefferies, basically saying they like the company. They said the title of the note is Restored and Re-rated Downgrade to Hold. Basically, because the company has been doing so well, perhaps some of this upside is now priced in. The analyst saying it took so long and happened so fast. I believe the analyst over there, Philippe Auchois, saying Ford and its shares are in good shape and in good hands. But after that big rally, it looks like from the chart, he's not the only one recommending a little bit of backing off here, Saz.
No, and this is the second, I would say, cautious note on Wall Street on Ford in as many weeks. Keep in mind, last week we were talking about some cautious commentary out of Morgan Stanley's Adam Jonas on Ford, concerned about some of the potential pricing pressure in the marketplace this year as the auto market starts to make more cars, gets more cars onto dealer lots. But I understand this analyst perspective here, Julie. Ford shares have been on a tremendous run over the past year, consistently one of the hottest ticker pages on the Yahoo Finance platform. And now there are some valuation concerns. I mean, Ford, General Motors, all the companies are still battling through chip supply concerns, and that might, how that played out in the most recent quarter may disappoint some investors when these companies report in a few weeks.
Yeah, we'll have to see if it can meet sort of these elevated expectations. On a car-related note, I want to check on shares of Luminar this morning because they have a new deal with Mercedes. Luminar, again, to remind folks, is the LiDAR company. In other words, uses lasers to help develop autonomous driving, to help navigate autonomous driving. And so according to reports here, Mercedes is going to partner with the company to try to have automated driving in its next generation of vehicles. So Luminar's signed a handful of deals here. I don't know if this is sort of the biggest name yet that they've signed on. I haven't kept that close track. What do you think, Saz? I mean, obviously the market's seeing this as a big deal for the company.
I would agree with the press release here, Julie. I know you have to stay skeptical. That's part of this gig, but this is a big commercial win for Luminar. Just to attach your name to the storied Mercedes brand, I think really further validates what Luminar is doing. And we've talked to founder and CEO Austin Russell since they came public, since day one. And every time he comes on, he's talking about more contracts, more legitimate contracts his company is winning here. And I'm starting to really be surprised by the stock reaction. I mean, the stock is up 10% here in the early going, but right now the stock's down about 18% over the past 6 months, despite these wins. At some point, you have to think Luminar shares get re-rated higher.
I mean, there's already some re-rating happening as we speak. And then also I want to talk about one more mover. That is Signet Jewelers here this morning. Those shares are up by nearly 4%. The company came out and basically gave an updated higher forecast, reported on the holiday season as well. Said holiday season sales had revenue growth of over 30%, comp sales of over 25%. So that stock has struggled a bit. So that the bounce that we're seeing this morning on those headlines coming on the back of some sort of lackluster performance.
Blowout quarter, Julie, from this company. Lots of things I liked in this report. I like that the gains were broad-based. North America sales for the holiday up 30.2%. International sales up 30.5%. And they also, which is not getting a lot of attention here, except on Yahoo Finance, the company raised its stock buyback program by $500 million. So a big show of confidence that they may be able to continue these results. And they did mention January sales to date are tracking up a high single-digit percentage. That's pretty good.
Yeah, and then also I think underlines the idea that while we saw those overall government numbers on retail sales that fell last month and were not as good as expected or were worse than expected, you do have quite a few standouts within retail that still managed to show some significant strength.
High end, Julie.
Yes.
High end. You have Signet. We just talked to Rolls-Royce's CEO last week. Rolls-Royces are rolling off the lot. Sales are strong. If you're selling stuff on the high end, you're doing pretty well.
Yeah, looks that way. All right, we are going to take a quick break. Does this new year mean it's time for new investments? Goldman Sachs has 8 top ideas going into 2022. clear by now that it could be a rocky year. It certainly has been a rocky January in U.S. equities thus far. So let's talk about some ideas that might help you navigate 2022. Candace Say is Managing Director and Global Head of Strategic Advisory Solutions at Goldman Sachs Asset Management. And you guys put out a report looking at sort of 8 investment ideas or themes for the year and how to play them. And I want to start with your first one because I think this is probably the most overarching of them, right? The president alluded to it last night. I'm talking about inflation, or what you guys term as inflation uncertainty, because there are so many moving parts here. So first of all, kind of how do you base case something like inflation uncertainty in this environment? And then secondly, we can talk about how to play it.
Absolutely. Hi, Julie. Thanks so much for having me. In terms of inflation, I think the inflation spike that we've seen has surely surprised many people. Moving forward, we do think those numbers do come down. So by year end, our expectation is for core PCE actually to come down to about an average 2.5%. So in thinking about where we are with inflation now, which is much higher than we've seen for a long, long time, a lot of investors have angst in the markets. So the way to invest during this time of inflation uncertainty, we would say is a couple of fold. First and foremost, equities actually is one of the best performing asset classes over the long term in terms of fighting inflation. And we've seen the ability for various sectors across equities to be able to do that as inflation rises, as interest rates rise, everything from different sectors, from financials, energy, basic materials. Those are some areas that can greatly outperform in these times of uncertainty. And then on top of that, if you're looking at areas of fixed income investing, you can take a look at multi-sector strategies. In particular, areas like bank loans could be very interesting at this point. And then, of course, folks are thinking about things like tips. While they may not provide the diversification factor, as other investments may do, they can track inflation quite better than others.
And Candace, I would argue so many investors have been lulled into thinking just put their money in passive investment strategies and that will work out well. But you are saying in this report, it's time to be more active with how you manage your money. Why is that?
Absolutely. So if you think about the last 18 years, it has been a beta rally across asset classes. Moving forward, it will be much more differentiated across the board. So alpha becomes much more important in terms of your returns than just getting access to the market. So finding the right managers, being highly selective will be the key, whether you're assessing and accessing equity markets, fixed income markets, alternative markets. It will be the differentiator, especially this year in 2022.
And, when people are looking to that, you hear folks saying this a lot going into this year. How do you find those people? I mean, how do you find the people? Are you looking for consistent track record? Are you looking for, what's your sort of criteria, if you will?
Absolutely. Lots of managers out there. Track record is one. Also, experience, expertise, teams. I think as you look not just at investing here in the US, but going global, making sure that the managers that you're looking at actually have feet on the ground, know the culture, know the language. I think that's very important. Making sure that you have managers that are going out and speaking with company management and doing the due diligence and the research, not only on the company, but these days, given the important focus on things like sustainability and ESG metrics, just making sure that not only are the company numbers aligned with what you're looking for, but also what companies are doing from an environmental, social, and also governance front.
And Candace, let's just stay on ESG. If one is looking to build out a portfolio of ESG-minded investments, what do they need to be looking for and what sectors should they gravitate to?
Absolutely. There's no shortage of sustainable investments these days, much different from a couple decades ago. And there's lots of tools to use to assess this environment. I think the important things to think about when it comes to sustainability is what companies are doing in terms of management, but also what they're doing in terms of their business, right? How are they treating their employees? How are they treating their customers? All of those things are accessible through different analytic systems, but also accessible through hiring outside managers who can actually do that work for you, because it's difficult just for you as an investor to try to pick and feel your way through the stock market without really looking under the hood to see if what they're doing is truly ESG in a sense. So I think from a standpoint of investments, it's really important to focus in on what what firms are doing, not only from a green perspective, but also technology is important, right? Because from a sustainability side, you're going to have opportunities, whether you're looking at green infrastructure, right? So you'll see opportunities, even though we're building green infrastructure, base metals, over the course of the coming years will be highly important to build that infrastructure. It'll be about green infrastructure. It'll be about, med tech, green tech, fintech, all of those things will come under the umbrella. So lots of areas to look at. It's just not one siloed area. And I think the investors are actually seeing the benefits of investing sustainably through COVID-19. Because I think before the pandemic, lots of investors thought, I don't want to give up returns to being green. But now they're actually seeing that investing in companies that are ESG friendly can tend to outperform the index, especially over the recovery of this pandemic.
And Candace, I want to put together some of the different themes you've been talking about and that you talked about in your note, because I know you say look beyond the US. You also say you can't ignore China. China's central bank today cut rates. They're already in a tightening cycle. Of course, they're also still growing at a relatively fast pace relative to the rest of the world. At the same time, when you're looking at these ESG factors that you're talking about, China has some challenges when it comes to investing, particularly what's going on in Xinjiang, for example. So how do you counsel investors to look at China and sort of navigate some of those waters?
Absolutely. There's no shortage of volatility, especially in the near term, and we understand that. There's a big shift in terms of what the government is looking for. They are looking for and seemingly accepting of lower GDP in hope for more resilient GDP going forward. And with that said, many different types of regulations are being passed across the board. Then you have issues with the property sector, and then you have concerns over things like what they are doing from a sustainability standpoint. With all of those in mind, there are sources of volatility near term. But if you think about China long-term and also emerging markets, I do think that China is too big to ignore. They're the second largest, economy in the world. Like their population is over 1 billion people. So as you think about that, there are ways to access this market. You don't have to invest in everything within the Chinese market. You can access, for example, the A-share market, which is a very local market, which you can gain access to companies that may not be listed in our local exchanges, but are highly relevant in their markets. You can access it through many different ways, like bonds as well, as they increasingly get included into different indices that will be have a huge impact into this market. So China, I would say, even though there may be some volatility near term, it is simply too big to ignore in portfolios.
Candace, thanks for your time this morning. Candace Say is Managing Director and Global Head of Strategic Advisory Solutions at Goldman Sachs Asset Management. Appreciate it. We want to get you our stat of the day. 537. That's how many private equity tech deals there have been this year. It's only January 20th, folks. Last year, private equity tech deals doubled to a total value of $786 billion. So we'll see how many more we end up having by year end. All right, we are going to take a quick break here. When we come back, we'll have, of course, more on these markets, and in particular, something that Ed Mills alluded to at the top of the show. What could be some of the regulatory challenges to another big mammoth deal, Microsoft buying Activision?
Microsoft's nearly $70 billion deal for Activision Blizzard is far from signed, sealed, and delivered. Regulators could dig in their heels on the transaction, experts say. Yahoo Finance's legal correspondent, Alexis Keenan, has been working on this one for us and joined us now. Alexis.
Hi, Brian. Yes, I've been talking with antitrust lawyers to try to understand if this mega deal is really destined for regulatory pushback, meaning will the FTC or the DOJ, whichever is eventually assigned to do the antitrust review, in reviewing the deal, will they file a suit to try to block it? And the short answer really is, at least for US regulators, is that they'll definitely take a really close look here and maybe even ask Microsoft for some concessions, but that ultimately this deal will stay mostly intact. Now, the antitrust lawyers, they point to one major potential sticking point, despite that the deal is technically a vertical integration with Microsoft primarily in that gaming consoles with its Xbox business, and also with Activision in the content business, truly. So they caution that Microsoft could make its new acquired content from Activision exclusive to the Xbox. That's the main thing that these lawyers are looking for. They say that could trigger either an antitrust lawsuit or requirements from regulators to really limit the level of exclusivity that Microsoft and Xbox would have. So let's take a look at the video game content that Microsoft is acquiring from Activision. You can see there 6 big names, importantly, Call of Duty. And then if you step back and take a look at what is NPD's list of top selling video games, you start to see where the potential sticking points are here. This is from December of 2021. You can see there that Activision's in the #1 spot with Call of Duty. And then among the companies that have both gaming consoles as well as content assets, you go down and you see there Microsoft with owning Xbox right behind Activision with its #2 game Halo. Then further down the line, Nintendo, which of course has Nintendo Switch, and it's still popular game Pokemon. And then you see Sony down below. Sony has PlayStation. They're further down the line there with Marvel's Spider-Man. So there are, though, some other competition considerations as well that could become part of the regulator's review. Those could include looking separately at the gaming industry and breaking it down and saying, okay, what is this deal's impact going to be on mobile gaming versus console gaming? Those could be considered 2 separate industries. We still don't know how the regulators are going to define the markets. That's a huge point here. Also, regulators could look at the deal's impact in the still very nascent metaverse industry. Lawyers are saying that regulators could definitely step back and say, look, there's still an industry to be had here. What could we do to make sure that competition is fair in that soon to be, or maybe it's already here, it's in some people's minds in that industry. So the timing of this should take about 6 to 18 months, wide span, of course, there. But overall, the review is not going to happen right away. It will take some time. And also there are staffing shortfalls at the FTC that still have not been filled. So these regulators have a lot on their hands. Perhaps this one will go over to the DOJ this time.
Alexis, the metaverse is here already. I can't confirm that. It is, in fact, here. Well, thank you for covering this for us. Alexis Keenan, we'll talk to you soon. And we will be right back with another look at the markets. Stick around.
Well, we continue to watch an early recovery in stocks here today. As Jared Blickery pointed out earlier, the Nasdaq tends to rally the day after it enters a correction, which it did yesterday. And indeed today, it's up some 1.5%, at least for now. The S&P up 1%, as is the Dow. We got consumer discretionary and tech leading the way higher here on this Thursday morning. Only energy stocks are very slightly in the red. We're going to talk much more in the next hour about what to do with your holdings. We've got a big bear with us, Mike Wilson, who has the lowest year-end target for the S&P 500 on the street. He's Morgan Stanley's chief investment officer and chief U.S. equity strategist. He'll be with us next.
Welcome back to Yahoo Finance Live on this Thursday morning. I'm Brian Sazi, and that right there is my friend and yours, Julie Hyman. It's another touch and go session for traders after Wednesday's ugly midday reversal. All three major indices are solidly in the green so far, but as we have seen the past few weeks, that can turn on a dime. A lot more volatility has crept back into all sorts of markets, notably that Nasdaq. Now, here are a few other things we are watching for you at this moment. Flying into the loss zone, the Yahoo Finance ticker pages for United Airlines and American Airlines are seeing heavy interest after the airliners reported another big quarter of losses due to the pandemic. United Airlines said it lost $646 million in the fourth quarter, while American Airlines showed a loss of $921 million. Both companies also issued cautious guidance. And a blown tire. One of the hottest stocks in the market has hit a speed bump. Ford shares are seeing volatile trading in the early going after Jefferies slashed its rating to hold from buy, saying the stock is lacking a, quote, new angle. Ford shares fell 7.3% on Wednesday. And clamoring for change, we'll talk with the president of the World Economic Forum on what he sees as the world's biggest challenges at this point in the pandemic. But first, start on the markets. Start to the year hasn't been kind to the bulls, especially those dabbling in tech stocks, as the Nasdaq has fallen into correction territory. Some pros on the street think this corrective period for markets has only just begun. Mike Wilson is the Chief Investment Officer and Chief U.S. Equity Strategist at Morgan Stanley and joins us now. Mike, always good to get some time with you here. So you have consistently said you have been looking for a correction in the first half of this year. We have the Nasdaq down about 10% or so. The S&P 500 not down as much as the Nasdaq. How much further downside do you see?
Yeah, well, thanks for having me on, Brian. I mean, look, I think what we have to acknowledge is this correction in the indices really began a while ago. Okay, and you could argue it began almost a year ago. That's when a lot of stopped in the spring of 2021. I think it took on another flavor, another level of correction when the Fed started to pivot its policy in early November. And that was right after Chair Powell was renominated. And I think the market started to figure out that, this Fed was going to fight inflation and fight it aggressively. And I think, that the market gets to joke on that. And so really since early November, the growth stocks have taken the most pain. That's really part of our two-stage corrective view. Okay, we call it fire and ice. The fire is essentially what we've already seen, which is inflation got out of control, and now the Fed is having to respond to that, and that's having a negative impact on valuations, particularly the most expensive ones. So that's good. That means that the market gets the joke, and it's discounted some of that. The second part of the narrative, though, which I don't think is really over and probably hasn't even begun yet, is that we're seeing a slowdown in growth. Okay, I think people appreciate that. And our view is just that it's going to slow more than what is modeled. Okay, both from an economic and an earnings standpoint. And there's really two or three reasons for why we're a bit more pessimistic on growth in the near term. And the first one, of course, is that fiscal stimulus is fading. Second one is that there's a payback in demand for things that were overconsumed during the pandemic. And then the third one is margins and profitability, because obviously these costs, are now eating into profitability. So that has to play through. We think it'll be basically over by the second quarter. We don't know exactly what month. Obviously, it's difficult to predict, but I would say another 10% downside for the major averages because they really haven't corrected yet. While the average stock has seen quite a bit of downside, the major averages still have a good 10% down from here, in my view. And then that sets us up for a pretty good second half, quite frankly, because Omicron's fading, and the rest of the world is going to have a pretty powerful recovery in the second half of this year.
Hey, Mike, it's Julie here. We've definitely noticed, as we've been getting some early guidance from companies on earnings from last quarter, an uptick in companies coming out with negative guidance. And you had a chart in your latest report that really put a fine point on that we have been seeing the negative revisions or really come up, and so positivity go down. What are you going to be looking to hear from companies this quarter? What questions do you want answered that are going to let you know kind of just how bad things are out there?
Yeah, I mean, I think it's going to be really mixed, Julie. I don't think every company is going to, suffer through this period. It's going to come down to execution, right? I mean, some companies are actually, benefiting from the trends that we're seeing. They have pricing power. They can pass it right along. Some things are going to stay high in demand. And then other companies, probably the lower quality operators are going to really struggle here, whether it's with labor costs, supply chain constraints, logistics, et cetera, and then just flat out missing sales because they underestimated the payback in demand. And so it's just going to be messy. Right? So what we want to see is we just want to see expectations come down either via price or via earnings forecasts. And if that happens, then we'll feel more comfortable. Right now, we think, a lot of margin assumptions are unachievable. So we want to see margins come down. And we think valuations are unsustainably high still at the index level. And just give you some numbers that 2021 times is kind of where we're trading on forward 12-month earnings for S&P. The more realistic sort of valuation metric we think is 18 times. And, we know it's a bit of a sort of black magic art more than science, but we have some pretty good models that tell us that 18 times is the right number. So let's see that come down. Let's see the revisions kind of come down, and then we'll reevaluate.
And Mike, in a sort of a concrete way, what's going to be the biggest obstacle here? Is it going to be inflation for these companies and the sort of varying ability of them to pass on costs? It doesn't feel like that the demand side of the equation is the problem.
Yeah, it doesn't right now. I think that is common wisdom that basically it's a supply problem, not a demand problem. We don't agree with that at all. We think that essentially the supply shortages have led to an abundance of over ordering, double ordering, whatever you want to call it. And as supply picks up, which is now, that's what we're starting to hear, of course, right? That supply is getting better. Normally what happens is we see orders get canceled, right? So as people get enough product, they start to then cancel those orders. And that's the next stage. So we think demand is actually overstated in every industry. There are some businesses clearly where there's pent up demand still. Maybe that's in consumer services, healthcare services, things that people weren't able to consume, obviously, during the pandemic. And look, once again, I think Omicron is, it's a good sign that basically the hospitalization and mortality rates are much, much lower. So I'm very optimistic that we're going to see the end of this pandemic sometime this spring. But with that comes better supply, which means then the double ordering gets revealed. Okay, so that's what we got to be, I think, focused on here for the next couple quarters.
Mike, you've seen a good number of investing cycles in your time. And the way I think about it, over the next 6 months, you're going to see the Fed wind down its balance sheet, potentially hike rates 4 times. And you know what? So what? We see the Nasdaq down about 10% right now. It doesn't strike me as a major correction. Why are investors so complacent heading into really a clear shift by the Federal Reserve?
Well, I think they were complacent. I don't think people are complacent now, right? I mean, I think the Fed has made it crystal clear through their communications recently that they mean business. So I don't think that complacency is nearly where it was 2 or 3 months ago. But look, this is what financial repression for a better part of 15 years has done, right? I mean, the Fed has been over generous with policy during this period. And so people have become used to that. And so now this pivot has come on us so quickly. That's why the adjustments, are happening rapidly. And that probably is not over with, meaning there is, a new regime. There's a new sort of Fed in town because they've had success. I mean, let's not forget, part of the reason why they're tightening is because they've had more success than they imagined, right? They got more inflation than they dreamed of. That's good on one hand. Okay, that means we're getting out of the secular stagnation. That means growth can be good, but what you pay for that growth now is under question if rates are going to be higher down the road. And that's the main issue. It's not about rates, being at 180 today or 175. It's where are rates going to be in 5 years, right? When you're investing in stocks or other long duration assets, you have to make an assumption about where rates are going to be over the investment time frame over the next 10 years. And I would say the odds of interest rates being higher, cost of capital being higher over the next 10 years has gone up materially with the Fed's success. And that's the sort of point of recognition that has really come upon the market so quickly here.
So, Mike, if you're not going to get return from the broad stock market here, and again, to remind folks, your year-end target for the S&P is 4,400. Where are you going to get it? Where are you looking for return this year?
Well, I mean, it's at the stock selection level. I do think this is the year of the stock picker, and I think clearly you need to see. You need to pick stocks, basically pick the winners, which is not impossible, but it is harder in a world where the overall averages are flat to down for the year. Now, look, we're still fully invested because, we still think stocks over the investable time frame, call it 3 to 5 years, are still going to be the better place to be. So, part of this is just a digestion period too, Julie. I mean, we've gorged on returns for the better part of 2 or 3 years, not to mention the past decade. So some of this is just payback, and basically people having to just, buy some time in here. You're still getting about a 2% dividend yield on the major averages. Some stocks are paying dividend yields of 3, 4, 5%, and they're growing. So that's part of your return. And that return is still going to be there because we think earnings are going to be fine and the ability to pay dividends is going to continue. So it's not uninvestable. Okay. There are also many individual stocks that have underperformed for years that are starting to come back to life, whether that's in energy, some of the financial sector, some of the international markets, perhaps emerging markets could come back to life if we're right about the second half of this year. So we just think that this one, decision, buy it and forget it, compounder, growth stocks. I mean, that was a great trade and it was a great investment theme, but now you need to kind of think away from that and there are other things to do.
Second half of the year can't get here quick enough. Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist at Morgan Stanley. Always nice to see you. Have a great rest of the week. Straight ahead, Amazon is opening its first real-world clothing store. Julie and I have a few hot takes on this one. We'll stick around.
Unilever has walked away from its potential deal with GlaxoSmithKline, saying it will not increase its offer for $68 billion. This move comes as analysts and investors were voicing their concerns on the price and strategic fit of that proposed deal. Unilever reportedly made 3 proposals for Glaxo's consumer unit last year, which the company rejected because it, quote, fundamentally undervalued the business and its future. Instagram is starting a trial of a new subscription service that will allow creators to charge for exclusive additional content. Meta Platforms launched this feature in the US on a limited basis, saying that subscriptions are the best way for creators to have a predictable income. Pricing of those subscriptions from 99 cents to $99.99, with options in between. And Amazon is opening its first ever physical clothing store, Amazon Style, in Glendale, California. That store is going to feature men's and women's clothing, shoes, accessories with a wide range of prices. Shoppers can browse the store through their smartphone, selecting things on display that they like and then having them added to the fitting room or a pickup counter. The store is going to be the size of a typical TJ Maxx. It will not offer any special discounts for Prime subscribers, unlike folks who shop at a Whole Foods, for example. Brian Sozzi, you and I have been around the retail block for quite a while here. We've seen a lot of concept stores, I think safe to say, in our time, a lot of different technologies that people try to apply to these stores. And Amazon, to be fair, there was a lot of stuff at the wall to see what's going to stick. So we don't know if there's going to be a wave of Amazon style stores across America 5 years from now, or if this is one and done. But I don't know, what stands out to you about this store and whether you think it's going to have any staying power?
I love what stories like this imply, Julie, that all of a sudden Amazon's going to open up 700 stores that have all of these giant iPads all over the 30,000 square foot location. Macy's going to go out of business. Bye-bye Dillard's. Nordstrom, forget you. I'm going to go to this Amazon style store. The bottom line is this, at least for me shopping, and I think I'm somewhat of a normal shopper, not normal in many other ways, but when I walk into a store, I don't want to check into an Amazon app. I do not want to hold my phone and scan a QR code so Amazon is getting more information from me and that can blast my email account with Whole Foods offers. I just want to go in and shop. Now, secondarily, this is another company trying to push it forward in terms of the fitting room experience. Apparently, you can press a button or log into an app in the fitting room and get clothes handed to you that if things don't fit, you can ask the workers to bring you more items. I, for one, am not standing butt naked inside of a new Amazon store waiting 12 minutes for one of the 2 employees on the floor to bring me new clothes. I want to get in. I want to get out. So I appreciate all the pretty photos floating around the internet on this. It's just not for me. I'll go to Macy's. I have been critical, but I like going to Macy's.
This raises so many questions about how you try on clothes in a store, Brian Sozzi.
We can keep it moving. We can keep it moving.
But I'll leave that aside for a moment. I mean, the other thing is that the Amazon Style apparently is just going to have like one of an item out on the floor. It won't have multiple things for you to have to sift through. I mean, I appreciate the idea of trying to remove some of the pain points in retail. In other words, the idea that you do have to look through a bunch of stuff to find your size, the idea that you are in the fitting room trying to get somebody's attention. But to your point, it's hard to see that the so-called throughput will be improved by adding a layer of technology where you're going to have to enter it in to get your next size. It is tough to say that that's going to improve things.
Yeah, I'm not revealing my fitting room experience. And real quickly, Julie, who has an opportunity to just to redo the fitting experience? It's Lululemon. They spent $500 million to buy Mira, and there you can see a photo. I was in the Los Angeles Lululemon store. These mirrors are just sitting there collecting dust in these Lululemon stores. They're not even on. They have nobody at the stations telling people what the heck this thing even is, and that is me taking a picture of myself in a mirror. I think Lululemon would be better served to put these things in the fitting rooms and try to reinvent the fitting room experience inside their own stores, because clearly not a lot of people are buying these things.
2 things I love, Brian Sozzi. One is that you bring up this picture of yourself whenever the opportunity arises, whenever Lululemon comes up. The other is that you call it Mira. Is that like
Mira.
The Long Island accent? Mira.
Oh.
Mira.
Oh.
I don't know what that is, but I like it. And just a reminder for folks, as we're talking about Lululemon, it's one of the worst performers in the Nasdaq since it reached its high, and we have seen this correction, although it's up today. Look at that. We'll see if we'll see if more stores of the future can come out. All right, we're going to take a break. When we come back, the Securities and Exchange Commission once again taking a look at cryptocurrencies. actually making some changes to increase its scrutiny of crypto. We're going to have more on that after the break.
SEC Chairman Gary Gensler is locking in on crypto regulation this year. Yahoo Finance crypto correspondent Jen Schonberger has more on this. Jen.
Securities and Exchange Commission Chairman Gary Gensler says he hopes to regulate cryptocurrency exchanges this year while warning about stablecoins. In a media availability on Wednesday, I asked Chair Gensler whether this would be the year that the SEC would regulate cryptocurrency exchanges. He told me, quote, "You shouldn't put timelines on yourself, but I will say I sure hope so. If the trading platforms don't come into their regulated space, this would be another year of the public being vulnerable." Gensler reiterated there are real vulnerabilities with cryptocurrency exchanges, calling crypto a, quote, highly speculative asset class, and underscoring that the platforms might be registered in some jurisdictions for light consumer protection, but that's not about market integrity. Meanwhile, Washington very focused on how to regulate stablecoins. When asked whether the SEC would look to levy regulations on stablecoins this year, Gensler told me, quote, "I don't want to get ahead of any one discussion with outside folks or any one possible investigation." Now, Gensler says he's also working closely with other regulators, such as the head of the CFTC, Treasury Secretary Yellen, as well as the Federal Reserve and the FDIC on new rules. In general, Gensler says he wants to bring stable coins in crypto within the regulatory perimeter, and to the extent that any actors or anyone is operating outside of that perimeter, the SEC is prepared to bring enforcement action. Now, some analysts have said that stablecoins could be regulated by the SEC akin to money market funds with new disclosures and liquidity requirements. When asked about that, Chair Gensler said he does see some similarities between stablecoins and money market funds. So, guys, this could be the year that the SEC could levy regulations on cryptocurrency exchanges as well as the space. Back to you.
Hey, Jen, I'm curious what you're hearing from crypto people about this latest, right? Because there has been this sort of attitude, I feel like, from those in the crypto community that those in Washington just don't get it. And I wonder if you've heard any reaction to some of the SEC's latest moves here.
Well, let me take it a little bit broader than that, Julie. I will say that there was a hearing at the tail end of last year before the House Financial Services Committee where many CEOs of crypto companies testified, and they felt that they had a really good dialogue with lawmakers and that lawmakers are gaining a better understanding. I will say, in speaking with certain senators, that they are really diving into this and trying to get a better handle on things so that they do regulate this space properly. At the same time, I think the industry is hungry for rules of the road so that there will be better clarity. And analysts that I speak with say that there are a number of institutional investors waiting on the sidelines to get into crypto if they had better rules. So it's kind of a push and pull here.
Indeed it is. Yahoo Finance's crypto correspondent, Jen Schonberger. Good to see you.
Thank you.
All right, coming up, we'll have some top strategies to beat the upcoming Federal Reserve's rate hikes. Stick around.
Retail investors, those putting money in their 401ks, anyone wanting to buy real estate, everyone is asking about rate increases this year and what you do in your portfolios in order to strategize right now. It's a tricky question. Jaime Quiros is a senior portfolio manager at FBB Capital Partners, and he's here to help people navigate through it. So when clients come to you and say, what do I do right now in terms of this? What are the sort of top tools that you give them?
That's a great question. It is a hot topic right now. I get various calls or inquiries about it. We're looking at stocks to offset the Fed rate hikes. We're looking at full equity allocations, right? Because we feel that the long-term factors will more than offset the near-term pressures. We're looking at trimming those high evaluated names or expensive valuations and or the large weightings that run up in the portfolio, and using those proceeds to add possibly to some of that fixed income when the rates do go up. And then finally, we're adding to attractive valuations. The volatility recently in the markets has given some opportunities, and we're looking to take advantage of those.
And it's interesting, Jaime, as well, because you're looking at the ISM numbers, manufacturing surveys in particular, as potentially rolling over a little bit as we get further into the year. And so what kind of implications will that have, and how can people be sort of defensive if that's happening?
Yeah, again, just trimming those names that run high and staying within the targets. And if you're looking to add into the equity space, right, you're looking at defensive names, staples, so that if that does happen, when in terms of the manufacturing does cool off, then you're kind of protecting the portfolio.
When clients or potential clients come to you right now, what's the biggest investing mistake you see them making?
Yeah, the fear of missing out on the names that run up so much right now. Trying to get into tech or the names that were working in during the peak of last year, right, in the middle of last year, where names where they just ran up so high, and trying to add to those, and right now they're not doing so well.
And are you also talking to people about sort of alternative assets in this environment?
If you mean like cryptocurrencies and that kind of thing, it's tough to talk about those.
Whether it's cryptocurrencies, whether it's sort of real estate, like anything that's not stocks, I guess basically is what I'm asking.
Yeah, no, it's a good question.
Where that should fit in.
Yeah, well, we favor stocks more because of the dividends they pay and the growth aspects of it. When it comes to commodities, it's tough, right? Right now they are going up, but it's been volatile over the summer. We favor more stocks. And while we do keep an eye on commodities and real estate, right now it's more appealing to be in the markets.
Gotcha. All right, sticking with stocks here. Thanks so much, Jaime. Appreciate it. Jaime Quiros joining us to talk through some strategy, or FBB Capital Partners. Appreciate it. All right, we're going to take a quick break. When we come back, Davos may not be happening today, the World Economic Forum there, but we are going to hear from the World Economic Forum president next.
Hello there. Welcome back to Yahoo Finance Live. Let's get a quick check of the markets here. Markets are in rally mode after yesterday's really tough session here. All three major indices solidly in the red. Even the Nasdaq, which fell into correction territory yesterday, and seeing some green over there in the Nasdaq as well. All right, switching gears. Two of the biggest risks facing global businesses right now are the pandemic and climate change. World Economic Forum President Borge Brende told me. Here's more from our chat as the World Economic Forum holds a series of virtual events with top business and political leaders.
Thank you for hosting me, and I'm really looking forward to also hosting you in physical Davos. This week, we are doing it digitally as last year. We have many of the key leaders of the world with us, and we have focused on rebuilding trust, because there is a lot of lack of trust globally. We are faced with a very polarized world, and if we are going to succeed in getting trade back on track, the global value chains, but also more inclusive growth, we also need countries to collaborate, at least on some of the key topics where there is common interest and should be for cooperation.
Where are you seeing the biggest pockets of distrust?
I think today we are seeing it between the G2, the two largest economies in the world, the US and China. It's almost 50% of the whole global GDP. And we have seen lately that China and US are challenging each other on trade. They don't look at things the same way when it comes to technology, and also on geopolitical issues. What we do hope in the years to come is that we will not see like a total decoupling between these two big economies, because we're all going to pay a price for that. Because if we then stop trading with each other, we cannot use the comparative advantages, and the global value chains have brought a lot of the wealth that we have seen during the last 2 decades. We doubled the global GDP in 2 decades, and partly because we have also then traded with each other, and we had this win-win approach and not the zero-sum game approach.
And just staying on that, Borge, China's President Xi did speak virtually at the event, pledging that China will be carbon neutral by 2060. Now, how could China and the U.S. work together? Because to me, this seems to be that like there could be some common ground here.
Indeed, and this is a topic where there is deep common interest, and that's also what we saw at the end of the COP26 in Glasgow. Secretary Kerry came together with the Chinese envoy, and they found some text that secured outcome, and we're still on the track there. 1.5 degrees Celsius is possible to reach. And what we have seen in the past is, for example, on the JSPOA, on the Iran nuclear deal, China and the US came together. We also seen it in other incidents, on other topics. So let's see, let's be pragmatic about it. And we feel that our platform, that's a neutral and impartial one, is the right one to bring business and governments together and find those pockets where you can collaborate even in a polarized and fractured world.
I remember pre-pandemic, Borge, you and I were actually in person in Davos talking about the theme of the event, or one of the themes of the event at the time was stakeholder capitalism, and companies need to do more. And now we have BlackRock's CEO, Larry Fink, saying in his annual CEO letter, stakeholder capitalism isn't woke. Where do you see the progress being on stakeholder capitalism compared to when we last spoke?
I think we have seen a lot of progress here. At the COP26, we saw the global companies took the lead. They came out and pledged going net zero by 2050. Some even said 2040. Together with President Biden and Secretary Kerry, the World Economic Forum launched its First Movers Coalition, where you got the big purchasers of the world, the Apples and Amazons of the world, to come together and say, we will green our supply chain. If you don't reduce your CO2 footprint, you cannot be someone that is eligible for selling to us. And I would like to see companies more and more pushing the envelope, being on corporate governance, being on anti-corruption, being on climate, and also biodiversity, like really securing our planet.
In so many of these companies, I hear your point, Borge. They've put out timelines, or they want to reach X goals on climate change by 2050. That's a long time away. I mean, do you think companies should start moving up those timelines and moving quicker on these initiatives?
Yes. And we are seeing companies that already said that we will go net zero by 2030. Some say 2040, but we will not reach our all goal if we don't get their so-called hard to abate sectors with us too. This is shipping, aviation, steel, aluminium, fertilizers, and they have a long way to go. And here we also will have to rely on technology breakthroughs. But we have companies now saying that their container ships in 10 years, many of them will be based on something else than fossil fuel. We also see huge development when it comes to aviation. So I think we're at a crossroads when it comes to decoupling economic growth from growth in CO2 emissions.
We're also at a crossroads, Borge, with the pandemic. And I know Dr. Fauci spoke at the event. How is there a timeline? Do you think we're moving past this? And how concerned are companies right now about the pandemic continuing beyond this year?
I really hope we are. We're moving from a pandemic to something being endemic. Maybe Omicron is the end of this, moving into more like a normal flu season, but we don't know. There is many people on our planet that are not vaccinated, and there can be some new variants brewing somewhere. That's why we also say that COVID anywhere is COVID everywhere. So we have to roll up our sleeves and we have to get more boosters and more people vaccinated. But hopefully at the end of this year, we will be in a much better space when it comes to the pandemic.
And what does the World Economic Forum view as normal? I've been seeing this a lot more lately. We will return to some form of normal as we get past Omicron. But what does that even mean nowadays?
I think it will be quite normal if we don't face maybe the pandemic of the century. That has been very tough. It also led to $14 trillion being launched in economic stimulus. We haven't seen something like this since the Second World War. It led to countries now being more indebted, or we don't have that much ammunition fiscally anymore. We're seeing inflation is also rising. So countries need to collaborate so we get out of the woods here. A normal situation, in my view, is a situation where we again can concentrate on creating jobs, also building prosperity, but also being much more conscious about resilience and being prepared for the next crisis. I think we have too many blind spots, and we have to really, really address those blind spots so we don't end up in the same way we did with the financial crisis in 2008, and now with the COVID crisis without being really well prepared.
Speaking of the pandemic, thanks to red hot inflation, prices are headed higher soon for some popular products from products giant P&G. We'll have a hot take on this straight ahead.
Inflation, of course, is the word on everyone's lips. We heard President Biden talk about it last night. And it's also something, Brian Sozzi, that you talked about with John Mueller, the CEO of Procter & Gamble, because the company's raising prices.
Yeah, a reminder to all new investors that are just now navigating onto our platform for one thing or another. Earnings day for a publicly traded company does not actually end on earnings day. You know, it really behooves you as an investor to just mine the earnings call transcript for potential nuggets. It could mean make or break for your investments in that particular company for the weeks and months to come. And I've been digging into the P&G earnings call transcript, and they called out in mid-December, they announced price increases to their retail partners that will go into effect on February 28th. So if you buy a lot of household cleaning products, save that date, because on February 28th, it will cost more to buy Tide, Gain, Downy, Bounce, and Unstoppables. Those are all cleaning products made by P&G. Now, P&G also said on the call that they just announced this week price increases for their personal healthcare products. And some of these brands include, according to their site, the likes of Metamucil, that is owned by P&G, Vicks, and yes, Pepto-Bismol. Now, we talked to P&G's new CEO, John Mueller, about inflation and if they're going to push through more price hikes. Here's what he told us.
We've announced price increases in the majority, I think 9 out of 10 categories. Some of those price increases have not yet come to the shelf. They haven't yet come to market. So we're going to work through that before we take the next step.
Do you see any signs we are nearing peak inflation, just from your standpoint in your business?
There are some commodities that are starting to modestly roll over, which is encouraging. There is capacity being added to some of the input supply chains, which is encouraging. On the other hand, in markets like labor and transportation, I don't expect any near-term decreases.
And Julie, P&G shares finished yesterday up close to 5%. That is a strong move for consumer staple stock. We're seeing the stock up another 1% here. I would argue in large part because they have not really seen any resistance to these price increases. So you take those price increases, you bolt it onto the fact that perhaps inflation is starting to cool a little bit in some categories for P&G. And over the next 12 months, this company could show some pretty solid bottom line results or profits.
Yeah, there's so many areas where we're not seeing pushback on higher prices. It's really been fascinating in this environment, even though economists are sort of looking for those areas where it's starting to happen. I want to do a little bit of a Yahoo Finance interactive tour because there's one area where we have also not seen prices come down, and that's aluminum. And that's something that is helping Alcoa here. It's one of our trending tickers after the company came out with earnings. Whenever I see Alcoa earnings, it reminds me that Alcoa used to be the first out of the gate, and we have seen a big shakeup in the order of companies reporting in recent years. But Alcoa shares are higher by 2% today, and that's because the company talked about stronger aluminum demand, persistent supply constraints this year. That's even though Alcoa has some higher costs itself. And that put a little bit of pressure on its EBITDA and on its bottom line. But sales were up by 40%, Saz. I mean, just pretty incredible numbers from Alcoa. Incredible results, but also too, like I just mentioned with P&G, Julie, it is good to mine an earnings call transcript for the likes of an Alcoa. It touches so many parts of the global economy, and President and CEO Roy Harvey noting on the call, they're already starting to see an impact on energy prices and in some parts of their business because of increased tensions between the U.S. and Russia. Very interesting call out there, something to watch as some of these multinational companies report earnings in a few days. Yeah, most definitely. Some of the other movers I just wanted to highlight, we talked earlier about Luminar, which is signing an agreement with Mercedes to provide some of its LiDAR technology to help power next generation autonomous driving. Those shares up by 18%. We have talked with Luminar founder and CEO Austin Russell multiple times about the company that he is building there. And so this is really a landmark partnership for that company. Also wanted to switch on over and look at some other movers and groups of movers that we were watching. Chinese stocks really stand out to me today, Saz, because look at all that green on the screen. Alibaba, by the way, also happens to be the top trending ticker on yahoofinance.com. And for good reason, you see this rebound after what has been pretty dismal performance, of course, going back to the peak in the Nasdaq 100 and the Nasdaq Composite, of which many of these companies are members. This is the performance since then. I only see one green on my screen, and that's Baidu. Everything else is in the red. And so we're seeing this little bit of a rebound here today. We were just talking to Candace Say a while ago from Goldman Sachs Asset Management, and she said China is really one of the themes that the firm recommends playing in 2022. And it looks like people are starting to nibble more at some of these Chinese stocks. But really, what we're seeing is a rebound overall in technology. This is today's Nasdaq 100. All of the largest stocks in particular are seeing a boost. Tesla in particular up by 4.5% today. And like many of these other stocks, it has been sort of more struggling in recent days up. And so that's something to keep in mind on an eye on here. Also, as we watch some of the movers in today's session, our Jared Blickery was flagging for us that solar stocks are on the move as well. So that's something to continue to watch, Saz.
Yeah, just going back to those Chinese stocks, Julia, I think they're probably getting a boost from the China rate cut. That's one thing, but you have to wonder how sustainable this move higher in those stocks are. P&G noting on their call yesterday that they saw a slowdown in demand in China, which is very interesting. I'm just going to file that away and to be on the lookout for more commentary on China's slowdown from other companies as they report. Of course, earlier in the week, we saw a significant slowdown in their GDP.
Yes, indeed we did. So that's kind of what we're keeping an eye on here today. One other note I wanted to make, by the way, is what we're seeing in energy stocks, which are sort of not as performing as well today, with the exception of Baker Hughes, which came out with numbers that beat estimates. Going back inside the Yahoo Finance Interactive here, these are the energy stocks in the S&P 500 and beyond, for that matter. And we're seeing Baker Hughes BKR in the upper left of your screen. That's one of the best performers in the S&P 500 today, with an increase of 5%. So that's something to continue to keep an eye on, Saz.
Yeah, also Netflix, time is ticking. Julie, Netflix earnings after the close. Good preview right now. Just hit the Yahoo Finance homepage from our very own Alexandra Semenova. So I encourage everyone, check that out and share it all over social media.
Yeah, that's going to be a big one that we'll be talking about tomorrow. All right, we are going to leave it there. Sazi and I will be back here tomorrow morning. We'll be talking about Netflix, among other things. In the meantime, Akiko and Brad will be taking you through the next 2 hours of trading.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brad Smith. We are 90 minutes into the trading day. Tech stocks clawing their way back one day after dipping into correction territory, the Nasdaq that is. The sector leading the gains in this session today with the Nasdaq up nearly 2%. We've got the Dow up more than 1% and the S&P 500 firmly in the green. Turbulence for United Airlines, shares falling as the airline warns of Omicron denting bookings. The carrier also lowering its growth forecast, while American Airlines posts record revenue in the pandemic. And Union Pacific tops profit estimates as the railroad raises prices to keep up with rising costs. But rampant thefts in one of its largest markets threatens to derail some of that momentum. We're going to be speaking to the CEO of Union Pacific a little later this hour, but we are beginning this hour with a pulse check on the Biden economy. 1 year since the president took office. And Brad, this is really interesting how things are being framed in the 1 year context, because when you look at the number, 6.4 million jobs created, a sharp decline in the unemployment rate, things do look good. And yet inflation continuing to plague the White House with levels at near 40-year highs. We heard from the president yesterday in a near 2-hour press conference saying he is happy to double down on his record.
I'm happy to debate and have a referendum on how I handle the economy, whether or not I've made progress on. Look, again, how can I'm taking too long answering your questions. I apologize. I think that the fundamental question is, what's Mitch for? What's he for on immigration? What's he for? What's he proposing to make anything better? What's he for dealing with Russia? It's different than I'm proposing that many of his Republican friends or his colleagues are supporting as well. What's he for?
The president there, of course, referring to Mitch as in Senator Mitch McConnell. But let's bring in our first guest for the hour to dive in a little deeper into the president's record 1 year on. We've got Greg Valliere, AGF Investments Chief U.S. Policy Strategist. And Greg, it feels like the White House has a bit of a messaging issue here, because if you look at the broader economic data, things have been ticking higher since he took office, and yet they just can't escape that big cloud of inflation.
You're right, Akiko. I mean, the economy is in pretty good shape. The unemployment rate is remarkably low, but they can't sell their story very well. There's shortages in stores. Inflation obviously is a big problem. And after 2 hours talking to the American public, what people will remember was a really serious gaffe that he made on Ukraine.
And so, as we continue to think about what the president said yesterday as well, and especially given this broader topic of inflation, and even with some of the picks that he's put forward for the Fed, he did say yesterday, given the strength of our economy and recent price increases, it's appropriate, as Fed Chair Jerome Powell has indicated, to recalibrate support that is now necessary. And so walk us through, from your perspective, the picks that President Biden has made in order to take on this daunting task of curbing inflation.
Well, Brad, I don't think he had much of a choice. I think he had to do this. He had to give the power, or the blessing, I guess, to Jerome Powell to begin hiking rates. And he's, be careful what you wish for, because a 3 or 4 rate hikes this year could start to hurt a little bit. In all the years I've been doing this, I rarely have seen a U.S. president welcome higher interest rates from the Fed. They don't like to see higher rates, and unfortunately for Biden, that's what he's going to get.
On that front, it felt like there's a bit of a pivot yesterday from the president, now pointing the finger at the Fed to say, look, inflation is higher, but that's also, in terms of price stability, that's part of the mandate of the Fed. When you take a step back and look how quickly prices have climbed, how much of that do you think is about the Biden policy? How much of this is about Fed policy?
Well, there are lots of villains, I guess you could point to. One is, I think, Jerome Powell was a little too complacent, didn't recognize the severity of the problem until, summer, and that was perhaps a little bit late. The supply chain issues are huge, and I think, unfortunately, they're going to persist for at least another half a year or so. And obviously there's COVID, but I'd say the politicians that I talk to here in Washington would tell you their big problem is all the spending. And a lot of their constituents are saying that as well. So that means, in my opinion, getting the Build Back Better bill or parts of it, which Joe Biden would like to get in the next few months. Are we going to spend a lot more money in an economy that's this hot? Maybe not.
And so variants continue to be the unknown variable here, especially considering how the Fed also has to take in whichever steps policy-wise that they take in, even on the spending side that we had seen earlier on in the pandemic. That economic detriment that was incurred, a direct result to not just the alpha of COVID-19, but then later on, where there were more thoughts about where there needed to be a deployment of capital and where there still needed to be parts of the economy that needed to be upheld over time. And so from your perspective, with that unknown variable of the variance going forward, where might this policy even need to be amendable in the future?
Well, the economy's gotten a lot of medicine in the last year, an enormous amount, $6 trillion or so in infrastructure and COVID relief. And many states, California in particular, New York State, incredibly, are flush with cash right now. They have more money than they know what to do with. If I were a governor, I'd put a lot of the money into a rainy day fund, but they're going to be spending a lot of money. So I think all the medicine this economy has gotten will keep the economy in pretty good shape. We just can't have inflation at this level. I think Biden realizes it, and I think he's going to have to accept it. But really, even if the Fed funds rate gets to 1 or 1.25%, that's still a pretty low Fed funds rate. And I think it's not going to be necessarily crippling for the wider economy.
Greg, looking ahead to now year 2 of the Biden administration, certainly midterms looming in the fall, there's a lot of questions about what happens with a key part of his domestic agenda in Build Back Better. It felt like the president was kind of conceding yesterday that this will have to be broken up. How do you think the key priorities in this roughly $2 trillion bill moves forward, especially given the politics?
I think he's going to succeed on some of this. I think Joe Manchin is perfectly happy to get pre-K funding. He's always been a big proponent of it. I think Manchin would agree to some expansion of Obamacare. I think Manchin might even agree to a lot of environmental provisions. So if you split this up into 2 or 3 or even 4 bills, I think some of it will get done. That would be a very desperately needed victory for the Democrats, because I'd have to say right now, here we are in the middle of January, we've got a long way to go. But right now, I would say that the issue is not whether the Republicans take the House. The issue is by how many seats. They only need 5. I think the Republicans might get 20, and I'm on the low side. There are many other analysts who think it could be 25, 30, 35 seats. So Biden needs some victories, and maybe the first victories he gets by springtime is some form of Build Back Better.
No question, the president and Democratic leaders watching the calendar very closely with those midterms looming. Greg Valliere, always good to talk to you, AGF Investments Chief U.S. Policy Strategist. And we are going to be diving deeper into this 1-year mark for the president, his accomplishments, and his challenges that we've seen over the last year. We've got a special plan for you this afternoon. I will be co-hosting along with Adam Shapiro. That is at 4:30 p.m. Eastern, the Biden presidency, year 1. Let's take a look at the markets right now. We've seen things pick up here in the last hour or so, with the Dow now up more than 400 points. We're watching the Nasdaq closely here, bouncing back in a big way after finishing or closing in correction territory yesterday. Let's bring in Yahoo Finance's Jared Blickery, who's tracking the rest of the market action for us today. Jared.
That's right, Akiko. I'm looking at the Wi-Fi Interactive, and I'm seeing the Nasdaq Composite up 2%, and this is a pretty meaningful number. I'll get to that in a minute, but I just want to show the intraday price action. That's today. I'm going to dial this back to a 2-month chart on a candlestick basis, and you can see from up here, that was the highs, the recent highs, but I think actually we need to go back a little bit more than there we go. So here is the record highs, and here's the low that we had just yesterday. Nasdaq dropped into correction territory. Will not be out until we get back to those record highs or rally 10% from here. Choose your definition. Nevertheless, we're seeing some strength. And I went back and I looked at all the times Nasdaq had entered correction, and it's been a buy the last 13 out of 14 times since 1997, with a median gain of 2.09% the following day and 2.97% the next 5 days. And here's that table. And the Nasdaq wasn't making record highs for about 15 years there. So I went back and did the same analysis using 52-week highs, and we get 16 out of the last 22 occurrences since 1997 have been positive days. So interesting to see this playing out. Now, I want to go back and look at the sector action for today. It's really centered around the mega caps. And I'm going to go in here and we can see tech, consumer discretionary, communication services. Those are the big leaders. And all of those are the houses of the mega caps. Real estate is also outperforming there. But to the downside, staples and materials and energy, those are the laggards, but you can see everything in the green there. Want to take a look at Chinese stocks because those are really popping today. And in fact, if you take a look at the last 2 days, some of these names really rallying even more. We see Alibaba up 4%, Pinduoduo up 11%. Is this a new rally? Hard to say. Sounds like, or it feels like a dead cat bounce for now, but needs to be proven. Want to take a look at the software sector because that has been under pressure. This is a 2-day look. Let me dial it back to a 1-day look, and we can see continuing that strength from yesterday. This has been a beaten down sector, so nice to see some strength there. And finally, let's get to the mega caps, and those are going to be found in the Nasdaq 100. We see Tesla up 4%. Some of the big movers here are the Chinese stocks we were just taking a look at, but also some of those beaten down names that we can see in the ARK Innovation ETF holdings. And this is another area that has been just beaten down over the last few months. Here's a 2-month look. Still have a lot of ways to crawl back here or claw back here, but nice to see this group of stocks getting some love. And we might as well take a look at the banking sector. We kind of wrapped up all the big banks yesterday. Morgan Stanley getting some follow through after a nice beat on its earnings yesterday. Let's just take a year-to-date look. Maintaining gains of just over 1% for Morgan Stanley, guys.
All right. Thanks so much for that, Jared. Well, we are also watching airline stocks today after United and American posted their fourth quarter earnings. American Airlines up just slightly here after posting a narrower than loss than expected. Let's bring in Yahoo Finance's Adam Shapiro with the details there. American and United, a bit of a different story here, Adam.
Yeah, and let's start with American. One of the reasons that American investors might be breathing a sigh of relief was they ended the fourth quarter with $15.8 billion in total available liquidity. Now, this is the highest year-end liquidity balance in the company's history. Remember, American has, all the airlines, by the way, have considerably larger debt loads. But it's Americans that has gotten a lot of attention. So when you jump into this, when you look at where they stood in the quarter and what's coming down the pike, no secret that the Omicron wave is having an impact on all the airlines and, of course, American. Doug Parker said the volatility from Omicron has created the most challenging planning environment in the history of commercial aviation. You should also know in the last quarter, they had the highest revenue they've posted since the pandemic began. And one of the things they're pointing to as to their personal recovery at the airline is that they hired 16,000 people last year, and they intend to hire 18,000 this year. Raw numbers, they lost $931 million in the quarter. The revenue was $9.43 billion. When you compare that to 2019, before the lockdowns, it was $11.3 billion. So that's the American picture. Now take a look at what's happening at United. They also lost something like $600+ million, but revenue in the quarter was better than expected at $8.19 billion. The one issue that they're guiding for at United that might be of concern to investors is that their costs in the first quarter are going up, even when you exclude fuel. So that's an issue that United is trying to deal with. And of course, Scott Kirby talking about the fact that Omicron, this is a quote, Omicron is impacting the near-term demand. We remain optimistic about the spring and excited about the summer and beyond. Let me put this into context for you. When Ed Bastian joined us on Yahoo Finance Live last week to report Delta's earnings, he said, look, January and February, we will not be profitable. But Bastian made a commitment that that airline will be profitable in March. Kirby not going quite there. He's just talking about the impact that Omicron has had on United. And one of the things, they all look the same to us, their planes, their airlines. But at United, 50% of their revenue before the pandemic was based on international travel. And that right now is hampered, especially to Asia, which is big for United because of Omicron. Team?
Adam, specifically on staffing, we got that letter from Scott Kirby a few weeks ago talking about the challenges that he's had to face with so many employees getting the variant, and yet he pointed to progress since that mandate was put in place at United. Did we get a little more color on that front and whether, in fact, they have the staffing in place to keep up with the demand?
They have talked about the fact that they have not been able, it's something like 50 planes and flights a day are grounded simply because of staffing. That was Delta actually. At United, it was 100 a day. So they are all in an urgent rush to hire people. As far as staffing because of Omicron, United 2 weeks ago let it be known that because they originally had the vaccine mandate, which, 90, I think it's 95% of, might be even higher, of their employees are vaccinated, that even though there are breakthrough cases, not one, I want to repeat that, not one United Airlines individual employee has died because of COVID-19. And prior to the vaccines, that was a different story. So Kirby was very optimistic about the fact that the vaccines had worked and protecting the staff that he has in place.
All right, Adam Shapiro, Yahoo Finance's Zone. Thanks so much for joining us on this, all of the airlines earnings that have come out, of course, of this week. We've got much more earnings season rolling on. Adam will continue to break down the airline sector as well. And on the other side of this short break, key player in the supply chain, Union Pacific, saw revenue increase year over year, but also worked through an uptick in railroad robberies. The freight train company CEO breaks down the company's earnings and day-to-day operations coming up. Shares of Union Pacific moving higher after the freight railroad company closed the books on its most profitable year ever, but not without some challenges. An alarming increase of freight train looting in Los Angeles has further impacted the supply chain for anybody out there missing an Amazon package. Union Pacific Chairman, President, and CEO Lance Fritz joins us now, and Yahoo Finance's own Adam Shapiro hanging with us for the conversation as well. Lance, let's get right into it. Full year 2021, you said that this was the most profitable year ever for Union Pacific despite lower volume. So looking forward, walk us through the demand outlook for 2022.
Yeah, Brad, thank you very much for mentioning the record year we just closed up on. What a testament to the team, because it was anything but an easy year. As we move into 2022, the profitability of our business is built on three pillars: volume growth, making sure we have good, solid productivity, and pricing power. And in terms of volume growth, the fundamentals of our markets look like they're still solidly in place, notwithstanding inflation. Consumers are still in very good shape. Their balance sheets are in good shape, and they've got plenty of cash to spend. And the industrial economy looks like it's pretty healthy. And industrial production is estimated to be recovering to the tune of, 4.5% to 5% as we go into 2022. Those two things are pillars for the goods economy. And so the goods economy looks like it's pretty healthy.
Hey, Lance, good to have you here. Usually I would jump in and talk about operating ratio and volume, growth as it relates to revenue. I want to talk about the future because the deal with Schneider Intermodal, for those of us who are not in the shipping business or the logistics of getting all of these things moved, this is pretty big. I want to read from their press release about the deal. Union Pacific Rail creates more opportunities for Schneider and our customers because they plan, this is 25,000 containers right now. They're going to be the biggest intermodal partner you have, but they're going to double the size of their intermodal fleet by 2030. For investors, what does that mean? And for your business, what does that mean?
Yeah, Adam, let me just make one correction, because I've got a great existing partner in the Hub Group who's been with us for, a dozen years. And I think they're probably still going to remain our largest intermodal partner. And having said that, the addition of Schneider and Knight Swift, who we onboarded at the beginning of this year, that forms a formidable number of customers out in the marketplace competing in the domestic intermodal space. What really gets me excited is how much potential we have to take more trucks off the highway and get more containers onto Union Pacific. These are very, very competent, very capable operators, and I am really excited to have them part of the UP team.
Yeah, in the press release you said, and this is a quote, I want to share it with everybody, when we pair Union Pacific's transcontinental rail solutions with our company-owned assets and professional drivers, we will be an unstoppable force in the intermodal marketplace. When we talk about, though, what happened in Q4 and where we're headed, there was one statistic, and it had to do with volumes. It was the business volumes as measured by total revenue carloads down 4%. It was an improvement, actually, over what we saw in the third quarter. But help us understand what that's signaling to you.
Yeah, there were two big headwinds during the fourth quarter. Fourth quarter volumes in our bulk segment and our industrial product segment, they look good. They were growing, healthy. We felt good about that. There was some opportunity that we left on the table in the bulk world, mostly about crew availability. Where we really faced headwinds was in our premium segment, and there were two big issues there. One was the chip shortage in finished vehicles, so our finished vehicle shipments were down, and our auto parts into finished vehicle factories were down. And then international intermodal shipments were down. And we've talked about that, Adam. That's a phenomena where Pacific Ocean carriers who own the international boxes were trying to get those boxes made empty in the LA basin instead of letting them go inland so that they could turn them back around and get another shipment in Asia. That's because the trans-Pacific rates for shipments were so high compared to history. They had a huge incentive to basically go port to port and not let their boxes go inland. That's going to remedy over time. There's more that goes inland normally. We talk to all of our customers. I think they're moving in that direction, but that really impacted our fourth quarter volumes.
Also, Lance, I want to talk about one of the targets that you've set for yourself as a company within the sustainability and environmental kind of protectionism that many companies are charting their own targets for. And going forward from here, you had talked about in this release how you fell kind of short of some of those targets. Where do you intend and where do you look to and seek to get back on track with regard to the targets that you've set forth there?
Yeah, actually, we feel pretty good about our progress, Brad. One thing that happened in the year is that we, for the third year in a row, improved our fuel consumption rate. That's a fundamental driver of reducing our overall greenhouse gas emissions. We've committed that by 2030, we're going to reduce overall absolute emissions by 26% on scope 1 and scope 2. And we've also now committed to being net zero by 2050. We're the only U.S. railroad that's made that commitment. And I'm really pretty darn excited about the progress that we are making. A lot of that scope 1 and scope 2 is going to be about the fuels that we use and converting our locomotives to alternative fuel. Early on, it's going to be about using more renewable diesel and biodiesel. And we've got a good, clear path to trying to make that happen over the course of the next 10 years. And then inside of that, we've got to continue to do a ton of work on converting to alternative fuel. And we're in the process of making a very big commitment about that. So keep your eyes open. I think in the next week or so, we should have an announcement about some very exciting news on that front.
Yeah, we'll certainly be waiting for that announcement. Lance, it's Akiko here. We have all seen those images out of LA County with the looting that's happened. And you've highlighted the impact to the company, $5 million in claims, losses, damages, and gone as far as to say if things don't clean up here, potentially you'd look at rerouting things. And I wonder what the realistic option is here. Can you really avoid LA County altogether if in fact the situation doesn't get better?
Akiko, clearly we don't want to do that. That's a nuclear option, and we would be very, very hesitant to pull that trigger. I will tell you, we've got our arms around this. We think at this point, we've amped up our use of technology like drones to be a deterrent and to help collect evidence. We've amped up the number of our own special agents, our police force that are present in those areas. We're partnering with LAPD. They've amped up their presence with us. We're encouraging the district attorney locally to prosecute more of these cases. The criminals there have turned from 2-3 years ago a theft event every now and then. It was one-off, wasn't well orchestrated. It was an opportunity crime. Now it's an orchestrated, organized crime that happens. We've largely cleaned up the areas from the video that you've seen and that you've shown. We've got good cooperation with the governor's office. They're going to be on the ground there with us today, this afternoon. So I think we've got our arms around it, but there's a lot of work that has to be done here. We need more prosecutions. And oh, by the way, we're also going to be making capital investment in physical barriers, in more physical security, whether it's metal security fence, razor wire, or concrete barriers. It's sad to say that we're going to have to do those kinds of investments, but we've got to keep our employees safe and our customers' lading safe.
You mentioned the cooperation from the LAPD as well as the governor's office. Are you getting the same cooperation from the district attorney? I mean, it sounded like when this story initially broke, there seemed to be a bit of tension between, or more frustration maybe, with the way that you saw the county handling these cases.
Yeah, our frustration is about making sure that prosecution occurs. There was a fair amount of criminals that we apprehended and booked with LAPD, only to see them back out, 24 hours later. And then they would brag to our police officers about how, a misdemeanor is nothing and they're just not worried about it. We need the theft to be prosecuted like what it is. It's organized, it's grand theft, and we need a strong deterrence to stop that behavior.
You emphasize too the thing that many of us sometimes don't realize is the threat that this organized crime effort might pose to the safety of your employees. It's with that in mind, because I've heard you stress that these barriers you want to put up the goal is to protect your employees. Got to ask you about Omicron. What kind of impact has the wave had on staffing? Hopefully people who did get breakthrough cases were able to recover, but what's that doing with your ability to transport goods?
Adam, thank you so much for that question. Yeah, we addressed this also on our call today, and I'm crystal clear about this. In our planning for the second half of the year, we missed that Omicron would behave, that COVID would behave like it did, that we'd see a third and fourth wave. We expected kind of status quo, getting a little better over time. And so I think we missed that as a risk. As a result, crew availability was an issue, and it impacted our operation. One great thing about the fact that we implemented the federal contractor mandate in October is that over 3/4 of our population heading into November and December were vaccinated. I think that had an impact on both their exposure and the severity of symptoms for those that got breakthrough cases. We can see that, when we track every day how many of our employees are quarantined for either presumed positive or exposure. And that did uptick in the fourth quarter. But it was nothing like the uptick in cases we saw in the communities that we serve and where our employees reside. So I feel very good that we're doing what we need to do to protect our employees. They're protecting themselves. And like in this LA situation, we've just got to continue to look out for their safety and their health. And we're committed to do that.
And we'll be watching for any progress on that front. Lance, it's always good to have you on our show. We appreciate the time today. Lance Fritz, Union Pacific Chairman, CEO, and President, and our very own Adam Shapiro joining in on the conversation. Coming up, it is game on for Microsoft. We're breaking down the legal hurdles the tech giant could face following the company's near $70 billion acquisition of Activision Blizzard. That's straight ahead. We'll be right back. Well, Microsoft is bracing for intense regulatory scrutiny on the heels of that $70 billion acquisition of game maker Activision Blizzard. The Federal Trade Commission, the Justice Department, among many agencies that are going to be taking a closer look at the size of this deal and whether, in fact, it limits competition. Let's bring in Yahoo Finance's Alexis Keenan for a broader look on that. And Alexis, that was the immediate thought here when we got that announcement earlier this week. Where do you think the arguments lie?
So intense, maybe. That's what I've been trying to figure out by talking with a lot of antitrust lawyers, trying to understand really if this deal is bound for regulatory pushback. In other words, will the FTC or the DOJ, whichever agency is tasked with the review, will they decide to file a suit to try to block this deal? Now, the consensus from these experts is that as far as U.S. regulators go, they'll take a very, very close look at this deal and even possibly ask Microsoft to make some concessions, but that ultimately the deal will stay intact and be able to go through. Now, these antitrust lawyers, they do point out one still unanswered question that all of this could possibly turn on. And it could be a big sticking point, despite that this deal is technically a vertical integration of these companies, with Microsoft being primarily in the industry of the gaming consoles with its Xbox, and with Activision in the business of content. So what the caution is here is that if Microsoft makes their acquisition of the gaming content exclusive to their Xbox, that then could very likely trigger either an antitrust lawsuit or some requirements from regulators to really limit the level of exclusivity of that gaming content. So let's take a look at some of the big video game content that Microsoft is said to be acquiring from Activision here, and namely, importantly, Call of Duty there you see among those 6. Now, the next thing I want you to look at is to take a step back and look at the top selling video games. And this is as of December 2021. By looking at this, you can start to see why exclusivity could raise some concerns for market competition. You have Activision, they're a content company in the #1 spot with Call of Duty. Then you step down and you go to the companies that have both gaming consoles as well as content assets. You see there Microsoft in the second place with they are the owner, of course, of Xbox. They have that #2 game, Halo. Then comes Nintendo, which owns the Nintendo Switch console, and the #3 position with its Pokemon game. And then further down, you see Sony, owner of PlayStation, down at that #7 position. So there are some other competition considerations too, though. The deal's impact could be looked at for the difference between the industries of mobile gaming versus console gaming. That's one of the ways that the agencies could slice and dice and try to look at whether competition is going to be a problem after this deal. They also, I'm told, could be looking much more broadly at the nascent industry of the metaverse. That's one way that they could say, look, does Microsoft's combination with Activision pose a problem for that still developing industry? Now, the timing of this deal is said to take somewhere between 6 to 18 months, but still a lot to be seen here as to how even the markets that are involved are going to be defined. Also running parallel to the deal being reviewed is on Tuesday, the FTC and the DOJ, they have announced a joint effort to try to really tighten the anti-review guidelines. So that's going to be all happening at the same time. So a lot of things will influence, a lot of moving parts will influence how this deal will ultimately shake out and whether it'll be challenged.
A lot of popular content titles on that list that even I grew up playing, Alexa. So this is going to be closely watched to see if this gets all the way through. You know, as we're talking about competition, we have to talk about what's on the docket for the Senate. The Open App Markets Act, that is set to be debated in the Senate. And so the significance of this, especially as you've got Apple and Google facing this kind of moment of truth in the antitrust space. Help us break this down even more.
Yeah, Brad. So there are a couple of Senate bills that are on the table here. And the one that is being considered today, being debated today by the Senate Judiciary Committee, and one that people believe has some of the best chances to actually become law. It's called the American Innovation and Choice Online Act. It's a bipartisan bill that is from Democrat Amy Klobuchar and Senator Chuck Grassley, a Republican from Iowa. So the bipartisan nature of it and the fact that it is moving along here, it does have some decent chances at getting through. Now, the aim of this particular bill is to keep those tech companies, some of that you mentioned there, Amazon, Apple, Google, from favoring their own products and services over their competitors on their platform. So we've seen so much of that, particularly with the in-app purchases and the Epic and Apple litigation. The goal here is really to try to make a level footing for the products and services that live on these platforms that are controlled by these big tech companies.
Yeah, a crucial day in the Senate's effort to rein in big tech today. We're going to be watching that one closely. Alexis, thanks so much for bringing us that story. Coming up, a sky-high record broken. We're going to reveal the impressive journey of one teenager becoming the youngest woman to fly solo around the world. Her story and others in our Worldview segment after this break. In our Worldview today, a new report out of Germany says Pope Benedict failed to act on child sex abuse during his time as Archbishop of the Diocese in Munich. The investigation commissioned by the church says the retired Pope knew priests were in fact molesting children, but looked the other way. The report examined complaints over 7 decades and uncovered nearly 500 victims at the church. The study identified more than 235 priests who were held responsible. Benedict has denied allegations he tried to cover up the abuse. Well, scientists have discovered a rare stretch of coral reefs deep in the South Pacific. Divers from UNESCO first spotted the 2-mile patch in November, more than 100 feet underwater off the coast of Tahiti making this the largest discovery of pristine reefs at this depth. Scientists say the coral reefs appear to be untouched by climate change and human activity, unlike other parts of the ocean floor that have already been mapped. Nearly 15% of the world's coral reefs have been destroyed by warmer temperatures over the last decade, and researchers say they hope the latest discovery will help them gain a better understanding about the role deeper coral reefs can play in the ocean's ecosystem. And a high-flying feat for one teenager in Belgium. 19-year-old Zara Rutherford set a world record as the youngest woman to fly solo around the world. Her plane touched down in western Belgium 155 days after she took off. Along the way, she traveled across 5 continents and 41 countries, and her flight was initially scheduled to take just 3 months, but bad weather and visa issues extended her trip by roughly 2 months. The previous record was held by a woman, was set by 30-year-old American Shasta Waits, that was recorded back in 2017. Rutherford's feat comes just 5 years after she began flying, but aviation runs in her veins with both of her parents, no surprise, pilots. The all-time record still belongs to 18-year-old Brit Travis Ludlow, who completed his journey last year. Coming up, pandemic pressures looming for employers. We're going to be breaking down how businesses are handling COVID hurdles in the workplace as Starbucks walks back its vaccine mandate plans.
The employer-employee relationship has been in the spotlight while companies evaluate return to office timelines, vaccine policies, wages keeping up with inflation, and retention, of course, as well. To discuss these key decisions correlated with the employment situation, we've got Rich Lesser, who is the global chair over at Boston Consulting Group, joining us now. Rich, great to have you here with us today. You know, we'd love to get a sense and a pulse of your discussions with CEOs, especially as they are navigating a lot of these broader employment-based themes as they set their course for 2022.
So I So I think right now to be a CEO, you have to be thinking about 3 time horizons. One time horizon is the immediate, the next couple quarters, and you pegged the biggest issue well, which is, the people challenges right now. We know attrition levels remain high. People are changing jobs. Many companies are looking to hire and looking to hire ambitiously because their business outlooks are not all, but mostly pretty strong. And so navigating that is really tricky. And frankly, how to navigate the uncertainties that Omicron presents. I was talking to a retailer yesterday who's had massive numbers of people out of work, and it's starting to come down now a bit. They're more Northeast based, but many people are facing challenges. And the other thing I'd say is very much near term are still supply chain challenges. We know China's still facing enormous pressures on its supply chains as it's navigating through the pandemic. We have all sorts of disruptions that have gotten somewhat better, but are still remain very challenging. Those are the short term. The medium term, I think, centers around the future of work and digitization. The long term is often around climate and sustainability. So they're juggling across 3 timeframes right now, which is quite interesting.
Yeah, Rich, I'm going to get to the long term in just a bit. So specifically on the staff shortages, though, to what extent has that dictated a company's policy on vaccine mandates? We have seen a lot of businesses, hospitals as well, kind of walk back their policy because they aren't able to staff up in a big way if they keep that mandate in place. What are you hearing in your conversations?
It's a real pressure point, particularly for a lot of organizations with frontline workers that are trying to provide service to their customers, whether that's a hospital or a retailer. The pressure is very real. But I think some companies have succeeded to navigate that pretty effectively. I mean, the list that you have on screen now are all companies that have made a choice that there will be some short-term pain. They try to educate their employees. They try to show support, but they also try to be clear that this is a responsibility. It's a responsibility to our community, to each other, and to our customers. And they've been able to get through it. But I do understand a lot of companies feel enormous pressure on this, depending on their locations, the state of their workforce, and so forth.
In another kind of commitment to community and responsibility to community as well, on the climate front, you've actually collaborated with the World Economic Forum and you produced the CEO Guide to Climate Change. I would love to understand, where you believe that some of the corporations are keeping their commitments in place and actively meeting some of those targets, or on the opposite end, falling behind some of those targets that they've set forth.
Yeah, so it was really terrific. We had our annual meeting of the Alliance of CEO Climate Leaders yesterday. It was virtual, of course. We couldn't all be in Davos like we often are, but it was nearly 80 CEOs from the leading companies around the world, all of whom have made bold pledges. And the overall news, I think, is an encouraging news. The chart you have on screen now, we've seen the growth of companies signing up for the Science Based Targets Initiative, basically saying they have serious climate targets, growing 65% a year over the last 5 or 6 years, now over 2,000 companies. So I would say overall, many more companies are signing up. The pledges themselves are getting more substantial, not just about the amount of reduction within their own operations, but taking on the challenge of their entire value chains. Scope 3, as it's called in climate language, to bring those down. So those commitments are going up. But you highlighted in your question the other part of it, which is commitments are great. Translated into action is what we need. And that requires new ways of operation, new skills, changes to the business portfolio, changes often to leveraging technology, and different strategies to compete. What we tried to do in the report that we did. Oh, sorry, Akiko, did you want to jump in?
No, Rich, I wanted to follow up on that very point I was thinking about, which is moving beyond just sort of the headline commitments and really talking about Scope 3. We've seen some of the big companies like a Pepsi, for example, make significant investments in working with suppliers. How much of that you think expands even further this year? I mean, what are you hearing from companies about how much they are now willing to put aside to be able to work with suppliers so they can truly say that they are carbon neutral?
So first of all, you're so right. Other than the people in the hardest to abate sectors like steel and aluminum. For most companies, most of their footprint is in their scope 3. It's in their supply chains. It's actually not in their own operations. So if you only focus on your own operation, you don't deal with your suppliers, you're a big global company, you're leaving most of the need on the table. That's being more and more recognized. The commitments are going up. It will be a multi-year journey. Many of these suppliers are farmers or mid-sized companies, people that may not even understand how to approach it yet. So this isn't a flip a switch kind of thing. This is a multi-year, engage with suppliers, educate them, partner with them, in some cases be willing to pay more for the products they offer because it's the only way they can afford to make investments, and to figure out how to make your products more valuable to customers so that it gets paid for, so that you can afford to do it. The point of the work this year, because it is so important, is to show that actually there's a huge advantage to being an early mover in this. And that the risk for most leading companies is not that they go too fast, it's that they go too slowly. And going too slowly risks really falling behind. Look at Tesla and what they've been able to do. You want to be ahead of the curve in your industry, and there's value in terms of employees and attracting talent. There's value in terms of the cost you can save. There's value in terms of cheaper financing and in terms of shareholder value, and that there's an urgency to act for the planet, but there's also an urgency to act for the business. And I think that really comes through.
Yeah, and added pressure from investors increasingly. I mean, that's another layer for these companies. Rich, always good to have you on the show. Rich Lesser, Boston Consulting Group Global Chair, joining us today. Coming up, VC investments are booming. The details as venture capitalists spend mere minutes reviewing pitch decks and pouring money into startups. That's straight ahead. Welcome back to Yahoo Finance Live. Investors pumped a record $93 billion in investments into early stage startups last year. And new data points to just how quickly some of those funds are moving. Let's bring in Yahoo Finance's Alexandra Semenova with that story. And Alexandra, I see these headlines, and it's sort of reminiscent of what we saw back in 2013, 2014, where a lot of these VCs were just pouring money into companies without really vetting them.
That's right, Akiko. That's happening again. The venture capital industry had a record-setting 2021 by any metric. In the US, VC funding topped $300 billion, and globally, $600 billion was spent on getting companies off of the ground by VCs. And both of those figures were actually about twice the size of those in the prior year. And as a result of this robust activity, firms are also racing for deals and reviewing pitch decks from founders at the fastest rate ever. New data from DocSend, which is a document sharing platform owned by Dropbox, found that venture capitalists scanned pitch decks at an all-time low time spent on deck of 2 minutes and 28 seconds. So as the VC industry has grown really exponentially over the last year, companies are moving at a furious pace to close deals and competing heavily with each other to look for the next best opportunity. And there were a number of factors that contributed to this. One was that big institutional allocators really stepped out on the risk curve last year and poured a lot of money into private investments with venture capital in that category. So as a result, VCs had record amounts of money to deploy to startups. And of course, this led to to an increase on the supply and demand side. So on the supply side, these firms had a lot of money to pour into startups. And also founders were actually pitching and seeking funding at record amounts. So another one of them was that we saw markets really rise to records last year. And as a result of that, we saw sky high valuations that really encouraged VCs to look for growth opportunities. And this led to them seeking deals that had more to return on the end of them. Akiko?
A lot of these VCs also flushed with cash after the type of listings we saw last year, a big IPO year, and a lot of them benefiting on the back of that. Alexandra Semenova, thanks so much for bringing us that story. Coming up on the other side, Netflix gearing up to report earnings after the bell. We'll be speaking with one analyst about why the streaming giant had a tough 2021, but expects this year to get better. That's coming up after the short break. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brad Smith. We are seeing a tech comeback here, a rebound after the Nasdaq entered correction territory yesterday. The tech-heavy index on track for its worst January since 2008. But today we are seeing it up about 1.7% right now. The Dow also seeing its gains up nearly 400 points and the S&P 500 up about 57. We should mention one of the big tech names we're watching, Netflix, reporting its fourth quarter numbers after the bell. We're going to be talking to one analyst who says 2022 is poised to be a great year for the streaming giant. And Biden's first year, the president highlights the inflation fight as he faces a number of other challenges, from voting rights to build back better. I'll be bringing you a conversation with the top economic advisor, Brian Deese, about the challenges that lie ahead for the president. That's coming up a little later this hour. But we are kicking things off this hour with a look at cryptocurrencies. Let's take a look at where Bitcoin is right now, because we have seen it sort of bounce back from the lows that we've been watching above the $43,000 handle. Some big comments coming from SEC Chair Gary Gensler yesterday saying this is the year the agency plans to regulate cryptocurrency exchanges. Let's bring in Yahoo Finance's Jennifer Schonberger with that story for us this morning. Jen.
Good afternoon, Akiko. That's right. Securities and Exchange Commission Chairman Gary Gensler says he hopes this will be the year that the SEC regulates cryptocurrency exchanges while warning again about stable coins. He told me during a media availability on Wednesday when I asked him whether this would be the year that cryptocurrency exchanges are regulated, quote, "You shouldn't put timelines on yourself, but I will say I sure hope so. If the trading platforms don't come into their regulated space, this would be another year of the public being vulnerable." Now, Gensler reiterated there are vulnerabilities with cryptocurrency exchanges, calling crypto a, quote, highly speculative asset class, and underscoring that the platforms might be registered in some jurisdictions for light consumer protection, but it's not about market integrity. Meanwhile, Washington very focused on regulating stablecoins. When asked whether the SEC would look to levy regulations on stablecoins this year, Gensler told me, quote, "I don't want to get ahead of any one discussion with outside folks or any one possible investigation." Gensler says he's closely working with other regulators, including the head of the CFTC, Treasury Secretary Yellen, and the Federal Reserve and the FDIC on rules for stablecoins. In general, Gensler says he wants to bring stablecoins and crypto inside the regulatory perimeter, and said to the extent that any exchanges or other players aren't complying, the SEC will bring enforcement action. Now, some analysts contend the SEC could regulate stablecoins similarly to money market funds with liquidity and disclosure requirements. When asked about that, Gensler noted that stablecoins are similar to money market funds as well as bank deposits. So while it's unclear when the SEC will take action exactly this year, it looks like this could be the year that the SEC will act. Guys?
Okay, Jennifer Schonberger, thanks so much for that. Well, let's turn our attention now to shares of Netflix. Getting a bit of a lift here, up 1.4%, although we've seen the broader tech sector up in the session. Netflix gearing up to report earnings after the bell today, and our next guest is expecting this year to get better after a tough 2021. Let's bring in Nat Schindler, Bank of America Senior Internet Digital Media Analyst. We've got our very own Ali Canal joining in on the conversation as well. Nat, set this up for me, because we were talking about this morning, saying there's been a lot of concern about maybe not a signature franchise being able to lead subscribers or more subscribers to Netflix. But I feel like we talk about that every few quarters, and yet they still seem to be the place to be in streaming.
Well, back in the days of House of Cards, a single franchise was all Netflix had. Now you're putting out massive franchises on a weekly basis. So giving a single franchise, even Stranger Things, enough of a belief that it's going to boost the company that much or boost subscribers that much, it's probably not. It's more the total amount which drives this company.
Okay, and so the total amount and on what price as well, because in your note you also kind of cite the price hikes as well that they've seen, and you're estimating an incremental revenue of $960 million in 2022 from those price changes. And so walk us through where the pricing power may start to fizzle out, or if that will remain intact.
I suspect it will remain intact. Netflix has not seen substantial churn when they raise prices in most markets. There's a short-term bump right when they do it, and then it usually comes right back down, and subscriber growth returns really rapidly. So I think consumers, and you can look at total number of hours consuming Netflix content, it just keeps going up. So they're getting more value out of Netflix every year. So paying another buck, maybe another $1.50 in this case for the mid-price range, is not that much to ask, especially when they're seeing prices rise for everything else.
And I want to follow up on those price increases, because the Wall Street Journal reported that Netflix raising prices amid these signs of slowing subscriber growth could suggest that Netflix is reaching a ceiling of some sort. So what do you think about that report and really the long-term impact that these price increases could have?
Well, I didn't see that specific report, but look, they raised prices 18 months ago when they weren't seeing slowing at all. There would be no way to justify the same they were seeing slowing subscriber growth. You are seeing near peak numbers in the US where they did raise prices. That's not surprising with 80 million households with Netflix right now. Cable peaked out at 110, but with password sharing, 80 million's probably not far from the peak in the United States, Canada level, and they're raising prices. Can they keep raising prices? I suspect they can, because they keep adding content at a high rate. So if you keep on adding content, spending $20 billion incrementally each year on content, that's content that those subscribers cannot even consume in a given year. So they're adding upon adding upon adding. It's layering on. So the value you're getting from Netflix keeps going up. So will consumers keep paying it? I suspect they will, as long as they're still increasing their number of hours viewing.
And in your note, you specifically called out growth in Asia as one of the key drivers for Netflix in 2022. What are you looking for in the earnings report today or the call when it comes to that international expansion? Because Netflix has doubled down in the past that they want to be a global powerhouse.
Yeah, I mean, that's clearly been the story actually for several years here. I mean, as I said, the numbers in the US have been going up, but not going up very much. I mean, as the UCAN region, or United States and Canada, the last few years prior to COVID was going up a couple, 2 to 3 million, and then went up a lot during COVID years. But now this year is probably going to go up about 1 million. That's not really driving the numbers when you're talking about Netflix adding in the mid 20 millions a year in net subscriber additions. So where's that coming from? Parts of Europe are beginning to become heavily penetrated, like the UK, but other parts still have a lot of growth, like Germany and France. But a lot of it is coming out of Asia, where a lot of this great content that they have created recently, like global phenomenons like Squid Game, are driving new subscribers. The big question that needs to be answered is, can they hold these subscribers? Will they stay and be permanent subscribers, or will they just come on when a Squid Game comes on and then leave right after?
And Netflix has talked a lot about that crossover appeal, that kind of content. I mean, Squid Game right there, but in the past, it's been a show like Narcos that really does work across multiple markets too. How much of that do you think, that template, do you think Netflix turns to increasingly? I mean, it feels like if you look at something like Squid Game, the costs were lower, the payoff was really big, and it wasn't just about one market, but it was, to your point, a global phenomenon.
Yeah, and that's very hard to do. And they admit it. They call it their zeitgeist shows, whether it's Stranger Things or it's Squid Game. It's very, very hard for them to predict what will be a zeitgeist show. And they admit this freely. But one, they're taking a lot of swings at bat. And that's the value of Netflix, is that they're going to take so many swings at bats. You compare that to HBO. Yeah, they're making great content, but they don't make a lot. And because of that, if they miss, it's a bigger deal. Netflix takes a lot of swings at bat and occasionally gets something like Squid Game, which is very low cost, certainly relative to something in the US, certainly relative to what Amazon just finally put a name to with Lord of the Rings. This is low price, but high value. They will get those. Will I be able to predict it? No. Will they be able to predict it? No.
While we have you, it's been a hot start to 2022 with regard to deals in the gaming space. So for Netflix, which has added more content, more titles on the gaming front as well as of recent, do you foresee any type of add-on for Netflix and making an acquisition strategically to kind of bolster that side of the business? And what kind of revenue benefits would you expect to come out of that?
I would, I think it's very hard to ever bet on Netflix buying someone, because if you look back in their history, they are one of the least acquisitive companies I've ever seen. I think they have bought 2 companies in total. So they are very non-acquisitive. They are a build it there type of company, build it in-house type of company. So, maybe, but again, I would not ever bet on that kind of outcome, because they have a history of not doing it. On what's happening in the gaming space for them, I still consider the gaming area for them at best poorly fleshed out upside. And what I mean by that is they still haven't really elucidated a clear gaming strategy. And most of their gaming content to date, or all of it, is just really extensions of their television IP. So taking something like Stranger Things and making it into some sort of a game to, build on that hype. That's great. That might create a very small amount of incremental revenue, but more likely just creates marketing buzz around their shows. For them, I don't see them anytime soon getting into the Activision or EA game of creating $60, $70 console titles and really going for that business. And I probably wouldn't be excited if they did. It's a really expensive, tough business.
Nat Schindler, Bank of America Senior Internet and Digital Media Analyst, joining us here today, as well as Alexandra Canal, who is of Yahoo Finance, Yahoo Finance's own. Alexandra, thank you so much for joining us, both of you here today, Alex and Nat. And coming up, everyone, Joe Biden's presidency 1 year later. We're going to reveal the new poll results on the president's approval rating and hear from his economic advisor, Brian Deasy, right after this. Welcome back to Yahoo Finance Live, everyone. Joe Biden's presidency, 1 year later. A new poll reveals the president's approval rating has hit a new low amid rising inflation and Omicron cases jumping in the U.S. 56% of Americans disapprove of Biden's performance, according to the AP. Kiko, that is a stark change from his 59% approval rating. That was back in July.
Yeah, no question about that, Brad. And if you listen to what the president had to say yesterday in that near 2-hour press conference, you get the sense that the White House is really playing defense on these issues. And when you look at the economic data as a whole, it really points to this disconnect that we're seeing between what the White House says they have accomplished and then what voters see. 6.4 million jobs created over the last year. We're talking about employment, near full employment, unemployment below 4% now. And yet here we are talking about every day, the headline being about inflation at near 40-year highs. We had a chance to speak with Brian Deese, who's the director of White House National Economic Council, and asked him specifically about that disconnect and how the White House shifts the conversation ahead of the midterms.
It has been a tough couple of years, and the American people are understandably frustrated and anxious across the board. And so what the president is making clear is that the way to best address that is, number one, act in their interest and try to deliver on those outstanding issues that have yet to be resolved. On COVID, on prices, you hear him with a clear plan on that. And get out of the Washington bubble and more clearly communicate where we are making progress, because as difficult and as challenging as these circumstances are, it's important, for example, that we note that this past year, we saw 30% more applications for new small businesses in America than we saw even before the pandemic. That's important to try to make sure that people understand there's real opportunity in this economy. There's new opportunity associated with changes that are happening that people are already taking advantage of, and others can too as well in a period where wages are increasing as well. So it's important that we make those arguments while also meeting people where they are and show people concrete actions on the ground. I would say the last thing, you saw a president with a clear plan, with action steps. People may like them or not, but he is acting every day in concrete ways. And he's going to make the case that he wants Democrats and Republicans to join him, but for those who are solely focused on trying to stall progress, he's going to also put to the question that he raised yesterday of what is their plan as well.
The president's top economic advisor, Brian Deese, there talking about the challenges the White House faces and trying to get the positive economic message out. And Brad, that is something we heard from the president yesterday, saying that, maybe I have been holed up a little too much in the Washington bubble. And he did talk about the need to get out into communities, get that messaging out there. And certainly they've got a tight timeline here because, all expectations here going into the midterms is that Republicans will take back Congress, and that could certainly derail the president's agenda in a big way.
And that's certainly the historical context that we've seen in the past, too. And it comes back to this question of where, for certain responsibilities in responding to everything from the coronavirus pandemic to the economy and even the correlations that we've seen therein, but also on all of the things that the president campaigned on, where they're looking to see even more progress, where some of those tasks are also delegated to among other members within the president's cabinet. And so on that front, we've heard even on the front of and the discussion that we had earlier about where the delegation of the responsibilities for the Federal Reserve and their dual mandate. And he spoke about this yesterday in his address, full employment and stable prices, and really trying to bring them into the chat and into the conversation, saying that he can't do it alone. However, I think for many people going into the midterm elections, they are going to be looking at this track record and trying to figure out which boxes they can check to see where there has actually been improvement in their household, in their local entities, in their state, and at their businesses as well. And many of those question marks still linger going into that critical midterm election period in time.
Yeah, and the president can talk about the Fed mandate, but if you think about the average voter, they're looking at prices going up at the grocery store. They're looking at how much they've been paying for gas, and they look at the White House, they've got the president there, and that's what's showing up in these poll numbers we've been seeing, which is the president getting hit for those higher prices regardless of where the responsibility lies. So a conversation that we're going to be having a little later this afternoon, a special programming note. We're going to be airing a special looking back on this first year for the president, of course, marking the 1-year anniversary of his inauguration. Not just about the economy, we're going to be talking about foreign policy as well, his domestic agenda. So you certainly don't want to miss that. It kicks off at 4:30 p.m. Eastern this afternoon. Well, coming up, disrupting the auto industry, we're going to be breaking down how Smart Car is aiming to change the game in mobility innovation. That's straight ahead after this break. Well, a rush of investments into climate tech led to a record year for the space in 2021. And our next guests are looking to keep that momentum going by leading the push in mobility software solutions. Let's bring in Sahas Kata. He is the CEO of smartcar.com. He's joined by John Tuff, Energize Ventures managing partner. Sahas, I want to start the conversation with you because you are announcing this $24 million funding round, Series B round, I should say. Talk to me about your company and where you see yourself positioning in this transition we're seeing in the auto space.
Absolutely. Thanks so much for having me on the program, Akiko. It's been a pleasure today. Smart Car, as a starting point, is a developer platform for cars. But before I really jump into what we do, I'm not sure everyone knows what is a connected car. Cars have really become computers on wheels over the past few years. All these cars are now shipping with 4G or 5G connectivity built in, just like your phone. In fact, 9 of the 10 cars that shipped last year are internet connected. And it's been a really incredibly exciting time for the automobile industry. But even with all this progress, it's been really hard to go build apps for cars. Every brand uses its own fragmented systems. And at Smart Car, we've built a platform that lets a lot of innovative mobility companies build apps for cars using a single integration.
John, you're obviously backing Smart Car, but you've made a lot of investments in the climate space overall. I know we're not talking just about EVs here, but talk to me about what's appealing to to you about this company and how you think this sort of moves the ball forward in this transition?
Sure. Yeah, great question. At Energize, we invest in digital solutions that accelerate the energy and sustainable transition. We firmly believe that mobility and software are colliding, and that's creating an opportunity for more climate-forward solutions. At Energize, we do believe specifically that smart car can help connect new stakeholders in the climate movement. First and foremost, we believe that utilities, energy providers, firms that are looking to better manage how electrification of mobility will impact the grid and reduce strain. And we believe that smart car can help bridge those two parties by connecting new applications to utilities.
Sahas, would love to know what type of data and access to that data that both the services side and the driver side is able to take away from these solutions.
Yeah, absolutely. So SmartCar as a starting point is a very customer-focused company. We're driven by product-driven growth. There are now over 100 million compatible cars on our platform across North America and Europe. And one of the exciting things about what we're doing is that we're enabling consumers to, for the very first time, have access to their own vehicle data and have a choice of the type of apps that they want to use with their vehicle. And when we kind of look forward at what people are doing with this, we're seeing consumers connect all sorts of really exciting applications to their car for the very first time. Whether it could be something like an energy utility company, an application that helps you charge your car at the right time of day to save money on charging your vehicle, or an app that gets you insurance that lets you pay by the mile rather than judging you based on an irrelevant factor like your credit score, or even an application that lets you rent out your spare car to make an extra buck on the vehicle that would normally be sitting parked in your driveway. These types of applications are creating new forms of mobility that we're incredibly excited about.
John, we have seen a flood of money pouring into climate solutions. Just a few days ago, we heard BlackRock's Larry Fink saying the energy transition is the biggest business opportunity of our time. And yet when you look at the breakdown of where those funds are going, it's still very concentrated in EVs, in these mobility solutions that some would argue aren't really what's going to move the needle in a significant way. Why do you think that's the case?
You know, the data, as Larry Fink pointed out, is overwhelming that there is more capital moving into our space. And at Energize, we're very excited about that. Mobility is such a tangible form of energy, and that makes it more easy for capital to move in the space. But there is no one silver bullet to address climate change. And so generally, the position for us, and I know for Smart Car, is that anything we can do to help accelerate the transition to more sustainable opportunities, whether it's mobility or other areas, is a win for the economy.
And Sahas, just coming back to you very quickly here as well, the 22 different vehicle models and makes in 31 countries, what are the next steps in kind of ramping up as, the roadmap for many of the kind of behemoth automakers and manufacturers out there as they're getting closer towards realizing real scale for their production of electric vehicles?
Absolutely. One of the nice things about Smart Car is that we're really agnostic across brands. And part of the reason we raised our capital for our Series B and announced it recently is because the adoption of our platform across all our customers has really been rapidly growing. And there's been increasing demand from new markets that we've been entering, like Europe as well. So we're really deploying our capital on two different fronts. First, we're really scaling out our engineering organization to advance the product. And second, we're investing heavily in sales, marketing, and success to really accelerate our go-to-market efforts. And we just want to get to that point in the coming years where consumers who now have an expectation that they can really use the app that they love with their car do have a huge ecosystem that they can choose from. And we're really achieving this by putting really friendly API documentation, SDKs, and tools in the hands of developers to let these folks go build really amazing products and services.
And finally, John, we were talking in the last hour, but about the sheer amount of money that is going towards these early, seed rounds. There's a lot of VCs out there who have a lot of cash on hand, in part because they were able to cash in from those big IPOs last year. And yet our reporter was saying that there's new data out there that points to VCs just spending 2 minutes on a pitch deck before signing off on that check. What are you seeing? Does that make you a little uneasy considering what we have seen in the past?
The history tends to repeat itself. I would say that the amount of capital that goes into renewables and sustainability is still only a fraction of what it deserves, the space deserves. Newer investors are coming to the space. There are a tremendous number of generalists who are now trying to figure out how to invest in this theme of climate tech. We believe that there are great long-term investors for hardware and technical risk out there. But generally, the best returns will happen in digital solutions and capital-light business models, just like Smart Car, that can help enable this transition. And that's where we believe great returns will happen.
Great to have you both here with us today. Certainly appreciate the time and congratulations on this movement on the investment front. And we've got to check back in the future as well to see how this continues to scale up. That, once again, is John Tuff, Energize Ventures managing partner, as well as Sahas Kata, who is the smartcar.com CEO. And coming up, everyone, crypto and your taxes. We're going to break down how to report your crypto gains or losses as part of our Taxes Made Simple series presented by TaxAct. Whether you're the Doge father, the self-proclaimed Satoshi, or flipped an NFT for profit in 2021, our next conversation explores how you can report crypto transactions accurately this tax season as part of our Taxes Made Simple series presented by TaxAct. And joining us today, we've got Tom Shea, who is the Ernst & Young partner. Tom, great to have you here with us. Help us set this up going into this tax season. Perhaps what's the top thing that people need to consider as they're getting ready to file and considering some of their gains or losses that they've made from crypto transactions?
Yeah, absolutely. And thank you for having me on. I guess, I like to think about it in three steps. And if you can take this away from this talk, then mission accomplished. So the first is really understanding the universe of your transactions and what you've engaged in, whether that's a simple buy and hold, whether you've exchanged and sold crypto for cash or other crypto, and even if you've engaged in some type of video game or that involves in-game currency or NFTs, really just kind of understanding that universe is a pivotal first step. The second is really gathering all the available data. A lot of market participants out there are starting to issue certain forms that can assist taxpayers, and there are plenty of tools out there that can also assist with aggregating that data, but that is a pivotal second step. And then the third step is really seeking the appropriate tax advisor. And this can be based on the complexity of your transactions, the volume of your transactions. So those are really the first three steps, and happy to elaborate more on either of those as you see fit.
Well, Thomas, you highlight one of the key questions I think a lot of people have, which is, when do I have a taxable event? I mean, looking at the timing of all of this, how should they be thinking about that?
Yeah, so I guess the easiest place to start is, again, understanding what you've done. So if you've purchased cryptocurrency with cash, you do not have a taxable event. You do not have a reportable event on your individual tax return. If you sold cryptocurrency for cash, you do have a taxable event, and you need to go back and assess what your gross proceeds were from that transaction and compare it to your cost basis, which is essentially what you paid for the asset, but also be mindful of other expenses that could be included in that cost basis, including exchange fees, gas fees, or the like. If you've exchanged one cryptocurrency for another, you likely have a taxable event as well. And in terms of looking at your gross proceeds, you would need to assess what the fair market value was on that crypto on the date that you made that exchange.
And so with all of that in mind, we've kind of walked through what people needed to know for the tax purposes for filing for the year 2021 and getting that filing in here during this year. But what may they need to consider for 2022, even if we think out even to the future?
Yeah, so right now the guidance is relatively limited, right? We mentioned NFTs at the beginning. The IRS has not specifically addressed NFTs. There are a number of other more complex types of transactions, such as lending, that have not had clarifying guidance. I think in the more immediate term, the Build Back Better Act contains certain provisions that could significantly alter someone's trading strategy, specifically if they're doing a high volume across multiple cryptocurrencies. So these provisions could both defer taxable losses and also accelerate taxable gains. So that's something to be mindful of as the Build Back Better Act makes its way through Washington. I guess even further off a little bit further off into the future, you're going to have certain information reporting requirements. This should actually be beneficial to the everyday investor, because you're going to be receiving forms from the market participants, the exchanges that you're interfacing with, that are going to provide a little bit more information around your transactions. So a little bit less self-reporting. The other thing to be mindful of as part of the Infrastructure Act is the requirement to file Form 8300s. Now, this is more if you have an active trade or business, and it requires you to file an informational form when you receive cryptocurrency in excess of $10,000. So I'm really just kind of scratching the surface here. There's plenty of other types of products and transactions out there that have yet to be kind of covered off by existing guidance.
Yeah, certainly a lot of new threads to have to navigate. Thomas, it's good to have you guide us along here. Thomas Shea, EY Financial Services Crypto Tax Leader. Coming up, the Nasdaq seeing a rebound after entering correction territory. We're going to be breaking down all of the market action after this break. Welcome back to Yahoo Finance Live. The Nasdaq leading the gains in the afternoon session, up well over 1.5%, with tech stocks bouncing back from yesterday. Let's bring in Jared Blickery for the latest on the market action. And I said just yesterday, Jared, but we're talking about the Nasdaq entering correction territory, and today a bit of a swing back.
That's right, and I've been I'm writing about this in for YahooFinance.com. I have an article that's going to be published in about an hour or two. I found that when Nasdaq enters correction territory since 1997, the next day tends to be a buy, and in fact, the 5-day returns are about 2 to 3%. So historically, could be a short-term buy signal. But here we have the Nasdaq. You can see it's maintaining most of its gains throughout the day on the Wi-Fi Interactive, up 1.7%, very close to its session highs up here. And also the S&P 500 and Dow holding on to some decent gains as well. And let's check out the sector action, because we have seen the mega caps finally get some love today after getting beaten down again yesterday. Here we see Tesla up 4%. And really what stands out, besides some of the mega caps up 1-2%, is the Chinese stocks and also some of the chip stocks. So let's get to the semiconductor heat map here. We have ASML still riding the coattails of its better than expected earnings, keeping its outlook up 4% today. Applied Materials up 2%. That stock close to a record high. And you can really see the risk on flavor in the markets when we look at the ARC holdings. And this is something that I like to show just kind of as a bellwether where sentiment is in the market. And you can see Invitae Corporation, that is up 10% today. Well, over the last year, it's down 78%. So you can see what we're up against here. Is this a short-term bounce? Is this a dead cat bounce? That's where I'm leaning right now. But if you're long, enjoy the price action. Here's China, and Chinese stocks really surging today. JD.com up 10%. I was looking for news in this sector. Didn't really see anything new or compelling. But again, these are some names that have gotten hammered over the last few months, and they're just getting a little relief rally today. Travel reopening, very similar story. Trip.com up 9%, by the way. Airbnb up 5%. So maybe the bookers and the hotels looking decent again. Let's look to the downside. I don't see any sectors in the red right now. We do have tech and energy and utilities and consumer discretionary. Those are outperformers, each up more than 1%. For real estate in there too. To the downside, we got staples, industrials, and materials. Materials really were the story yesterday, but kind of flagging a little bit today. So all in all, definitely a risk-on day, but will it last? That's a big question, Brad.
Yeah, absolutely. As we continue to navigate some of the concerns that have prompted the larger kind of downturn that we've been tracking and pushed us into correction territory, now back out of it for now for the Nasdaq. We'll see where we continue to move from here. Jared Blickery, Yahoo Finance's own, bringing us the latest on the market's activity here on the day. Thanks so much, Jared. And coming up, everyone, as the creator economy expands and the sponsorship checks, they roll in. Some influencer incomes, they reach higher levels than CEOs. Our hot takes on the trend next. Time now for some hot takes. Ever wonder how you can live like a CEO? Well, all it might take is your cell phone and an app. According to reports, some TikTok influencers are earning more annually than CEOs of Fortune 500 companies. So, Akiko, it's not so much about the one-hit wonder anymore of the music realm. I think we might be in the wrong field, especially if we're sitting here trying to get to some of these highest paid TikTok influencers. A lot of familiar faces on there. I'm not sure they've all showed up in my algorithm, but I recognize them all in some form or another here. Do you want to go first with a hot take, or should I?
Well, Brad, I will say, I mean, we've always been the wrong field, right? Journalism is not a place that people get into for money, but $17.5 million. I mean, that's significant in some comparison here. We're talking about $17.5 million for the top earner on TikTok. By comparison, the CEO of ExxonMobil, Darren Woods, his annual income, $15.6 million. Kevin Johnson at Starbucks, $14.7 million. And I say this is empowering because in many ways, to your point, all you need is just your phone and some good content to push out. Right. I think it's interesting we're talking about TikTok today because we did get some reports out of Instagram yesterday saying they're considering a subscription model with a monthly subscription fee ranging anywhere from 99 cents, reportedly, to $99. So the creator economy, as you said, only going to get even bigger. And that's going to empower a lot of people who say, look, I don't have to go through these big companies. I can make my own.
You know, setting aside my fear of a future where social media lacks like true authenticity or genuine connection, this influencer economy, it does have the opportunity to really create that next generation of kind of the connection point, I should say, rather, if I take a step back, it could contribute to improving or lessening this wealth disparity across genders, across ethnicities that we've seen, even generational gaps, as I mentioned, too. And there was an interesting study a few years back by the CEO Genome Project that actually revealed it takes about 24 years for someone to reach the CEO level. They looked across something like 17,000 C-suite executives, and that was their finding. And I think at the end of the day, in social media, in the influencer economy, I still feel like no one wants to feel like they just got bagged by an ad, but the population that social media has amassed does appreciate real-time relevancy. And where creators get that right, and even with the lighter fluid that could be poured on it by some of the NFT opportunities in the future too, that creates an amazing opportunity for that next generation of wealth for some of the other genders, the different kind of ethnicities that have looked to be able to generate those opportunities for themselves as well, and creating their own small businesses and monetization as well.
Yeah, I mean, still questions about how the algorithm in these individual apps, elevate certain accounts. I mean, that's been a big question as well. Right. Brad, I want to point to some breaking news that we're getting right now with a hard pivot here, looking at the markets in a specific stock we're watching. Shares of Peloton down nearly 11%. After reports here from CNBC that Peloton has temporarily halted production of its connected fitness products with consumers' demand waning. The company saying in a confidential presentation January 10th, so we're talking about earlier this month, that demand for its connected fitness equipment has faced a significant reduction. And Brad, I know this is a space that you've been watching really closely. We were just talking about this last week, about the demand and to what extent Peloton can keep things going as more and more people move out of their homes and return back into the regular workout routine.
Right. It is that question of how they can continue to coexist in an on-premise versus an at-home reality that the workout and fitness setting is moving back into. And so I think with regard to this, the most notable thing is that it's the bikes and the treadmills, whereas prior in 2021, it was all of the question around the Tread Plus and the recalls that we had seen go forth there. But the production for the bikes has also been in focus because of the supply chain issues that they had faced coming into this year for many of these connected devices. And so that is something that's going to continue to be watched by investors, and you're seeing shares down heavily on this news as well.
Yeah, that sell-off accelerating. We're going to continue coverage of that over the next several hours. That does it for Brad and I in these 2 hours, but I'll be rejoining all of you at 4:30 p.m. Eastern this afternoon with our special, the Biden presidency year one, taking a look back on the accomplishments of this administration 1 year on, as well as some of the challenges they face. Much more to come here on Yahoo Finance Live. Keep it right here.
Netflix gets ready to kick off earnings reporting season for big tech. What can we expect from the streaming giant now that the stay-at-home trade falls out of favor? And will its latest price hike backfire? An analyst weighs in. Rent prices are through the roof in cities across the country, and it's where many Americans are feeling inflation the most. Just what's fueling the rise in rent, and what does it mean for the health of the housing market? The CEO of RentPath joins us to break it down. And scoring a touchdown with his investment portfolio. Tampa Bay Buccaneers Super Bowl champ Ndamukong Suh is here to share his strategies for winning both on and off the field. Good afternoon, everyone, and welcome to Yahoo Finance Live. I'm Alexis Christoforous here with Karina Mitchell. We can just call it the great snap back on Wall Street because the Nasdaq rebounding after slipping into correction territory yesterday when it was down 10% from its recent high. We've got tech and financials staging a comeback today, Karina, to lead that advance.
Yeah, Alexis, looks like we've got a little bit of a rally on our hands. Investors clearly buying the dip. That's despite some rising jobless claims numbers that we got in data showing home sales dropped 4.6% in December as supply hit a record low. So looking at those numbers on the benchmarks, the Dow up by about 290 points, the S&P also higher by 46 points, and the Nasdaq better by 199 points. The Dow actually off session highs at the moment, but obviously still in the green. Also want to point out that the small cap Russell 2000 up nearly 2% today after hitting a 52-week low yesterday, and sector-wise, everything in the green. The big winner, of course, tech today, followed by consumer discretionary. Headed over to the bond sector and take a look at the yields. The 10-year is up by, just a little bit. It's at 1.83, so still off that 1.9% high that we saw. And of course, the 30-year up at 2.15% right now. Here with a closer look at the market action is Yahoo Finance's Jared Blickery. Jared, what a difference a day makes, and a lot of eyes looking for those Netflix results later on today.
That's right, Karina. And let's begin with that. I'm looking at expectations, and this is a key number here for Netflix. Streaming paid net changes for the fourth quarter. The street is expecting 8.3 million, and that breaks down by region. United States and Canada expecting a bump up of 650,000. East, Middle East, and Africa, 3.5 million. Latin America, 1.25 million. And Asia Pacific, nearly 3 million. And the gap estimates for the results is 80 cents for the quarter. Revenue estimate is 7.71 billion. And I got some analyst commentary here. And let me put up a 1-year, actually a 2-year chart here. We can see Netflix recently broke to record highs, only to fall back down to the bottom of its trend channel here. But here's what Evercore is expecting. They've recommended the stock with an outperform rating, price target of 710. That's $190 above the current price. They're saying stabilization of subscriber growth at or close to pre-COVID levels is a key catalyst for the stock. Company needs to add 25 million plus subscribers in 2022, expand its operating margin, accelerate average revenue per user globally. And we also know that the firm, that Netflix, just raised their prices around the US by $1 to $2. So focus is going to be on their expectations. So for the first quarter, the street believes streaming paid net change will come in at 6.3 million, and then they have a revenue estimate of 8.12 billion with a GAAP EPS estimate of $3.38. Again, that's for the first quarter, and then for the for the whole year, they're expecting free cash flow to be 990.1 million, and the operating margin they're estimating that at 22.7 million. But there's another stock in the Nasdaq 100 I want to get to here. It's Peloton. That stock is off 24%. Here is an intraday chart of what's happening today. Let's take a look at a max chart going back to the IPO. You can see from their IPO, they are now underwater by 4.8%. What is the news here? They are halting production on all of their bikes, treadmills, and other products that in their connected fitness line, and that's as demand has waned. So this comes from a CNBC report. They saw an investor presentation from January 10th that said demand for its connected fitness equipment has faced, quote, a significant reduction around the world due to shoppers' price sensitivity and amplified competitor activity. So you can see that stock really taking it on the chin there. But guess what else is not taking on the chin? We got Tesla up 3%. The mega caps are up. Apple is looking at gains of 1%. Microsoft up 1.5%. Facebook up 1%. So Karina, to your point, really mounting a comeback after the Nasdaq slipped into correction territory yesterday. And I'll just reiterate one more time. I'm writing an article for YahooFinance.com, going to be published in about an hour or so. The day after the Nasdaq slips into correction tends to be positive. 13 out of the last 14 times since 1997, it has been a buy. Tends to be what we're seeing here today, guys.
All right, always love those stats. Thanks for digging that up for us, Jared Blickery. Want to get back to Netflix. Lots of folks talking about the company today because it is on tap to post quarterly results after the closing bell. The stock is down about 14% year to date. Here to break down what we should expect from the streaming giant is Tuna Amobi, media and entertainment analyst at CFRA, who, by the way, maintains his buy rating on the stock. Good to see you again, Tuna. So what are you expecting from Netflix, and what are you going to be listening for on that earnings call?
Good afternoon. It's great to be with you again. No, I think this quarter, Q4, is going to set a tone for the expectations for the rest of this year. I think we know coming into the quarter that they were starting to rebound from the deceleration subscriber growth we saw in the first half of last year. So in kind of a way, this past year is a kind of a reset year, company is guiding to 8.5 million global net additions. That number has looked recently somewhat optimistic, but we still believe that there is a potential upside to that number. But more importantly, I think we're going to be watching to see what the Q1 guidance portends on the heels of the recent price increase in the US and Canada. Any indications of potential churn, which, by the way, we don't have that much because if history is any guide, I think they've been able to navigate those kinds of price increases fairly well. But more importantly for this year, arguably the most important affirmation that we're looking for is the change in the free cash flow profile. We have them swinging to major positive free cash flow acceleration. This year, they guided to break-even target for last year. So now I think we're in a situation where the content pipeline has never been more robust. They've rebounded quite strongly from the shutdown, the pandemic, and now they're kind of almost on a cruise control. So I think right now, despite the intensely competitive environment, I think the company really is well positioned to kind of build on this momentum, especially from the international markets like Asia Pacific, where we expect the bulk of the subscriber growth to come from.
Hey, Tuna, it's Karina. Thanks for coming on. Good to see you again. So how does Netflix, what do they need to do specifically to stay ahead of the competition? Because last year was a pretty bad year for the streaming sector overall. So how do they do that and then also keep investors happy?
Indeed. Last year was almost like kind of a reset year of sorts. You had several new entrants into the streaming landscape that shook up the market quite tremendously. And then you also had the potential reversal of the stay-at-home trends. As far as Netflix is concerned, I think they're pulling all the right, triggers, right? They have kept the pedal on the throttle in terms of the content spending. We have them spending north of $20 billion again in content this year versus $17 billion last year. So I think the question right now is who are going to be the streaming winners in the streaming wars. I think Netflix would have them as one of those. Because if you look at what they're doing, especially international market, where a lot of their peers are now starting to roll out, whereas Netflix has, pretty much they have the global footprint. And one of the major, catalysts that we think has been underlooked is the potential for some of the local language content that they've developed at relatively, minimal cost and to travel really well. So those kind of bodes well for monetization and continued growth in viewership hours. They talk about reporting viewership hours now for the shows, for the top shows, as opposed to the number of accounts. And I think that's going to give us more insight into how some of their top shows have been performing, where a lot of the international markets are actually accounting for more and more of the viewership gains that we see. And that's a recipe for continued growth.
Yeah, to that point, I know a lot of non-English shows are dominating Netflix's top 10 list right now. But I want to get back to that idea of history being a guide. I mean, with this latest price hike, Netflix has never had so much competition. It now has not only Disney Plus, Viacom, CBS's streaming service, Warner Media. Even though it has some of its big heavy hitters like Ozark and Bridgerton and Stranger Things coming back, does it still have the pricing power it used to? Or does it risk really losing some subscribers here?
I would argue that the pricing power, Alexis, has been as good as it has ever been. And that might sound counterintuitive. But when you look at the content pipeline today compared to where they were even 2 years ago pre-pandemic, I think it's really, night and day. So I think the consumer has demonstrated the propensity to keep coming back as long as you have more content to refresh. And I would say the elasticity of demand for Netflix offerings is nothing out of the ordinary. So when you take $1 or $2 price increase in a market like US and Canada, where arguably the market is relatively saturated, what they're trying to do is to make sure that in those saturated markets where there's not much low-hanging fruit left, that they're able to offset, some of the pressures that they're getting on their margins from content spending. And by the way, the way you can be comfortable about that is to look at the margin profile, which we have them this year adding another north of 300 basis points. So despite all of this huge content spending, I think the business model is able to absorb all of that in terms of the subscriber growth. So to your question, I think I think right now the price hikes, we don't have any reason to believe that it's going to generate any more churn than that would be somewhat of concern given the historical experience that I alluded to, and indications are that people are paying up for this. The more that you can keep consumers coming back for more, that's really the playbook that Netflix and others now are trying to follow.
Yeah, investors really didn't seem to mind when those price hikes came out. The stock actually went up, so I think they're ready to bear the extra cost. I personally can't wait for The Crown to come out. That's what drew me to Netflix in the first place. But they are investing heavily in Asian markets, setting up a base in Korea. So where should they look for that subscriber growth? Because India, obviously a huge market, and they are tapping into that with some of the programming as well. Korea and other parts of Asia. Where else?
I think Asia Pacific, obviously, I think is probably the market right now where they have the longest, runway for growth. But even you look at some of the markets in Latin America or Central and Eastern Europe, I would argue that some of those markets still have a very decent amount of low-hanging fruit that can still be plucked out. But remember, the economics of those markets are entirely different, and they vary quite significantly compared to North America. So what they're trying to do is kind of a balancing act here, and kind of use local language production as a jumping off point. They can have a hit, like a few hits like Squid Games, for example, that are developed in some of those markets. What it does is to create a lot of buzz and momentum that they can now export around the world. So, and that's why the international markets are so critical. When you talk about Netflix, investors seem to be focused a lot on the saturation in the domestic market, and maybe not remembering that the secular dynamics of broadband penetration in international markets are way more attractive than they are in the US and Canada at this point in time.
And of course, Netflix moved into mobile gaming last year. Curious to see what they're going to say about that, especially in the wake of Microsoft's buyout this week of Activision. Tuna Amobi at CFR, always good to see you. Thanks so much. And a reminder that you can step up your investment strategy starting today with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. Check it out at yahoofinance.com/plus. Why are rental prices so high, and what does it mean for the housing market? We talk about it with the CEO of RentPath next. For the first time during the pandemic, rents are rising faster than home prices as would-be buyers get priced out of the market. Here with his outlook is John Ziegler, CEO of RentPath. John, welcome to the show. You know, 2 years ago, rent prices were at bargain basement prices. What has changed since then? And do you think that rent prices have peaked?
Well, thanks for having me. And you're right. Rent prices have continued to go up throughout the pandemic, and we're continuing to see that occur. Right now, vacancies are at an all-time low across rental properties across the U.S., and rental prices for 1-bedroom and 2-bedroom homes have gone up on average across the U.S. between 16 and 21%. There's two things going on. One is you've got a lot of folks that are maybe being pushed out of the housing market as housing prices have been increased. You also have a lot more demand for rental properties, and the supply of rental properties has not been where it has been. Now, there's a lot more coming online in the next year or so, but I think that we're probably going to stabilize here for a while, and we'll continue to see this.
John, renters are paying so much more. What are they prioritizing at this point? Is it lower pricing? Is it location? What are they looking for?
I think it depends on a lot of things, and some you can sort of see in the data, some would be anecdotal. Potentially one of the reasons for the increased demand of rental properties as a result of the pandemic is, perhaps you used to be in a 3-bedroom with 2 roommates, and now you really want to have your own place because you're at home all the time and you want more privacy. I think that a lot of it demand is around location. So you do see markets where rental prices are up 40-50%, and a few markets where they're flat or down a little bit. A lot on the coast, coastal towns have seen a lot of rise. So I think a lot of it has to do with location, as well as amenities, as people start to be able to work more freely, work from where they want to be. So they're moving based upon that versus maybe where the job is.
John, the national eviction ban has lapsed, and now a lot of states are letting their eviction moratoriums expire. It happened recently in New York State, for example. What effect do you expect that to have on the rental market?
We have not seen a huge, there's not probably been the huge flood of evictions that folks saw. That folks we were saying were going to come. I believe from the studies that we've seen, you've seen an increase in non-pay, as they would say. So that would be more of a pre-eviction action. But I think it really remains to be seen. We do have a very strong job market. You have a lot more jobs available than you have folks to fill them. Rates, pay rates have gone up significantly. So, one would hope that you're not going to see a significant increase in evictions because people are actually financially able to be, to continue to pay their rent, at least not above historical norms. We've been in a little bit of the last 24, 22 months have been, a different situation because you have had these moratoriums.
And John, as you see more people sort of migrating and sort of, they have the flexibility to move around for their jobs, are you seeing a rise in short-term rentals because people are just don't want to be tied in and they want that flexibility to get in and out quickly if they need to?
What we're seeing is a lot more property management companies enable more flexibility. So enable folks to be able to get out with less penalty, if they want to. I do think, and I failed to mention it, I think that want for flexibility is probably another reason for the increase in demand for rental properties. Because if I think I want to live in Denver for half the year and then I'm going to move to Miami or whatever, I'm not going to buy a home, right? I'm going to want to rent. I'm going to want the flexibility to move as I want to move around the country. And I think that also drives some of this demand. But I think what you will see is more flexibility in that, because that will become a sort of a key selling point for renters is, how long am I stuck? Can I move? And we've seen in a few cases where the property management companies have been able to charge a little bit more on the rent because they're giving more flexibility on the ability to get out early.
And I know that RentPath, John, was recently acquired by Redfin. Just curious what kind of growth your company has personally seen during this time and plans, maybe expansion plans here in the new year.
Sure. So, RentPath is actually started with Apartment Guide, if you remember that back in the day, but really created the category around being able to aggregate all the rental properties for one place for consumers to be able to find it. And our focus is really on two things, which is on helping people find a place called home, be that a single family home, an apartment, a condo, doesn't really matter to us, and do it simply and easily. And on the other side, to really help property managers and landlords fill vacancies efficiently and easily and lower friction and be more profitable. We've seen a lot of growth in demand in the last few months. Interestingly, you've had a situation where vacancies are so low that landlords have been less worried about filling vacancies. So the demand for certain things that we do has not been as high. I think we see that coming back right now. But you have much greater turnover of folks as they move around. And so that need is still there. Our goal really as we move forward is to continue to build out the suite of marketing and engagement services that we provide for property managers that make it easier for them to attract, engage, sign, and then manage those tenants in those properties.
All right, John Ziegler, CEO of RentPath, thanks for your insights today. And coming up next, the chairman of Union Pacific weighs in on the wild, wild west and how all of that looting of freight trains in Los Angeles continues.
Welcome back to Yahoo Finance. Well, it is a wild sight in Southern California, packages strewn all over rail tracks. Now we hear firsthand from the CEO of Union Pacific on the scene that looks like it's out of a movie. Also joining us is Yahoo Finance's Danny Romero. Danny, what did you have to say about it all?
Yeah, Karina, this issue has gotten just worse and worse over the last 3 months since the holiday shipping. And the debris field, like I've described it before, goes for miles and miles and miles. And easily we're talking tens of thousands of destroyed boxes with addresses from Seattle to Pennsylvania. But today we're hearing from the CEO who's speaking out on the issue. Take a listen.
We've amped up our use of technology like drones to be a deterrent and to help collect evidence. We've amped up the number of our own special agents, our police force that are present in those areas. We're partnering with LAPD. They've amped up their presence with us. We're encouraging the district attorney locally to prosecute more of these cases. The criminals there have turned from 2-3 years ago, a theft event every now and then. It was one-off, wasn't well orchestrated. It was an opportunity crime. Now it's an orchestrated, organized crime that happens. We've largely cleaned up the areas from the video that you've seen and that you've shown. We've got good cooperation with the governor's office. They're going to be on the ground there with us today, this afternoon. So I think we've got our arms around it, but there's a lot of work that has to be done here. We need more prosecutions. And oh, by the way, we're also going to be making capital investment in physical barriers, in more physical security, whether it's metal security fence, razor wire, or concrete barriers. It's sad to say that we're going to have to do those kinds of investments, but we've got to keep our employees safe and our customers' lading safe.
You mentioned the cooperation from the LAPD as well as the governor's office. Are you getting the same cooperation from the district attorney? I mean, it sounded like when this story initially broke, there seemed to be a bit of tension between, or more frustration maybe, with the way that you saw the county handling these cases.
Yeah, our frustration is about making sure that prosecution occurs. There was a fair amount of criminals that we apprehended and booked with LAPD, only to see them back out, 24 hours later. And then they would brag to our police officers about how, a misdemeanor's nothing and they're just not worried about it. We need the theft to be prosecuted like what it is. It's organized, it's grand theft, and we need a strong deterrence to stop that behavior.
And you can hear it right there from that interview that Union Pacific is working hard to keep their cargo safe by increasing patrols, also flying surveillance by drones, and working closely with law enforcement. But this really goes back to the issue that California has a no bail cash policy, which is causing the frequency of thefts. Alexis, Karina?
What about the idea of rerouting, these packages altogether from outside of Los Angeles County, finding another place? Is that even a possibility?
Yeah, Union Pacific CEO and chairman says that he really doesn't want to go that route. He described it as a nuclear option and that they're really hesitant to really pull that trigger, but they are looking at investing in physical barriers, like he said in the interview, like metal fencing or wiring fencing. And so, but also remember that LA has been a hub and recently about, regarding supply chain bottlenecks. The Twin Ports handle about 40% of the nation's imports, with the majority of nearly $450 billion worth of goods eventually moved by rail. So it wouldn't be an easy move if they do decide to go that route. But again, today, before I went on air, Union Pacific confirmed that they do have a cleaning crew out there right now and that they clean periodically. And the last time they had cleaned that whole area that we're seeing video from was in December. Alexis?
Okay, I'll take it from here, Danny. Thank you so much for that report. We will leave it there. It doesn't look like it's going to end anytime soon. All right, we're going to take a quick break, but on the other side of it, the rise in popularity of NFTs is creating a crypto turf war between artists and the brands they seek to monetize. Ahead, we look at the legal fallout of jumping into the metaverse. Welcome back to Yahoo Finance. Well, there is a growing scramble to claim a stake in the metaverse and monetize it, but there's also growing scrutiny surrounding intellectual property rights and trademarks tied to the NFT boom that's ensnaring artists and major brands. Here to help explain some of the legal questions being raised is Cal Raustiala, UCLA law professor. Cal, thanks so much for joining us. So it seems like the lines are blurring between what a company says constitutes its intellectual property rights and what artists are claiming as fair use. And one example making headlines is a turf war that's brewing between luxury brand Hermes, famous for its iconic, very expensive luxury Birkin bags, and the artist behind the Meta Birkin, Mason Rothschild. And we actually had him on our show recently, so I want you to take a listen to what he had to say about his entry into this, virtual foray, if you will, and then get your reaction on the other side.
For me, there's nothing more iconic than the Hermes Birkin bag. And I wanted to kind of see as an experiment to see if I could create that same kind of illusion that it has in real life as a digital commodity. And I feel like I've kind of accomplished that with the statistics that we kind of have today, is being able to put together this kind of digital commodity that everybody loves, bringing it into the digital world with this introduction of the metaverse.
So Cal, just want to give you some context on all of this. His creations fetched up to $45,000 a piece, and his entire collection works out to about $1.2 million, according to Marketplace Wearables. So now Hermes says he's infringing on its trademark and IP rights. He says he's selling them as though they were art prints. So who's right, and how do you navigate trademarks and art in the metaverse?
Sure. So first of all, in some ways, what's going on here is very old. So if you think back to Andy Warhol and the Campbell soup cans, That was an example of using a brand in art. And in fact, at that time, Campbell's was very happy that he did that. They wrote him a letter praising it. Of course, today things are different. And in this particular case, obviously Hermes is not happy, and it's not surprising. A lot of brands try to police their trademarks, pretty vociferously. But the bottom line is art is art. And so at one level, what he's doing is no different than what Warhol did, and fair use probably does cover it.
So I'm wondering then, Professor, if you could break down sort of what you intrinsically own when you buy an NFT. We see them going for crazy amounts of money. My question would be, if I have this NFT, do I own the rights to then go and resell it? Or do I still need to get the licensing rights from whoever initially has the IP?
Sure, that's an excellent question, and an area where I think a lot of people have been confused in this case and in other cases. So first of all, the NFT itself, it's a non-fungible token. You can buy and sell that, and people have resold them. And of course, the notion is that you will be able to resell them in the future. That's why they're valuable. On the other hand, NFTs often are pointing to, as in this case, some underlying artwork. Just like when you buy a painting, you don't then own the underlying copyright in that painting. You can't then put that on a t-shirt, for example, if you buy a Picasso, or a better example would be a contemporary artist still under copyright. So the NFT is distinct from the underlying artwork that it typically points to. And no, you can't then go and monetize that artwork, but you can buy and sell the NFT all you like.
Another NFT issue that's getting a lot of buzz right now is between Miramax and director Quentin Tarantino over the cult classic Pulp Fiction. What's the story there, and how do you think the impact resonates on NFTs in Hollywood?
Sure. So we were just talking about art, which is really one of the areas that's blown up in the last year with NFTs. They go back a few years, but basically most people, I think, have heard of them in the last year because of the astronomical prices paid for certain art NFTs. But now that wave is hitting Hollywood, and the Miramax Tarantino lawsuit is the first out of the gate. That lawsuit, so first of all, Tarantino today is closing the auction on the very first NFT that he's selling from Pulp Fiction. So that auction opened, I believe, on Monday. It's going to close in about 2 hours. So just to say, Miramax did not successfully stop it. They may succeed in the future, but at least he's begun. The deeper issue is really who gets to monetize older films, or in this case, aspects of the film, specifically aspects of the screenplay. And at bottom, like a lot of things with NFTs, they can seem confusing. This is really a case about a contract between Miramax and Tarantino written in the 1990s, so well before anyone thought of this. And so the basic issue is he allowed to mint an NFT around the script or not? There's really nothing more to it than that. I can talk more about what's in the contract, but that's the basic gist of it. But this is not the last we're going to hear of it in Hollywood.
It's nothing new to see innovation a few steps ahead of the law, right? We saw it with the internet. We're seeing it with crypto. What kinds of rules do you expect we'll see in the future regarding NFTs?
Yeah, that's a really excellent question. I think with a lot of things, as you mentioned, the innovation takes place and then the regulation comes after, or the rules come after. So with NFTs, there are really no court cases right now to look to. There's one or two that are maybe kind of next to the question, but not exactly on point. So to take the Tarantino case, if that one were to, go to a judgment, that would be a big deal, and that would begin to lay down some markers on what's possible. On the other hand, there's so much money in NFTs that I think a lot of the parties that might have a dispute may in fact be more interested in seeing, can we simply move on to minting more NFTs? So rather than fighting over the division of the pie, let's bake more pies while the oven's hot. And in this particular case, Tarantino has gotten incredible coverage, in part because of the lawsuit. In fact, you have to wonder, did he collude with Miramax? They're both amping up the market for this in a way that's really kind of fascinating. But the rules are going to eventually unfold, just like with crypto. We're going to see noises about regulation. We'll see court cases, and eventually we'll have more clarity. But until then, it's like a gold rush. And in your previous segment, you talked about the Wild West, about the railroads. This is like the gold rush, and just like in the original gold rush, property rights are really unclear. And so we're going to need to hammer those out pretty fast.
Yeah, it is definitely like the Wild West of the metaverse, and definitely more regulation to come. Very interesting to see what happens if any of those cases actually make it to court and see what the fallout is from there. We'll have to leave it there. Cal Raustiala, thank you so much, UCLA law professor, for your time today. We're going to take a quick break, but then on the other side of it, we speak to an NFL player making news off the field in an effort to support struggling restaurants and their recovery efforts. Stay with us.
When he's not crushing the competition as a defensive tackle with the Super Bowl champion Tampa Bay Buccaneers, Ndamukong Suh is busy scoring with his portfolio of investments. We are delighted to have this NFL star and five-time Pro Bowler with us today. Ndamukong, thanks so much for being here. Look, we'll get to football in a moment, but I know you have been for a long time an investor in the restaurant and hospitality industry, and you recently tweeted out some information that's getting a lot of attention. You said it's never been this bad for the restaurant industry. Tell us what you're seeing with regards to the restaurants you're involved in and what needs to be done right now to help the industry.
Yeah, it's been very, very difficult. And unfortunately, we've been in this pandemic for close to almost 2 years now and counting. And I think as we understand the restaurant business is a livelihood of a lot of many people, whether it's people working in the service industry or actually the cooks or the farmers. And it's important for us to understand that we got to continue to support our community. And I've been fortunate enough to be in the hospitality space since I first got out of college. Blue Sushi was a great restaurant I went to when I was a kid in college, and I wanted to be a part of it. So I asked the owners, and we've been able to create some great restaurants in and around Lincoln University of Nebraska.
Mr. Thanks so much for joining us. This is Karina Mitchell. So happy to have you on. Wondering, what do you say to consumers who really want to help restaurants, but they are so afraid of this Omicron variant that perhaps they're not going out so much? And then because you are so involved in the industry, what are you hearing from restaurants as far as consumer behavior? Are they tipping well? Are they behaving well in the restaurants when it comes to mandates and vaccines?
Yeah, I think it depends on the part of the country that you're in. I'm in Florida and obviously have restaurants in Portland, Oregon as well. And really, it comes down to people being courteous and understanding everybody's particular wishes when it comes to the COVID regulations and mandates. But I think the biggest thing people can do is first start in their community and go out there and support the restaurants they've loved and they've enjoyed, and not be afraid to try new restaurants and really take it to go if you don't want to dine in or there's not an option to dine in. And I think that's important for folks to do because there's a trickle down effect. As I mentioned before, there's the farmers, there's wineries, there's distilleries, and really being from Portland, Oregon, that is one big place that we strive to be very elite in the agricultural world, and so it has a big effect.
I want to talk about your overall investment portfolio because it's quite wide ranging. What else are you investing in right now? I know there's some real estate in there. Are you playing with NFTs and crypto to any extent?
Yeah, so real estate has always been something I've learned and really from my parents, cutting lawns as a little kid to help be a part of that overall success of having apartments, and then really having that additional generational income to be able to help me support to go play sports and travel. I have dibbled and dabbled a little bit in the NFT and crypto space. Most notably, Metaplex was a recent investment that I just did along the Solana blockchain. And it's been exciting to be a part of these things and really learn. And that's where I want to do as a young man, know my career is probably coming to an end, me being 35. They consider me a very old man in this game, but I have great aspirations to be more successful off the field than I was on this field.
And one of your aspirational people that you speak to is Warren Buffett. I know he's given you advice in the past and suggests, maybe taking advantage and buying the dip. So, we saw the Nasdaq in correction territory yesterday. I wonder if there may be some buying opportunities and things that you are interested in looking at.
Yeah, there's some opportunities, and you definitely want to do buy in the dip and find things that have great intrinsic value, as I've learned from him. But also at the same time, just being able to know you have strong companies you've invested in, and it's all about being patient. That's one of the best tools I've ever learned from him. It's about being patient, understanding that this company you believe in has strong roots. It's going to have to weather the storm, but most likely, if it's a very strong company, it'll come out better on the other side. Excuse me.
So Warren Buffett is a mentor of yours, but you've become a mentor for many young athletes coming up. We've seen this story before. They come into a lot of money early on and wind up losing it. What's a good way for them to build generational wealth, especially since, a career in something like the NFL doesn't last very long?
Yeah, the career in the NFL is on average 3.5 years, and I've always understood that. And so that's one of the reasons why I got my engineering degree and then focused in real estate, and also had the opportunity to have a father that was an engineer as well as a mother that was a school teacher that always instilled that education is one of the most important things that nobody can ever take from you. So with that being said, I'd always want to find mentors and people that I've been able to understand how they've created success and follow in their footsteps, and then create my own focus on how I wanted my life to look at when I decided to retire. So it was exciting for me to be able to have those opportunities, and the NFL opened up a lot of them even much more. And so for me, advice for young players and young people in general is just go out there, don't be afraid to ask questions, be hungry, and focus on things that you care about, and make the most of it.
And Ndamukong, I want to turn things over to what you're doing on the field. You were with the Buccaneers last year. I'm wondering how different is it this year playing? Obviously, you have Tom Brady on the team as well. Wondering what that dynamic is like. And what would a second Super Bowl ring mean to you personally?
Well, I mean, we were the underdogs last year, and we came in 5th seed, and really people didn't really care for us to think that we had an opportunity to win a championship, and we proved them wrong. And so the roles have really reversed. Now we're in the Kansas City spot where they were last year, being the previous Super Bowl champ, and people are targeting us. And we have a big opponent against the Rams this weekend at home that we need to make sure we take care of business to get our goals to being back in Super Bowl and actually heading to LA to play in the Super Bowl. So that's exciting. I think we have a great team. We've dealt with the injury bug. Guys are starting to come back. I'm excited to where our defense is trending in the right direction. And really, to answer your other question of winning a Super Bowl, I've got twin boys. So I need another ring for my other son so they don't have to share.
I love it. That's great. And also when you say your career may be ending soon, folks are talking to you about a future, you being a future Hall of Famer. When you think about your legacy and what you want to leave your boys, both on and off the field, what is that?
I think the most important thing is when it comes to being on the field, it's about dedication, hard work, and being a champion. I think that's one of the things that I've been able to be very, very steady and very lucky to be successful on the field. But when it comes to being off the field, it's just about being strong young Black men that have changed and being a thought leaders and being able to be an example for other people and help them grow. And that's something that I aspire to help them be as very strong men that understand that they can make a lot of different change, and they don't have to do it via sports. They can do it in any particular way they choose to, as long as they're passionate about it.
And obviously, you have this big game coming up on Saturday. I know nothing about football, so I have no dog in the game. So I have no problem wishing you all the luck and hope you guys take it all the way to the end again. But I am wondering, what challenges has the team had to face dealing with Omicron, and how well do you think the league has handled making sure the players are safe and then bringing back fans into the seats this year?
Yeah, it's been a huge challenge, and it started all last year where we were tested each and every single day. The rules and the regulations have changed and been fluid throughout this particular season, and something each and every individual needs to take into consideration of how they want to particularly move forward. And then really for our own team that I can really speak for, we've done a great job. I think we've had some cases where we've been in potentially issues going into games, but I think overall guys have been cautious in respecting people's wishes and how they want to do it, masking up and doing the different things that they feel is necessary for them to be safe and be ready for the games, but also respecting everybody in the locker room.
Real quick, that big game's just in 3 days. In addition to being on Yahoo Finance, how do you prepare for a big game like that with just, hours to go?
To be honest with you, it's being able to compartmentalize, and I love to get away and being able to do these fun things and be able to have you guys have me on Yahoo Finance and have great conversations, because it keeps me sharp. It allows me to dive into football, but dive into things that I care about in the world, whether it's restaurants or real estate, and being very sharp. And I think that's something people don't really know, that athletes like to get away at times from sports, to not be just fully dived into them, even though we're very focused and ready for the game time. And I'll be for sure ready at 3:00. This is my former team in LA. I actually lost the Super Bowl with them a couple of years ago. So we'll go from there.
All right. And Ndamukong Suh, we know you're going to have your game face on come Sunday. Best of luck to you and to the Buccaneers. Thanks for being with us. And we're going to get another check of the markets for you right after this short break.
Welcome back to Yahoo Finance. We'll want to get you a quick check of what's going on with Peloton, just making news about an hour ago. CNBC reporting that the company is temporarily halting production of its connected fitness products as consumer demand wanes and the company looks to control costs. So we can see that the stock is down now quite severely, down 17%, and we'll continue to track that for you. But the company said in a confidential presentation earlier in January that demand for those fitness equipment has faced a significant reduction around the world. That added to a slew of problems that they're dealing with, recalls as well. All right, we'll leave it there, but we have much more on the other side of the break. More market news ahead, plus why some states are reaching pre-pandemic job levels before others. Stay with us.
The job market is on fire in some states like Texas and Arizona, where the unemployment rate is back to pre-pandemic levels. What are they doing right, and when will other states follow? Is President Biden's plan for free COVID tests and masks too little, too late to stop Omicron? The head of one of New York's largest hospital groups weighs in. And should Microsoft's big buyout of Activision have other gaming companies shaking in their boots? We look at what Microsoft's big bet on the metaverse means for Sony's PlayStation and other heavy hitters in the gaming landscape. Hello, everyone, and welcome back to Yahoo Finance Live. I'm Alexis Christoforous, along with Karina Mitchell, taking a look at the market right now. Stocks staging a rebound one day after the Nasdaq slid into correction territory. Want to toss it over to Jared Blickery now for a closer look at the action, especially for those big cap tech stocks. Jared.
That's right. After that nasty slide into the close yesterday, we do have the makings of a bounce. And I want to get to the Wi-Fi Interactive, where we have the Nasdaq 100 Front and center are those mega caps to the left of the screen. Amazon, that's a standout. That's down about 1/3%. Tesla stand out to the upside. That is up 3%. But let me just show you what has happened this year so far. The 13 trading days, we have seen a lot of these big stocks take it on the chin. Nvidia down 14%, and we have Amazon down 6.5%, Microsoft down 8%. Apple down 6%. So it is nice to see this comeback here, but it is just the beginning of a comeback. And here's my leader and sentiment markets indicators, and we have a lot of green here. And let me just start from the top left. That's KWEB, that covers China. Those are bouncing pretty heavily here. I think that's the best day they've had this year. Then we have ARC, that's up 3.5%. Those components are flying high. Then we have a solar ETF, that's TAN, that's up 3%. Also getting some love, we got IPO, software, gambling, and emerging markets. I want to hone in on the clean energy market here. Biden made some favorable comments yesterday afternoon about more stimulus, perhaps breaking out some of that Build Back Better money for clean air. And we were saying a lot of these names charge higher. Also want to delve into the Chinese stocks, in particular, looking at JD.com. That stock up 10%. You can see over the trailing year, pretty far down. That's down 16%. Not as bad as some of the other names. Finally, want to check out the ARC components. Those are jumping nicely as well, guys.
And Jared, big news in the auto sector earlier today. Mercedes announcing it's in a deal with Luminar for LiDAR automated driving technology.
That's right. So EV also generating some, or benefiting from some hot money flows, and laser, that would be Luminar, is among the recipients. Now, this stock is up 17% today. Doesn't look like that much when you put it on a one-year chart like we're seeing here. It's still down 51%. But some of the details here, so they have formed a pact with Mercedes. They're going to institute their LiDAR sensors into Mercedes passenger cars, and it's going to be integrated into production of the vehicle platform. So good news for Luminar. A lot of these stocks have peaked relatively, I think most of them peaked early last year. There was a huge run up into January, February. And if we put a one-year view, we can see the carnage that has beset this sector, guys.
And want to get to our Yahoo Finance investment idea of the day. Jared, I know it's a bullish call on Bank of America. They're reporting a strong net interest income outlook when they release their earnings this week.
That's right, 8%. That is a huge number for earnings. And let's take a look at what Argus Research is writing about Bank of America today. I'll put a one-year chart on so we can see the most recent price action. It's a pretty strong uptrend, by the way, up 44% over that trailing year. And here's what Argus is saying. They are raising their price target to $55 after the strong fourth quarter results that were delivered, I believe it was yesterday only. On January 19th, the company reported fourth quarter earnings of 82 cents per share. Net revenues were up 10% as growth in net interest income was augmented by strong investment banking and also investment brokerage revenues. The results benefited from a $489 million loan loss provision reversal, the fourth consecutive quarter of reversals. That's the banks releasing some of that money that they had saved early on or built up early on in reserves because of pandemic. So this is in recognition of overly conservative loss provisions at the height of the pandemic. Net interest margin should begin to improve in 2022 as the Federal Reserve begins a rate hike campaign, and we're encouraged by management's forecast for flat expenses for the full year. Not going to finish up all the other numbers here, but just want to point out this is a stock that has had some historical volatility. And you take a look at the max chart going back to the 1980s. This was a peak just before the global financial crisis, and we're almost right back there. What a journey, guys.
What a journey for sure. All right, Jared Blickery, thanks so much. Let's stick with the markets and bring in Michelle Connell, CFA and owner of Portia Capital Management. Michelle, good to see you here. So today, look, we're seeing a bit of a bounce back in tech, although the Nasdaq still in correction territory. Is this a head fake, do you think, or is there more downside for the tech and growth sector?
I don't think it's a head fake for some names. I think it's a case of we finally realize that valuations do matter, and it's not just a case of growth versus value, but a lot of these names were priced to perfection, as we keep hearing. And so people are looking at those particular names that may have some downside, and they're taking money off the table at the beginning of the year. They're being prudent. But at the same time, there are some technology names that do look interesting here, that do have positive cash flow. that do have, strong moats in terms of their competitiveness. So I think it's an opportunity for some names.
Michelle, if you are looking outside of growth, what is your opinion on getting into defensive and value names? Is it too late? Has that bull already left?
That also is an area where you need to be selective. So we've had some of the financial names that after they've reported in the last, since the beginning of the year, they've been hurt. You have the JP Morgans, the Goldman Sachs that have pulled back. Some of those names look interesting here. You're looking at potential upside anywhere from 10 to 20%. Other value names, we have an uncertainty in front of us. Currently, we only have about 6% of the companies on the S&P that have reported. So we've got a lot of unknown ground to cover in terms of expectations. So I think you need to be careful and know your company. And at the same time, there will be opportunities. There are some now, and I think we're going to have even more in front of us.
Let's talk about where you're seeing some of those opportunities, Michelle. I mean, I'm thinking financials in an environment where interest rates are going to be moving higher, energy, which we continue to see, have a strong start to this year, adding to last year's gains. Where are you seeing those opportunities? Because some might argue that energy is already a little too frothy to get into at this level.
I might agree at that level. A lot of the energy names have done extraordinarily well, especially this year. A lot of them are up 10, 15% since the beginning of the year. So there are a few that, have some upside, I'd say, but the number is pretty limited. So I'd look at financials. I'd look at maybe some staples. And again, technology doesn't have to be considered just GARP. It can be growth at a reasonable price, meaning that it's a blend of growth and value. And so there's some good, strong technology names like NVIDIA and Intel and Microsoft. And this isn't a GARP name, but Shopify, that's definitely a growthy, frothy name. It looks interesting here given the amount of pullback that you've had. So I think, again, it's just a matter of valuations. We're becoming a little bit more prudent now that we realize that maybe money isn't as free as it was due to the Fed.
And Michelle, talking about that, let's move over to the bond market and wondering what you make of what you see with the yields climbing. They were flat for the longest time, stuck below 1.5, touched 1.9 on the 10, now retreating a little bit. How diligent do investors have to be in that space? And then I also want to ask you, your opinion of the Fed. Is it jawboning? How many rate hikes do you see coming this year?
Looking at the bond side of a portfolio right now, I talked to a client yesterday who has a friend who's a prospective client. And this is somebody who thought that they were safe at retiring at a 60% equities, 40% bonds. And now they're getting concerned because they see what bonds did last year. Overall, they were negative. And we're seeing expectations for this year being about the same. So whether it's an individual or it's an institution, there's a lot of concern, maybe even more so on the bond side of a portfolio versus equities. So there's risk there, especially interest rate risk. So people need to understand what's underneath their bond portfolio, look at the duration, the maturities, and try to have as much floating rate bonds as possible, to protect yourself from that interest rate risk. In terms of the Fed jawboning, who knows at this point, right? Because we listened to a lot of jawboning up until they decided that they needed to be a little bit more prudent and tighten. So I think, anywhere from 3 to 5 rate hikes is very possible. I hope it doesn't go beyond that. But when you look at the potential discount rate that you're looking at, even with those 3 to 5 rate hikes, it's still not enough to make stocks not look attractive here.
Michelle, I just want to get back to earnings real quick. After the bell, Netflix kicking off those big tech earnings, wondering what you're expecting perhaps from Netflix, but also just the larger media landscape, where you're seeing some opportunity for investors right now.
Well, they're all competing on content, right? And so they're taking on a lot of money, a lot of debt to get that content. That's basically what Microsoft was doing yesterday with the acquisition of Activision. Content is king, but also at the end of the day, it's also going to be how much did that company pay for that content? Ultimately, will they be positive cash flows? And who's going to be number one in the sandbox? And obviously, Netflix has done extraordinarily well, and Microsoft will too, with the acquisition of Activision. So know what you own, who's going to do the best in terms of scrambling to buy all that content, spending millions and millions of dollars. Is it ultimately going to lead to profits? Because at the end of the day, that's what you're buying with the stock. You're buying positive profits in that stream of those.
Yep, content certainly king. Michelle Connell, CFA and owner of Porsche Capital Management. Thank you. Coming up, we're going to talk all things COVID with the head of one of the largest hospital groups in New York.
Welcome back. The Biden administration's free mask site is now up and running, but the World Health Organization says the pandemic is, quote, nowhere near over. So are leaders doing enough to keep COVID under control? Let's bring in our next guest, Dr. Stephen Corwin from New York Presbyterian Hospital, to help answer that question. Doctor, thanks so much for joining us. So even though cases are trending lower in certain parts of the country, the death toll is rising up to about 2,000 cases a day. So from your perspective, doctor, on the ground, do you believe that hospitals are getting enough support from the government on the federal and state level? What more can they do to offer support?
Well, I think that we're getting enough support. Thankfully, the supply chain has been better. Certainly in New York, it's been better. So we're thankful for that. That certainly was a huge issue for us in both prior surges. But look, this is a very infectious agent. And even though the number of patients on ventilators, patients in ICUs is trending less than with the Delta variant, you have more people infected, and therefore, unfortunately, more people are going to die. And this is more across the entire country at this point in time, instead of waves in various parts of the country. We've peaked in New York. And we're starting to come down, which is good. We expect that we'll get dramatic reductions over the next month. The government has done a lot now in terms of rapid testing. I think they were slow on that one. That would help. The giving out of masks will also help. Despite the mask controversy, masks work. So I think there are things like that. And in areas where you can't get enough personnel, I think states have been very good about getting the National Guard out. Fortunately, we've not needed that in New York Presbyterian, but there have been some sites in New York that have needed that. And the Governor Hochul has done a good job with that. So look, we're still not out of it. It's the third wave, and hopefully by the spring, it'll be better.
Well, you're in an enviable position, Dr. Corwin, of not experiencing these big labor shortages that we see lots of hospitals across the country dealing with right now, as their own staff is now out sick with COVID. What kind of labor issues, if any, have you been experiencing during this Omicron wave?
Alexis, a great question. We have experienced staffing shortages. We've had to rely on traveling nurses, outside agency nurses, and we've been hiring at a record pace. Despite that, there are shortages across the board in healthcare: radiology technicians, laboratory technicians, nursing staff, physician staff, et cetera. And to your point, I think you have a combination of the Great Resignation. A lot of people left healthcare after the first wave or two, as well as the issue of people getting sick and having to be out before coming back. And we've been conservative about bringing people back. I want people to feel that they're healthy. I want to make sure that they are testing negative and that they're well out from their symptoms. So that's hurt us a little bit, but I didn't want to bring back employees too early, both for their own health and to make sure that they weren't affecting patients.
To that end, doctor, you were making sure that you didn't bring them back too early. I'm wondering, keeping schools open, particularly during this Omicron wave, has been a really hot button topic. I'm wondering where you stand on that, because now certain areas are having to bring in National Guard to help teach in school, and state workers are being, allowed to sort of teach in schools as well. Should we have waited a little bit for the worst of the Omicron wave to have passed before bringing children back for in-person learning?
There are two sides to that coin. I think that our children suffered tremendously by the absence of in-person learning. Plus, you have the issues of childcare. You have people not being able to get to work or take off from work to take care of their children. So despite the puts and calls, on balance, I think in-person learning is really important for our children. That means that masking is really important. That means that for children over the age of 5, that vaccinations are really important. Fortunately, children do not appear to get significantly ill with this, but they can infect each other. They can infect their parents. So it's not an easy call, but I think keeping the schools open this go round is really important.
All right, Dr. Stephen Corwin, thank you so much for all the work you and your team are doing. New York Presbyterian Hospital CEO, thanks so much for your time. We're going to take a quick break, but we'll be right back. Stay with us.
We've got some breaking news to share for you now regarding the Federal Reserve out with its long-awaited white paper just moments ago, laying out the pros and cons of a central bank digital currency. For more, let's go to Yahoo Finance's Jennifer Schoenberger. So, Jen, I'm wondering if Bitcoin has to worry about some new competition anytime soon from the Fed.
Hey there, Alexis. Yeah, that's right. The Federal Reserve out with its long-awaited paper detailing the pros and cons for a central bank digital currency. The Federal Reserve does not come to a conclusion on the digital dollar, but has a long list of benefits and risks. Among the pros for adopting a central bank digital currency, it would support faster and cheaper payments, including cross-border payments. It would expand consumer access to the financial system, particularly for lower-income Americans, and would preserve the status of the U.S. dollar as a global bank reserve currency. Now, on the risks side, banks rely a lot on deposits, and adopting a central bank digital currency would actually lower the amount of deposits at banks, and that could in turn increase the costs for banks, which could increase credit costs for households and businesses. A CBDC could also create runs for financial firms and make them more likely or more severe. And in the long term, the Fed could have to increase the size of its balance sheet to accommodate a central bank digital currency, just as it increases the size of physical currency. Now, if adopted, a central bank digital currency would, of course, need to protect consumer privacy while also guarding against money laundering and any other criminal activity. And it would need to be a seamless transfer between parties. The Fed views this as less risky than other cryptocurrencies, private cryptocurrencies, I should say, and stable coins, though, of course, Federal Reserve Chairman Jay Powell has said that the private sector stablecoins could exist with a central bank digital currency. The Fed is not committed to how it's actually going to execute this, whether it would use blockchain or it would have a ledger. Currently, paper money, the fiat currency, does not have a ledger. Also unclear about where those accounts would be housed. The central bank does not house individual accounts right now. That's done by banks, so likely would include banks or intermediaries. At this point, the next step is for the Fed to put this out for comment. They will do so for about 120 days and gather everyone's responses. And if they do decide to move forward with a central bank digital currency, they would need authorization from Congress. Alexis?
All right, thanks a lot for pulling that together, Jen Schoenberger. Well, Boston Consulting Group's global chair, Rich Lesser, spoke with Yahoo Finance earlier today to discuss efforts from corporations towards climate change, as well as the hurdles and uncertainties CEOs of companies have to navigate resulting from COVID-19.
So I think right now, to be a CEO, you have to be thinking about 3 time horizons. One time horizon is the immediate, the next couple quarters, and you pegged the biggest issue well, which is, the people challenges right now. We know attrition levels remain high. People are changing jobs. Many companies are looking to hire and looking to hire ambitiously because their business outlooks are not all, but mostly pretty strong. And so navigating that is really tricky. And frankly, how to navigate the uncertainties that Omicron presents. I was talking to a retailer yesterday who's had massive numbers of people out of work, and it's starting to come down now a bit. They're more Northeast based, but many people are facing challenges. And the other thing I'd say is very much near term are still supply chain challenges. We know China's still facing enormous pressures on its supply chains as it's navigating through the pandemic. We have all sorts of disruptions that have gotten somewhat better, but are still remain very challenging. Those are the short term. The medium term, I think, centers around the future of work and digitization. The long term is often around climate and sustainability. So they're juggling across 3 timeframes right now, which is quite interesting.
Yeah, Rich, I'm going to get to the long term in just a bit. So specifically on the staff shortages, though, to what extent has that dictated a company's policy on vaccine mandates? We have seen a lot of businesses, hospitals as well, kind of walk back their policy because they aren't able to staff up in a big way if they keep that mandate in place. What are you hearing in your conversations?
It's a real pressure point, particularly for a lot of organizations with frontline workers that are trying to provide service to their customers, whether that's a hospital or a retailer. The pressure is very real. But I think some companies have succeeded to navigate that pretty effectively. I mean, the list that you have on screen now are all companies that have made a choice that there will be some short-term pain. They try to educate their employees. They try to show support, but they also try to be clear that this is a responsibility. It's a responsibility to our community, to each other, and to our customers. And they've been able to get through it. But I do understand a lot of companies feel enormous pressure on this, depending on their locations, the state of their workforce, and so forth.
In another kind of commitment to community and responsibility to community as well, on the climate front, you've actually collaborated with the World Economic Forum and you produced the CEO Guide to Climate Change. You know, I would love to understand, you know, where you believe that some of the corporations are keeping their commitments in place and actively meeting some of those targets, or on the opposite end, falling behind some of those targets that they've set forth.
Yeah, so it was really terrific. We had our annual meeting of the Alliance of CEO Climate Leaders yesterday. It was virtual, of course. We couldn't all be in Davos like we often are, but it was nearly 80 CEOs from the leading companies around the world, all of whom have made bold pledges. And the overall news, I think, is an encouraging news. The chart you have on screen now, we've seen the growth of companies signing up for the Science Based Targets Initiative, basically saying they have serious climate targets, growing 65% a year over the last 5 or 6 years, now over 2,000 companies. So I would say overall, many more companies are signing up. The pledges themselves are getting more substantial, not just about the amount of reduction within their own operations, but taking on the challenge of their entire value chains. Scope 3, as it's called in climate language, to bring those down. So those commitments are going up. But you highlighted in your question the other part of it, which is commitments are great. Translated into action is what we need. And that requires new ways of operation, new skills, changes to the business portfolio, changes often to leveraging technology, and different strategies to compete. What we tried to do in the report that we did. Oh, sorry, Akiko, did you want to jump in?
No, Rich, I wanted to follow up on that very point I was thinking about, which is moving beyond just sort of the headline commitments and really talking about Scope 3. We've seen some of the big companies like a Pepsi, for example, make significant investments in working with suppliers. How much of that you think expands even further this year? I mean, what are you hearing from companies about how much they are now willing to put aside to be able to work with suppliers so they can truly say that they are carbon neutral?
So first of all, you're so right. Other than the people in the hardest to abate sectors like steel and aluminum, for most companies, most of their footprint is in their Scope 3. It's in their supply chains. It's actually not in their own operations. So if you only focus on your own operation, you don't deal with your suppliers, you're a big global company, you're leaving most of the need on the table. That's being more and more recognized. The commitments are going up. It will be a multi-year journey. Many of these suppliers are farmers or mid-sized companies, people that may not even understand how to approach it yet. So this isn't a flip a switch kind of thing. This is a multi-year, engage with suppliers, educate them, partner with them, in some cases be willing to pay more for the products they offer because it's the only way they can afford to make investments, and to figure out how to make your products more valuable to customers so that it gets paid for, so that you can afford to do it. The point of the work this year, because it is so important, is to show that actually there's a huge advantage to being an early mover in this. And that the risk for most leading companies is not that they go too fast, it's that they go too slowly. And going too slowly risks really falling behind. Look at Tesla and what they've been able to do. You want to be ahead of the curve in your industry, and there's value in terms of employees and attracting talent. There's value in terms of the cost you can save. There's value in terms of cheaper financing and in terms of shareholder value, and that there's an urgency to act for the planet, but there's also an urgency to act for the business.
That was Boston Consulting Group's Chairman Rich Lesser. Coming up next, a recap of the oil markets. Don't go away.
Welcome back. Well, crude oil slipping slightly today amid some profit taking, but still strong demand and short-term disruptions continuing to support levels around multi-year highs. Here with more on that and how crude settled today, let's bring back Jared Blickery.
That's right. And let's take a look at the Wi-Fi Interactive. A little bit of a downdraft today, giving up about 75 basis points or so. We have crude oil for February futures settling down just around $86 and change here. Let's take a look at the year-to-date price action. You can see up 13% from the lower left to the upper right, not really giving back much ground at all there. And I do want to check in on the energy sector because we have a kind of a mixed board here. It looks like some of the foreign majors are seeing a little bit of weakness today, like Royal Dutch Shell, BP. Those are down 1%, but Exxon and Chevron both up about 0.75%. We also got Baker Hughes earnings this morning. Let me show you an intraday chart, getting a nice little pop there. You can see over the last year, up 18%. So this isn't one of those high-flying oil companies or like a production company. This is an oil service company that we're seeing. Here's a comment from Piper Sandler saying that the company has just kicked off the earnings season in strong fashion with a well-rounded beat, both across segments as well as financial metrics. Margin performance across segments was solid, especially encouraging with oil field services. And this comes only after, I think this was earlier this week that we found out that Permian production is at a record level, surpassing those that we saw in 2019. If you go to OPEC, the only larger player in OPEC than the Permian Basin, that's Texas and Arizona, is Saudi Arabia itself. Guys?
All right, Jared Blickery, thank you so much. We are going to pivot now. Want to bring your attention now to our ETF report brought to you by Invesco QQQ. Let's bring in our next guest to discuss what's on the horizon for the ETF space. Ben Johnson, Morningstar Director of Global ETF Research. Ben, thank you so much for joining us. I want to start off by asking you, Fidelity is apparently making a foray into direct indexing into that space, which some have said that could be pegged to a potential ETF category. What's your opinion on that?
Yeah, so while I think many have worried that direct indexing could be a category killer for low-cost diversified ETFs, what I would say is that ultimately long-term, it's probably going to sit side by side with ETFs in relative peace in harmony. It's an interesting angle. It's an interesting tool in investors' toolkit to get diversification, tax efficiency, and I think most importantly, most notably, customization. And now at an entry point as low as a $5,000 investment minimum with Fidelity's new offering, that brings direct indexing as close to retail investors, mom and pop, as it's ever been before. So it's an interesting development, but it's got a high hurdle to beat. A low-cost portfolio, diversified mutual funds or index ETFs can cost investors less than 10 basis points a year. Fidelity is going to be charging 40 basis points for this service. So at a minimum, it's going to have to add about 30 basis points worth of value. Even more if you line it up next to one of Fidelity's own existing offerings, which is its zero-fee index mutual funds, which investors might prefer over paying 40 basis points for something that's a bit more customized. And certainly Fidelity, on the contrary, would rather charge 40 basis points than nothing to more of its customers. So it's going to be interesting to see this ongoing tension, this ongoing tug of war between the incumbent ETFs and index mutual funds and this new form of indexing, direct indexing.
Ben, paint the picture for us. The year has been a rocky one for the stock market, and there has been a lot of volatility. How is that translating into interest in the ETF market? Are you seeing a lot of money flowing into ETFs, and if so, where in particular?
Well, we're seeing continued momentum at large into the ETF category. Last year, we saw record flows, and record flows by a massive margin. We'd actually surpassed the prior annual record in terms of ETF flows in July of 2021, that prior record having been set just the year prior in 2020. So what tends to shift is the contours of flows. What are the areas of the market that our investors are most interested in? And what we saw in 2021 was a noticeable uptick in anything that might be an inflation fighter, be it TIPS. TIPS ETFs saw record inflows. We saw renewed interest in gold-backed ETFs. Fast forward to today, and what we're seeing is a pivot away from inflation fighters and towards value strategies of all types, as we've seen value stocks make a bit of a comeback. Now, whether or not this is truly the long-awaited comeback for value stocks or another false spring like we saw in 2021 is yet to be seen. But what is certain is that investors have been allocating money at the margin to value ETFs.
And Ben, I'm wondering, it's a time of such volatility. What are you advising clients on duration of ETFs?
Well, what you see is that ETFs offer you the full spectrum. You can cut up the interest rate curve, you can cut up credit markets, slice, dice, even julienne them now with the launch of bond blocks ETFs imminent that offer the finest slices yet of sections of corporate credit markets. So investors have, I would say, more tools at their disposal than they ever have before. So if they want to manage interest rate risk in a very fine fashion, if they're worried about rates rising, they can do that by coming in closer to shorter maturity bonds. They can do that through bank loan ETFs that adjust their interest rates as interest rates change. They have a multitude of tools at their disposal today that they didn't even just 10 or 15 years ago. So ultimately, the right decision depends on the investor in question, depends on their preferences, their tolerance for risk. But the good news is they've got as many low-cost choices, as many low-cost implements as they ever have at their disposal.
And need to remain vigilant this year for sure. All right, we will leave it there. Ben Johnson, Morningstar Director of Global ETF Research. Thanks for stopping by today. We're going to take a quick break, but on the other side of it, we'll look at jobs. Texas and Arizona are the latest states to return to pre-pandemic job levels. How far behind is the rest of the country? We'll find out ahead.
Texas and Arizona have joined Utah and Idaho in recovering all the jobs they lost at the start of the COVID-19 pandemic. Will that trend continue? and which state is next? I want to bring in Adam Kamens now, Director of Regional Economics at Moody's Analytics. Adam, thanks for joining us. So let's zero in on these 4 states for a minute. What are they doing right? And is this a trend you see continuing in the new year?
So what's really gone right for those 4 states is a longer story than just the aftermath of the pandemic. They're states that have been growing rapidly. They're states that have generally a large tech sector, or maybe warm weather, or some advantage that's been attracting people there for a long time. The kind of continuation of that trend and the increased prevalence of remote work, meaning people can move anywhere they want, is driving more and more people to those states. So I think that's been kind of the key factor so far. And I do see this trend continuing now in the next year. It took a while to get those first 4. I think the pace is going to pick up in 2022.
The unemployment rate is now nationally at 3.9%. So how far behind are the other states, and which regions are closer to reaching pre-pandemic levels?
Sure. So the region that's been leading the way throughout the recovery is the Mountain West. A lot of states in the Mountain West are already there, and I think some of the next states are going to come from there. So Montana is actually the state that's closest to being the next to get over the hump. But in terms of a broader region, the South, and in particular the Southeast, is likely to be next. I've got states like Florida, Georgia, the Carolinas that generally are ahead of the pace nationally. And I would expect by the time that we get to the middle or end of 2022, those states will be back above their pre-pandemic highs as well.
Well, let's talk a little bit about what's holding some states back versus others. I know that some states in the Northeast and the Midwest are still pretty far away from returning to those pre-pandemic job levels. What can you point to there? Why is that happening?
So it's a variety of factors. One is that the initial hit to those economies when the pandemic struck was so severe that when you're talking about in New York, you just have a much steeper, much deeper hole to climb out of than you do in a place like Arizona or Texas. Then beyond that, these are places that are losing residents, or at least not gaining them rapidly in the way that some other states are. So consumer industries, restaurants, hotels, those types of establishments, it's just taking a lot longer for them to ramp back up. And then the last thing I would point to as well is the fact that remote work, again, has been a real game changer. What it means in a big city like a New York or a Boston or a DC is that there's just less activity day to day in those cities, which means less demand for consumer industries. And a lot of those low wage jobs are the ones that are taking a lot longer to kind of catch up to the rest of the economy in that part of the country.
I'm wondering how much of a headwind has Omicron been? Would the numbers have been even better if we didn't have this wave that we're going through? And then looking a little bit more forward, what about the Build Back Better plan? If that doesn't come through, do you think that's a headwind as well?
So yes, I think both of those are headwinds. I think Omicron, we haven't seen it yet in the data. So all of the numbers that we've seen so far that have been officially put out by the government don't reflect Omicron yet. When we start to get the January and the February numbers, that's going to be a setback. And in fact, January, probably we're going to see slight job losses nationally. And so that means that it's going to be a little bit of a step back, especially in parts of the country like the Northeast that are further behind. In terms of the Build Back Better bill, that actually, the impacts of that not passing, sort of the assumption had been that some form of it would pass. Those are going to be felt in the middle of the country, probably a little bit more. That's where healthcare subsidies and universal childcare and some of the other components of the bill that might have had an economic benefit, more pronounced economic benefit, those would have, not having those is going to hurt a little bit more. But I'd say that's more of a long-term impact. I don't think it would have that much of an effect on the long-term recovery. And same thing with Omicron. I think that's not going to have much of an effect on the kind of medium-term recovery. I think we're really just talking about a month or two of a setback before things get back on track.
And Adam, the latest report we got out on the job market is those weekly jobless claims, which actually rose surprisingly for a lot of people to 286,000. That's the highest level we've seen since October. What does that tell you about the overall job market recovery? Because it seems more and more as you delve into these reports that it's pretty uneven, and it really does depend on where you live in the country.
Yeah, I mean, we've actually looked at that a bit. And first of all, those numbers, as you said, they're the highest in about 3 months. I would say Omicron's fingerprints are all over that number. That we saw the same thing with Delta to a lesser extent back in the summer, where that's just dealing a little bit of a setback to what had been a pretty steady downward pace. For the most part, what we'd been seeing throughout the fall was that states that were further behind were experiencing more of a rebound. And so the decline in jobless and initial claims for unemployment insurance were actually falling a little bit more rapidly in some harder hit parts of the country. We're now seeing, again, going back to the Northeast, states like New York, New Jersey, Pennsylvania experience a more rapid increase. And I think they are playing a disproportionate role in that increase that we're seeing now. That reflects the impacts of Omicron and the fact that that rebound and that convergence that was starting to happen a little bit with the rest of the country has slowed meaningfully.
All right, Adam Kamens of Moody's Analytics, thanks for your insights today. And coming up next, what Microsoft's buyout of Activision means for Sony and its gaming business.
Welcome back to Yahoo Finance. Well, Xbox's acquisition of Activision Blizzard is one of the biggest deals in gaming history and the latest in a series of key purchases for Microsoft's video game division. But what does that mean for Sony's PlayStation and other players in the space? Yahoo Finance reporter Dan Howley joins us with the latest. Dan.
That's right. Microsoft's purchase of Activision Blizzard for nearly $70 billion sent shockwaves through the tech and video game industries. And, a lot of the talk has been around the metaverse, the future of kind of gaming and what this means for Microsoft. But I want to take it back to what it means currently for the company and kind of the big benefit that Microsoft is going to see as a result. And that's to its Game Pass service. Now, this is Microsoft's subscription service where gamers can either download games to their Xbox or PC for $9.99 a month. It's more than 100 games. A lot of them are day and date releases, meaning the same day that you could go and buy them online or buy them in store. You can get them on Game Pass and play them without having to make that purchase. You just use that $9.99 a month. That's a great service, very inexpensive. But the real winner here is Game Pass Ultimate. Now, this is really kind of the future of gaming in general, but more specifically for Microsoft. What it allows you to do is cloud gaming. So what you'll be able to do is log on to the Xbox Game Pass app or Xbox app on your Windows PC, log in via the browser that you have on your iPhone or iPad, Chromebook, smart TV, basically anywhere that you can get a browser or the app, and then be able to stream games similar to what we are able to do with Netflix to those devices. So this is going to be the future of games. It significantly improves margins for Microsoft because they don't have to worry about clunky hardware, the R&D that goes into that. They have their own Azure cloud service, so they have the backbone to do this, and that's where they're going to see the biggest benefit. And currently, Game Pass has something north of 25 million subscribers. Microsoft is really pushing this. And right now, that price at $14.99, really heavily subsidized considering the amount of games that are on there. And outside of the Activision Blizzard titles that they're getting and their own Microsoft titles, they also give players access to Ubisoft titles, Take-Two Interactive titles, and EA titles. So it's just a behemoth. Sony is working on something of its a similar offering of its own. It has a kind of cloud gaming service in PlayStation Now, but it's not nearly as robust as what Microsoft has. And while they are working on their own service, Microsoft is able to bring in both PC and Xbox games, and that's a big, big win for them. So the fact that they have all these different properties and that they already have the service up and running means that Sony really has its back up against the wall. And while it did beat Microsoft when it comes to console sales in the latest generations, I don't know if they're going to be able to keep that win up going forward.
Yeah, I mean, Dan, real quick, do you foresee Microsoft taking these Activision franchises like Call of Duty and saying, look, they're exclusive to the Xbox?
Yeah, it's a good question. I mean, right now, they've already started doing that with their ZeniMax acquisition. Bethesda has a game coming out called Starfield, highly anticipated. Microsoft spent $7.5 billion, and they basically said, look, we spent the money on that. We have to do something to make it back, so we're going to make that game exclusive. They also own the property rights to the Elder Scrolls series, something that a lot of gamers are waiting for a new version to come out. And that may be exclusive to Xbox. Now, as far as the Activision Blizzard acquisition, that could mean that Call of Duty eventually is an Xbox PC only title, leaving Sony and Nintendo out to dry. What has to happen, though, is obviously the acquisition has to close, and then any existing deals that Sony had with Activision Blizzard have to lapse. And then Microsoft can make that decision. Whether or not it makes financial sense, it could get more gamers onto Game Pass, but then they lose that huge chunk of money that they would get from people making purchases on the PlayStation. So it's still up in the air. I think smaller titles will definitely be exclusive to the Xbox and PC going forward, though.
All right, Dan Howley, thank you for that report. We will leave it there. That about does it for myself and Alexis Christoforous on what has been definitely a risk-on day on Wall Street. We have much more Yahoo Finance ahead. Our colleagues will take you to the bell and beyond, and much anticipation over those Netflix earnings coming up. Stay with us.
Stocks are staging a rebound as the Nasdaq tries to claw back losses after sinking into a correction. Investors are also watching new economic data roll in as weekly initial jobless claims unexpectedly jumped by the most in 3 months. We'll discuss the latest on the market action with Jeffrey Kleintop, Charles Schwab Chief Global Investment Strategist. Plus, we're awaiting quarterly earnings results out from Netflix after the bell this afternoon. Hit shows from Squid Game to Don't Look Up may have fueled a pickup in subscriber growth at the end of last year, and looking ahead, the return of names from Ozark to Bridgerton and Stranger Things may serve as future catalysts. Santosh Rao, Manhattan Venture Partners Head of Research, joins us later as we break down those numbers. And auto auctions heat up further. Bring a Trailer set a fresh record in 2021 with more than 21,000 listings, yielding a total value of $828 million in vehicles sold on the digital auction platform. We'll bring on Randy Nonnenberg, Bring a Trailer co-founder and president, for more on the turbocharged classic car market. We have an hour to go in today's session. I'm Emily McCormick.
And I'm Adam Shapiro. Let's see where we're lining up right now with that last hour of trading in the session, because as always, fasten your seatbelts. The last 20 minutes could be quite a ride. And we're seeing a little bit of a pullback from the session highs that we had earlier. There you go. We've got the Dow up about 142 points, the S&P 500 up about 16 points, the Nasdaq up about 68 points. We were doing a lot better earlier in the day. So let's check in with Jared Blickery to find out what's driving these markets at this point.
That's right, Adam. I'm looking at the Wi-Fi Interactive, and on the Nasdaq, we had been up 2% earlier today, and we have given back most of it, still looking at gains of about 0.5%, but you can see how that's been slowly whittled down since the peak at about the 11 a.m. hour. Let's fast forward to the VIX, because we've seen that a little bit elevated, the highest level that we've seen in about 3 or 4 weeks. There you can see on this 2-month chart, we got a little spike here that took out these highs that we saw in the middle of December. Checking in on the bond market, seeing a little bit of action there, not a lot. And that's giving, I think, the mega caps a little bit of room to breathe. You see the 10-year up 1 basis point, the 5-year up 1 basis point, and the 30, that is up almost just a fraction of 1 basis point. Crude oil. Now, crude oil just settled in the red, but still hovering around the highest level since about 2014. There's a 2-month chart where you see it's up over 13%, even more off of these lows there. Now, let's get to some heat map action. And here we see the NASDAQ 100 flashing some green for the mega caps, but they are giving back some territory. Tesla had been up about 4% earlier in the day, now up about 1.75%. Microsoft up 1%. But a lot of the gains have been centered around the Chinese stocks. JD.com up 9% in the center of your screen. Pinduoduo up about 4%, Baidu up 6%. So seeing a little bit of a snapback here. And I think the tone for this morning was we are indeed getting a snapback in a lot of the areas that have seen the most carnage over the last couple of months. That would be the Chinese stocks. That's KWeb in the upper left. That's up 5.5% today. The best day in some time. ARC Innovation, that's up 2%. We were taking a look at some of the solar stocks after the Biden comments yesterday afternoon, gave them a little bit of a jolt here. Gambling, IPO. So a lot of these beaten down sectors attracting some money today. The big question is it going to stick? And also looking at a little bit of action in the meme stock sector. So I think putting it all together, we have the makings of a little bit of a rebound. But again, we're giving up steam into the close. So you got to ask yourself, is it going to be another down day tomorrow? We'll have to wait around and see.
That is the question. Jared Blickery, thank you so much, and we'll check back in with you later. Let's talk more about the markets now with our next guest. Jeffrey Kleintop is Charles Schwab Chief Global Investment Strategist, and he joins us now. Jeffrey, thank you so much for joining us this afternoon. Looking at the price action today, as Jared was mentioning, we are seeing stocks after the highs of the session, but the Nasdaq especially is still gaining after falling into a correction just yesterday. Is this just some temporary dip buying in your opinion, or is this potentially something that could be sustained?
I think there is a rotation going on towards those areas of the market that have been neglected for a long time, not just months, but years, areas like financials and energy, even healthcare, which is an area that had done a bit better during the pandemic, but really isn't seeing any kind of multiples like it did in the past. I think those areas of the market have more durability here as we look at an environment where earnings growth is slowing, so valuations matter more, and many of these companies can look to generate earnings growth in this environment of rising interest rates and commodity prices, whereas tech is a bit more challenged as goods demand begins to slow.
Something you just said made my ears perk up, and I think a lot of investors who want to make some money want to key in on it, because you said that the areas that might have not got as much attention as they deserved, you said energy, and yet energy was the best performing sector last year. So how much more attention does it need?
Yeah, it certainly got a good bit of attention last year, but it's been left for dead for almost a decade. I think that there's more to go. Energy, of course, the stocks tend to track what happens with the crude price, whether they should or shouldn't, given spreads is a separate issue, but I think they will. And I think those prices will remain elevated. I think as we look to the second half of the year, continued reopening, particularly in areas of Europe and even in China, which is seen renewed shutdowns, I think will continue to spur demand. At the same time, supply may be constrained to keep up with that. So we continue to see elevated energy prices, and that should continue to keep a floor and even some fire under energy stocks.
Jeffrey, I think one big question as we've seen this move higher, especially in benchmark 10-year yields in the US, has been this relationship between bond yields and stocks. And I'm wondering, can you break this down for us? Because one of the things that you wrote in a recent note is that a lot of times we do see interest rates and yields and stocks actually move up in tandem with each other, at least in terms of historical trends, because these tend to track positive economic activity. And is this something that investors should expect as we head into this year's potentially higher interest rate regime?
Yeah, well said. I think that's right. I think, there's no doubt that bond yields are reacting to a robust economic environment, very strong demand and increasing prices as supply has struggled to meet with that. And that goes along with strong earnings results. And that's in fact what we're seeing. We're not reverting to an environment where rising inflation is sapping strength of corporate profits, as we might have seen in the 70s or even part of the 80s, where we had an inverse relationship between interest rates and stock prices. So I think as long as rates are rising in an environment of still above average global economic growth, and we're still seeing that, I think that can be beneficial for stocks. I think the risk is, do we see inflation get out of control? That continues to push up interest rates to much higher levels at the same time maybe weighing on growth. That doesn't seem to be the case now. Corporate profits seem to be tracking well ahead of inflation and keeping pace with that. But if that were to change in the second half of this year due to unforeseen events, that could be a risk.
Jeffrey, help us understand, those of us, especially those of us who are, say, passive investors. As I'm talking to you, it's a very good reality that the S&P 500 is going to fall into negative territory, and yet it started the day so well. How do we go within just, 6-7 hours to that kind of, up, doing well, and then we just all the way back down? What is that telling us?
Well, I think this is not abnormal to see the kind of volatility as we start to enter a Fed tightening cycle, and at the same time seeing earnings growth begin to decelerate. The return of volatility is going to be a theme this year, and that's why I think you want to focus on stocks that have the benefit of share buybacks. This is not just individual investor demand, but corporate demand as well, helping to support those prices. We saw from 2009 to 2014, the early stages or the first half of the last economic cycle, really the stocks that saw buybacks saw the best performance by a wide margin, doubling the performance of those that didn't. And again, this time, I think that'll be an important factor as individual investors may waver a little bit in this more uncertain environment, but corporate buyers remain strong.
All right, we'll leave it there for now. Jeffrey Kleintop is Charles Schwab, Chief Global Investment Strategist, and we thank you so much for your time this afternoon. Coming up, we'll get a check of the COVID situation in Florida with Dr. Adrian Burrows, family medicine physician and CEO of CFP Physicians Group. Stick with us. Welcome back. Union Pacific shares are up today after the company posted quarterly profits that topped estimates. Price increases from the railroad company helped boost earnings even as global supply chain snags rippled through the economy last year. Adam, you spoke with Union Pacific CEO Lance Fritz about these results and about some of the other concerns facing the company, even given this latest strong quarter. What were some of your takeaways?
Well, first, the important thing is that they had, and this is in the press release, the most profitable year ever in 2021. We have Lance Fritz join us all the time at Yahoo Finance because Union Pacific gets a kind of picture of where the economy's headed before the rest of us. And although Omicron is having an impact, for instance, staffing shortages, they face that as well. There are other things coming down the horizon. They have a new deal with Schneider Intermodal, which is going to be very big for them. Shipping goods is going to be profitable going forward, and they're optimistic. Here's more of what Lance shared with us about some of the break-ins that have been taking place on Union Pacific rail cars, but also where they're headed.
We've amped up our use of technology like drones to be a deterrent and to help collect evidence. We've amped up the number of our own special agents, our police force that are present in those areas. We're partnering with LAPD. They've amped up their presence with us. We're encouraging the district attorney locally to prosecute more of these cases. The criminals there have turned from 2-3 years ago a theft event every now and then. It was one-off, wasn't well orchestrated. It was an opportunity crime. Now it's an orchestrated, organized crime that happens. We've largely cleaned up the areas from the video that you've seen and that you've shown. We've got good cooperation with the governor's office. They're going to be on the ground there with us today, this afternoon. So I think we've got our arms around it, but there's a lot of work that has to be done here. We need more prosecutions. And oh, by the way, we're also going to be making capital investment in physical barriers, in more physical security, whether it's metal, security fence, razor wire, or concrete barriers. It's sad to say that we're going to have to do those kinds of investments, but we've got to keep our employees safe and our customers' lading safe.
You mentioned the cooperation from the LAPD as well as the governor's office. Are you getting the same cooperation from the district attorney? I mean, it sounded like when this story initially broke, there seemed to be a bit of tension between, or more frustration maybe, with the way that you saw the county handling these cases.
Yeah, our frustration is about making sure that prosecution occurs. There was a fair amount of criminals that we apprehended and booked with LAPD, only to see them back out, 24 hours later. And then they would brag to our police officers about how, a misdemeanor is nothing and they're just not worried about it. We need the theft to be prosecuted like what it is. It's organized, it's grand theft, and we need a strong deterrence to stop that behavior.
You emphasize too the thing that many of us sometimes don't realize is the threat that this organized crime effort might pose to the safety of your employees. It's with that in mind, because I've heard you stress that these barriers you want to put up the goal is to protect your employees. Got to ask you about Omicron. What kind of impact has the wave had on staffing? Hopefully people who did get breakthrough cases were able to recover, but what's that doing with your ability to transport goods?
Adam, thank you so much for that question. Yeah, we addressed this also on our call today, and I'm crystal clear about this. In our planning for the second half of the year, we missed that Omicron would behave, that COVID would behave like it did, that we'd see a third and fourth wave. We expected kind of status quo, getting a little better over time. And so I think we missed that as a risk. As a result, crew availability was an issue, and it impacted our operation.
So when you talk about what's going on with Union Pacific, just about all of the segments in which they ship did very well in the fourth quarter. This new deal with Schneider, they look to be doubling, at least Schneider looks to be doubling the amount of intermodal transportation they have by 2030. So the future is looking very good, Emily, for Union Pacific.
Yeah, Adam, definitely really interesting to hear Union Pacific talking about this increase in organized crime as well. Just earlier this earnings season, we also had Walgreens Boots Alliance, another company in a different industry, talking about higher organized crime, really weighing on their margins and just the increase in overall shrink in that sector as well. But thank you so much for bringing us that interview. And coming up, we'll discuss the latest on the COVID-19 pandemic and the spread of Omicron in the US. Stick with us.
So we're hearing mixed reports about COVID-19 and where we stand in this latest wave with the Omicron variant. So let's bring into the stream Dr. Adrian Burrows, who's a family medicine physician and CFP at the Physicians Group, as well as CEO. It's good to have you here, Dr. Burrows. Thank you for joining us. I guess it depends where you are in the country to be able to say that it's peaked and now declining. That's at least the headline we're getting in New York. What do you think is truly going on with this nationwide?
Well, thanks for having me on, first of all. Secondly, though, you're right. Depending on where you are geographically in the country, depends on where you are in terms of whether we feel that Omicron is reaching its peak or whether, you are past the point of having to worry. So, I'm in Florida, and so the data is showing that we are coming off of a peak. So hopefully we'll be looking at, less cases. Last week, we were inundated with cases. You still can't get into the hospital. If you get admitted to the emergency room now, it's taking you almost 2 days to get admitted here locally in Orlando where I am. And, I just think that people let their guards down. We do have a variant in Omicron, which is much more easily transmitted. And I think you're seeing that as you go across the country.
Doctor, thank you so much for joining us. In your state, there has been an inquiry in Florida that just opened into Dr. Ralph Pino, the director of Florida Department of Health in Orange County, to determine whether he tried to press employees to get vaccinated in violation of a state law prohibiting government agencies from implementing vaccine mandates. What impact do you think this state law and now an inquiry towards an official who may have violated it, what has that done for vaccination rates in Florida?
Yeah, so first of all, I will tell you that the Governor DeSantis has been, I don't want to call him anti-vax, but he certainly has not been a proponent of what I consider doing the right thing and trying to promote vaccination. The gentleman that you're referencing in public health, he's not asking for a vaccine mandate. He's simply saying that those people who are working in public health are not being vaccinated at the same rate as the general population. And he's encouraging them to do so. So that puts Governor DeSantis in an awkward situation. He's not mandating vaccines. He's encouraging vaccines, which is a First Amendment right. Governor DeSantis has always been about freedoms of speech and things of that nature. So does he try to fine this gentleman for violating the vaccine mandate law, or does he stick with his mantra of freedom of speech? So that puts him in an awkward situation. So I'm interested to see how he handles that.
But your Governor DeSantis, won't even admit if he got the booster shot, whereas the former president, who's a resident of Florida, has talked about getting the booster shot. How difficult does it make it for doctors when the state's leader takes that kind of position?
That's a wonderful question. It makes it very, very difficult. We have been struggling to try to get control over our infection numbers here in Florida. And so when you have the leader, the people that people look up to in terms of directing us and trying to help us get control of this pandemic, not supporting the health care officials in the state, it makes it very, very, very difficult. And it's confusing to the patients, it's confusing to our residents, and it certainly is not making my job any easier.
I want to shift gears for a moment and ask you about data that you're seeing around long COVID. So those who were previously infected but may still be experiencing some symptoms of COVID-19 months after that initial infection. Are we seeing any data emerge in terms of who's being affected most by this and how to alleviate some of these lingering symptoms?
Yeah, so, people who are, at high risk for developing COVID are people who you're starting to see these, prolonged conditions with, where they're getting, scarring to the lung tissue, having prolonged periods of shortness of breath, unable to return to their normal quality of life. But I will tell you that is actually trending into people that, you would have considered having healthy lifestyles. So the high risk patients, as we have identified them, are not the only people who are having these long COVID symptoms. And so that's why I try to urge everyone I can to try to get vaccinated if you're eligible to be vaccinated, because we're definitely seeing less of those symptoms in the vaccinated population.
It's a hopeful question I'm about to ask you, but it's a light on the horizon question. Do you have in your mind a date by which this really is going to be behind us?
That's wonderful. And people are really anxious for that. I don't think anyone really thought we would even last this long. Historically, pandemics tend to last roughly 4 years if you look back in history. And so I would hope that would be the light at the end of the tunnel. I know some people are getting very excited about what's happening with Omicron, if you can get excited about something, because it's really increased the amount of people who it's affecting. So I think people are trying to hope that, we'll develop herd immunity as a result. But I tell people, we thought the herd immunity number would be 60 to 70% when this first started. For Omicron, we're talking like probably 90 to 95% to achieve, that type of immunity. So I tell people, don't worry about those types of things. Worry about what you can control. We cannot control coronavirus, but we can control whether we get vaccinated, whether we wear masks, whether we social distance, whether we wash our hands. So I tell people, those are the things you can control. Those are the things you should be doing.
All right, Dr. Adrian Burrows, family medicine physician and CFP Physicians Group CEO, thank you so much for joining us and thank you for your time this afternoon. We want to get a quick check of the market action here because as we can see, the S&P 500, Dow, and Nasdaq have flipped into negative territory. Remember that they were sharply higher earlier during today's session. And just taking a look at some stats now, the Nasdaq Composite and S&P 500 have just hit fresh year-to-date lows. And recall also that the Nasdaq Composite had closed in correction territory as of yesterday as well. But we've got much more on the market action coming up on the other side of this break. Stick with us.
All right, let's check these markets because we had started the day trading higher. It looked like we might recover some of the losses from this week. And now we've hit new year-to-date lows on the S&P 500, on the Nasdaq. The Dow is off 6 points. It might go positive in the last 15 minutes of trading. The S&P 500 down 7 points. Nasdaq is off 43 points. Before we get to our next segment, let's do our 2 and 2. 2 stocks that Emily's watching, 2 stocks that I'm watching, and want to pay attention to the airlines. Let's first pull up United. They reported after the bell yesterday. We got their earnings call today, and the shares are trading down. Now, United is different than the other big airlines like Delta and American in that 50% of United's revenue pre-pandemic came from international travel. So although the recovery is well underway, that the 2021 fourth quarter and going forward, reservations for visiting friends and family, the leisure domestic travel, back to where it was in 2019, Omicron is having an impact not only on the staffing levels, but on people who are canceling reservations and slowing down bookings. So where they stand right now, according to Scott Kirby, is that revenue in the fourth quarter, better than expected, $8.19 billion. But they are still projecting that in the first quarter of this year, they're going to be 20 to 25% off from where they were in 2019. And Omicron is going to impact the speed of their recovery. In fact, he said, quote, near-term demand, we remain optimistic about the spring and excited about the summer and beyond. In other words, first quarter, not so much. Okay, take a look at American Airlines. A couple of good things about American, even though they are trading down right now. Let's go right to their debt situation. At the end of the quarter, they had about $15 billion in liquidity, and that's the highest amount they've had during the pandemic. Very important. Also, the highest revenue during the pandemic for them came in at $9.43 billion. It's down compared to where it would have been pre-pandemic at $11.3 billion. They lost $931 million in the quarter, but they hired 16,000 people last year, and they're going to hire 18,000 this year. So in the words of Doug Parker, Omicron, quote, "This volatility has created the most challenging planning environment in the history of commercial aviation." You think? Emily?
Adam, speaking of volatility, take a look at shares of Peloton. Now, another rough session for this stock. And this is after CNBC first reported this afternoon that the company was halting production of its connected fitness products due to declining customer demand and as a means of reining in costs. Now, according to that report, Peloton will pause its connected bike production for 2 months until March, and production for its more expensive Bike Plus will be halted until June. Now, it's also reportedly planning a 6-week pause on manufacturing its basic treadmill starting next month, and likely won't produce any new Tread Plus products this fiscal year. Now, shares have fallen more than 20% today following this report, and that also triggered multiple volatility halts in these shares. Now, those have also fallen below the stock's IPO price of $29 a share back from September 2019. And this is all really extending a slide that we've seen in Peloton stock that picked up in earnest after it first reported fiscal first quarter results in early November, and at that time had slashed its full year forecast in that report. Now, shares have fallen by about 80% over the past 6 months. Now, meanwhile, a different story for shares of Luminar Technologies. As we can see, that stock is solidly in the green today. And that's after Mercedes-Benz said today it plans to use Luminar's LiDAR technology for its next-gen vehicles featuring highly automated driving technologies. Now, as part of that deal, Mercedes-Benz is also set to acquire up to 1.5 million shares of Luminar as certain milestones in this partnership are met. And this is just the latest deal with a major automaker for Luminar, which just last year had announced that Volvo would be also using the company's LiDAR tech on a new electric SUV. Now, in terms of this deal with Mercedes-Benz, we don't yet know a timeline for when the company will integrate Luminar's LiDAR sensors into its production vehicles, which models will ultimately be getting these sensors, or ultimately the extent of the autonomous capabilities that this will help generate for Mercedes-Benz. But nevertheless, another major deal for Luminar, and that stock is soaring today. Adam?
All right, people who are nuts about cars or describe themselves as car nuts are probably familiar with Bring a Trailer. In the old day, you had to go, say, to eBay to sell your car, or even to an old-fashioned auction. We just had an old-fashioned auction through Mecum, and they had millions of dollars in sales. But the industry as a whole is worth billions. And that's where Bring a Trailer comes in. They were founded and created in 2007. I wish it'd been around in 2006. I had to sell 2 Studebakers on eBay. But let's talk about where they're headed, because they are having a banner year. I think a $2 million Porsche just sold. Randy Nunenberg is Bring a Trailer co-founder and president. Prasubramanian is my fellow car nut. I wish you were around in 2006, because I think I took a hit doing it on eBay. Let me throw the first question out to you, though, Randy. What is the attraction for those of us who like to consider ourselves car nuts to being able to do it all on your platform?
Well, thanks for having me. Yeah, a lot of that attraction is just the sort of treasure hunting that people get to do, and that's popular in many different enthusiast segments, whether you're into jewelry or fine art, or we happen to be cars. And for the types of cars that we list, which are special things, one-off things, what falls into the enthusiast segment, finding the right one to come up is what causes people every single day to come back to Bring a Trailer.
Hey, Randy, Pras here. I have a lot of questions. I want to certainly big picture here. You guys had a huge year last year, nearly $1 billion in sales. What do you think is driving this big boom in collector cars right now?
There's a boom in collector cars overall. Some of that was supercharged by the pandemic, but some of that is just people refocusing based on the macro financial environment and wanting to see them as investments. A lot of people see collector cars as a scarce item, and it's one that you can actually invest in and at least break even, if not make money in, while also enjoying it at the same time. In a way, it's harder to enjoy a stock or a gold investment, something like that. So a lot of people use these and park them and care for them and dote on them, and their enthusiasm, as we have helped it to grow, makes that for something that can actually be a meaningful investment for them.
So Adam mentioned just earlier about the $2 million Porsche Carrera GT that sold this week, a record amount for that car. Do you think the market is, there's a lot of enthusiasm, but is it getting overheated? When I talk to small talkers, even big ones, they're a little dismayed by how high these values are and how they can't get in. What do you think about that?
Well, certainly, the big ones like that $2 million Porsche you're showing right now certainly get the headlines. But interestingly, the average sale price of a vehicle on our site, last year was about 35,000 and did boom to 45,000. But there's not really a narrative that, all of these are going to be $1 million and this is only a rich person's game. You ask what makes people come to Bring a Trailer. One of the main attributes is the variety, and there's things transacting every single day for $20,000 and less that people can sort of get into it at every level. There's kind of something for everyone. But is it overheated? There's a lot of people that are really excited about it and aggressive, and like I say, using it in those sort of investment language as opposed to enthusiasm and hobbyist language. And thankfully, there's enough vehicles out there. We listed 22,000 vehicles last year, which was a 57% increase over the previous year on our online platform. And we see that much growth again. And there are there are millions of interesting vehicles that are out there already on the road. And then manufacturers these days are still producing some interesting ones as well.
Randy, this is Emily here. I want to dive a little bit deeper into what you were talking about with accessibility. And have you seen recently any shift in demographics and who's purchasing these cars on your platform or participating in car auctions even more broadly? Or has that target audience really remained relatively steady?
That's a super good question. And I think that on our platform, what we have let people do is do it in their pocket, right? I think that the older environment of having to go to a physical car auction, how many people have done that? That's only really industry people or really deep collectors and that sort of thing. Most people never do that. But with our platform being purely online, the accessibility has just ballooned, and people that are coming into the hobby, if they call it that, or even just looking to transact for their next vehicle are using our site to be able to do that. So I think we have expanded that sort of accessibility. And so that has made it shift maybe a little bit younger, more technologically savvy, have different sorts of expectations around like their life around vendors like Amazon, as opposed to their life with vendors like a traditional car dealer. So there are different sort of features that are and conveniences that are both expected and helpful for the market. So that has led to a shift in a different type of buying audience.
You're also providing, though, on the platform the kind of data that people who, you call it the hobby, I'll call it the frenzy mania. And I'm looking at the page right now, and I put in Studebaker Avanti. And you get the data, real data, on what certain cars that might not have sold but got bid up to, and then those which sold. And unfortunately, we just saw one go for $83,000, so out of my wallet's range. But that's really valuable to not only the buyers, but the sellers. How often do you have to explain to a seller, because you work with the sellers when they list the car, be realistic about the price?
Well, data helps it no longer be mysterious and no longer be based on opinion. The car industry and the collectible car industry for so long was, held tightly by a small group of experts, and you kind of had to succumb to whatever they said. And now people have a much greater expectation for transparent data, and we wanted to push that forward. So our platform, every single listing, we've listed over 60,000 vehicles on Bring a Trailer, and all of those are permanent. So you can go see the permanent record of all of those in scatter charts, and you can see all that data. And we kind of model that after sort of a Zillow type marketplace, where if you really want to find comps and understand what this is going to take and why one is valuable and why one isn't, we think that's positive. And that sort of transparency is through the entire site and everything that we try to do, because we think that's something that hasn't been in the industry before. So that's fueling a lot of the visibility of our site and usefulness of our site to users.
Hey, Randy, real quick two-parter here. What's next for Bring a Trailer? And also, give me one undervalued car that I should keep an eye on.
Oh, good ones. What's next for Bring a Trailer is more just trying to let more and more people use this sort of platform. I think the online trust and the online reach have both been things that people were dipping their toe into as sort of first timers, but it's really starting to be the norm now. Now that, cars, 7-figure cars can transact there as well as $5,000 cars, people are seeing it as more universal, where previously it might have seemed more niche. So I think our platform is going to see more growth in this year and the coming years. And just in terms of adoption, it will become the regular and first choice place to go. So that's in our favor. In terms of what cars are available, I mean, there's so many different types of models and makes that are out there. I don't know whether you're into sports cars or vintage 4-wheel drives or European or American stuff. But I think that there's been these crazy booms, this hot market for European cars and trucks and those sort of things. I think American muscle cars have sort of trended a little bit behind that. So a lot of people think, oh, everything's, so expensive these days, but you can still get pretty iconic American V8 cars from the 60s, like a 65 Mustang Coupe. Yeah, sure, it's not 10,000 anymore, but it's probably 20 or 25,000 now for a car that is just amazing, right? And Americana, and it
Randy,
hasn't run away the way some of these other ones have.
Oh, because I've been on your site and I've been on other sites to answer Pros's question, and Pros, it's not you. You're Mr. BMW, Porsche. But
oh, easy. Okay, I can answer that.
If you want to, Lincolns from the early '70s, it's blowing me away. Like the car they drive in Schitt's Creek, people are paying 25, 30 grand for these Lincolns, these land yachts. But that's another discussion. Pros, you and I will grab a scotch and talk about go get a 72 Lincoln. Randy Nunberg, Bring a Trailer, co-founder and president. Thank you so much for joining us. Pros, see you in just a bit. When we come back, the latest from Mountain, because they're investing in a future where it becomes much easier to take the video you might have on YouTube and get it onto places like Instagram and TikTok.
Welcome back. Let's get a quick check of the market action because we are seeing stocks holding lower after dipping into the red earlier this hour. As you can see, the Dow Jones Industrial Average now down about half a percentage point or more than 150 points. It had been up by more than 450 points at session highs earlier today. The S&P 500 and Nasdaq also now in solidly negative territory. Now, just taking a little bit of a deeper dive here on the sector action for the S&P 500, consumer discretionary, materials, and information technology are the sectors that are weighing on that index this afternoon. But let's shift gears and talk about marketing, because the marketing software platform Mountain has just purchased the video creation platform QuickFrame in its latest major deal after buying Ryan Reynolds' maximum effort ad agency last year. Mark Douglas, Mountain CEO and President, and Lucas Leffler, CEO and founder of QuickFrame, join us now. Thank you both so much for being here. And Mark, I'll start with you. Tell us a little bit more about this deal, because Mountain has been quite acquisitive this past year. And why was QuickFrame the right fit right now?
The reason why is we launched the service right before the end of the year. We call Creative as a Subscription. And the idea behind it is really simple. We want all of our advertisers to have lots of creative for their television ads and to have it at a reasonable price and to have it frequently every quarter. And so maximum effort was the driver behind that in delivering on that creative. And the first ad they did was the Peloton ad that, unexpectedly went very viral. And so the QuickFrame is essentially the next extension of that. They take that, they're essentially like Uber for creative, and they take that to all companies. So any company can participate in Creative as a Subscription on top of the Mountain platform.
Mark, great to see you. I'm going to throw this question to Lucas because I recently put TikTok on my phone, and I'm allowing the Chinese government to spy and learn all about me. It's addicting. You go through those videos really fast. So the question I would have for you, if I've got a 30-second traditional kind of ad, but I know when I'm on the TikTok platform, you got to get me within 3 seconds, 3 to 5 seconds. How do you take that 30, create that thing that I'm going to go through, but make sure that I'm there long enough so that somebody gets paid?
Yeah, it's a really great question. I would actually advocate that you want to get the user's attention in maybe a third of a second. QuickFrame actually specializes not only in editing video, but also creating original video. And so today we actually create a piece of original video content every hour on average through a marketplace of thousands of different content creators in close to 60 different countries. And so brands large and small, as Mark mentioned, basically request to have a new video made, and those creators, very similar to Uber, apply for that project and then go create the video.
So just in the real world, Lucas, if, for instance, this discussion, we will cut this discussion and put it onto the web, but could we then come to your platform and say, get me a TikTok from this? How much would it cost us if Yahoo Finance did that to create the TikTok experience and then get it posted?
Sure. So on average, the piece of original video is created for close to $750 per video, but because you're a friend of the company and Mark, we might be able to cut you a deal.
Well, thank you.
Mark, I want to turn this next question to you.
Sure, go ahead.
Go ahead.
I was going to say, and better yet, when you're doing your TV ads on the Mountain platform, there's no additional cost. It's just bundled in with the cost of our platform, so with the media you're spending. And so that's the idea behind Creative as a Subscription. You get more and fresh creative and get it often because it's just bundled with the Mountain platform.
Well, Mark, and that's a great segue into my next question, because your company on its website even has said that television is the most powerful ad medium in the world. We were just talking a little bit about TikTok and social media advertising. So why do you think television is still such a powerful, if not the most powerful way of reaching consumers?
Yeah, it's really simple, is that you really commit time to TV. You sit on your couch, you lay in bed, and you commit to being told a story or watching your favorite reality show. And when you do that, the advertising, if it's fresh, if it's culturally relevant, if it's timely, is something that people really pay attention to. So it's not in a sense, it extends the entertainment experience. And so no other medium has that other than television. And so that is what makes TV just continues to be so powerful as an advertising medium.
Mark, in the traditional model, the advertiser, the company comes to you, create us a TV ad, and then now you can go over to Lucas, take this TV ad and create the TikTok. But would it make sense for you to be partnering with the other side of this, which are the networks and the local TV stations, to create a kind of loop so that those who want to advertise, they come to you to create, but then they have placement in the same process?
Yeah, so that's exactly what we do. So we basically have partnerships with every television network in America. And so our customers come to us in order to drive like performance ads, like ads that they can measure. And so we're growing very quickly. And as a result, the biggest problem we saw is just getting the ads. And so that's why we acquired Maximum Effort. That's why we acquired QuickFrame, was to solve that problem. But all of that creative then goes into the programming you watch, essentially on every TV network.
Lucas, I want to turn this last question and give you the last word here, because we're about a month out from the Super Bowl, which is, of course, a major tentpole event for advertisers. Can you tell us a little bit about, how QuickFrame is going to potentially be involved in that experience, and why and how important it is to have these sort of well-produced ads around these major events?
Yeah, so you're hitting on a key topic for our business, which is being able to support seasonality. And so where I think QuickFrame is incredibly supportive isn't just for the tentpole, but for the always-on marketer who needs to think multi-channel. And so we actually support channels beyond CTV, social, e-com, just to name a few. And so our brands actually will look at us as being able to support the Super Bowl commercial, but more often than not for the weekly and ongoing social content that Adam had mentioned before. So we try to focus on shorter form, tend to be a little bit cheaper, more cost effective, as our head of marketing would say. Original content that is basically everything but that 7-figure or super expensive Super Bowl spot.
All right, Lucas Leffler is QuickFrame CEO and founder, and Mark Douglas is Mountain CEO and president. Thank you both so much for your time. Coming up, we've got the countdown to the closing bell. Stick with us on Yahoo Finance Live.
All right, we have seen the gains wiped out as we have accelerated to the downside. Heading to the closing bell, Jared Blickery, where do we stand?
Nasty reminder of yesterday. Definitely some echoes here. I'm looking at the Wi-Fi interactive here, and the Nasdaq has gone from up over 2% at the highs around 11 a.m. to where we are now at session lows down over 1%. So more than almost a 3.5 point range. That's a trading range for the day. So the last time we've actually had, I think, 3% or more moves in the S&P 500, in the Nasdaq this year, and that is a lot of volatility for the market to stomach. Also seeing the Dow off more than 300 points right now, in the S&P 500, that is off 1% as well. Want to take a look at the VIX. That has been picking up, and we can see it is at new territory here. It is at the 24 level. Let me just take a 2-month candlestick view here so we can see all the spikes. Haven't really taken out that mid-December spike just yet, but 24 definitely moving up. And the bond market been pretty quiet today. You can see the 10-year, that's up 1 basis point, 30-year not doing much either, basically unchanged. And then you take a look at inside the market here, and this is the Nasdaq. Wow, what a reversal. Amazon now down 3%. This stock was green on the open. Nvidia down over 3%. All these names, from my recollection, were green just a few hours ago. What's the news that's sending everything south? I lined up the timestamps, and it could be the U.S. giving the decision, the green light to certain Baltic states to send U.S.-made weapons into the Ukraine. But I got to tell you, geopolitics, usually not a big market mover, so this could be simply more continued weakness. We got utilities in the green, and that is it. To start the day, everything here was in the green. Now, consumer discretionary, that's the Amazon sector. That is down 2%. That is the biggest loser, followed by materials and industrials, guys.
All right, Jared, we're going to keep an eye on this. Less than 4 minutes to the closing bell. Quick breather. We're going to come back and assess where we stand before we hear the gavel. Okay, about 1:15 into the closing bell. The people who are going to help us understand what we've witnessed today are Mark Lucchini, Janney Montgomery Scott's president, chief investment strategist, and chief investment officer. We've also got Dave Mazza from Direction Managing Director and head of product. Dave, let me just talk real quick with you. Used to be you could buy on the dips and confidently expect things to go up. But this year, and I realize we're only 3 weeks into January, boy, get out the Pepto-Bismol. Do you see an end in sight to this kind of volatility and then fall?
Well, it certainly, to your point, feels a lot different than the last few years. Where buying the dip was the mentality, and that dip could have been 50 basis points or 0.5%. Now we have a proper 10% correction. The Nasdaq today started off on a much stronger note, and certainly the close here is not very inspiring. So I think investors do need to be more cautious. It's certainly an opportunity for traders here, but we know valuations for certain areas of the market still remain higher And if earnings come in stronger, that's going to help. But other than that, it's going to be challenging.
All right, we've got a closing bell as we are racing down, and here it is.
And that is the closing bell this Thursday, January 20th. As we can see, another ugly day in the equity markets here. The S&P 500, Dow, and Nasdaq had been in positive territory earlier today. As we can see, closing in sharply negative territory as we get today's settlement. The Nasdaq down another about 1.3% after closing in a correction yesterday, so down about 10% from a recent record high. The Dow Jones Industrial Average down more than 300 points, or nearly 1%, and the S&P 500 down more than 1% as well, with the consumer discretionary, materials, and information technology sectors leading the way lower on that index. But let's kick it back over to our panel. And Mark, I want to ask you a little bit about the market action that we've been seeing recently as well, and where you think we may be going, because we had been seeing pretty strong economic growth, but just looking at some of the data that we got out today, an unexpected spike in new jobless claims, we're seeing inflation at multi-decade highs. Is economic activity going to underpin further stock market appreciation this year, or is this something that investors can't count on?
Well, certainly, first of all good points. The Atlanta Federal Reserve GDP Now tracker was punching up a number about 6.8% up until the revisions due to retail sales and industrial production last week, which brought it down to 5.1%, which is still very strong inertia. And mind you, yes, we've had a couple of mixed readings coming out of the government with regard to Empire State. A couple of things you mentioned. Today's Philly Fed survey, on the other hand, kind of contradicted some of the weakness in the Empire State survey, given reason to believe that economic momentum is still quite healthy, and we therefore expect it to remain well above trend over the balance of 2022, particularly emboldened by job gains, which we expect to continue to see, and importantly, wage growth, which is occurring at a pretty rapid pace. Once again, quoting that same Atlanta Federal Reserve, their wage tracker is showing 4.5% annualized growth for people who have been in their jobs at least a year. We haven't seen a pace like that going back to 2002. So I think there's a lot of horsepower in the economy. The consumer's well endowed to continue to propel economic growth forward, which is going to put that underpinning to stock prices that, while off to a weak start and will likely be volatile because of the pivoting monetary policy setting, some geopolitical issues that lurk out there, I still think it's going to be a good year for stock prices overall.
Mark, just want to follow up on that. So as an average investor who doesn't have the insight that you and Dave have, Mark, what should I look for as that pivot? Is it after the March meeting when everyone expects the first increase of 25 basis points, or is it going to be some other metric that I should be paying attention to?
Well, certainly I would be looking for what we actually hear the Fed say, and as opposed to necessarily what they do. And we should have some preemptive commentary around that as soon as next week when the Fed meets and probably begins to talk about in more clearer terms what it's likely to do with regard to the unwind of its bond buying regime, if not necessarily foreshadow when that first rate hike is likely to occur. But I think one should really be focused on inflation, because that's going to be the driver to Fed policy. If we see peak inflation here over the next couple of months, such that these readings we've gotten here of recent, the CPI at headline 7%, which is the highest since 1982, begins to recede somewhat, that's going to allow the Fed more runway to act less aggressively than what the market's currently pricing in. And that should help, once again, to boost equity prices that right now are trying to digest higher interest rates, not so much where they reside today at 185 on the 10-year, rally speaking, but how abruptly we got here from the beginning of the year where it was 1.5%.
Dave, I'm wondering, what advice would you have to investors as they look at what's happening in the Nasdaq composite and many of these tech and growth shares? Is this the time to be selling as we see this continued volatility, or should long-term investors especially be considering holding through some of this churn?
Well, it all goes to an investor's time horizon, true point. If you have a very long time horizon, and if you still believe in many of the secular themes that have been occurring, cloud computing, the 5G rollout, gene editing, now may actually be a better time to step into those spaces. Now, if you've been owning that, you've certainly suffered. Some of these names are well off their highs, 50% corrections, which is very, very difficult and challenging to do. in the near term, there is certainly momentum has moved from the growth areas of the market to things like energy, things like financials, which are more cyclical and tend to do better in a broad-based economy. But Mark raises a great point. The real focus here is going to be on inflation. And the Federal Reserve has a small pocket here to act before they potentially get even more politicized than it seems like they have been with the midterm elections coming. So that March meeting is definitely going to be a hot button issue for investors and traders. And I would say look to be more diversified than maybe you have been in the previous years, and be maybe more cautious and just with that buy the dip mentality we were talking about before the close.
All right, we want to put this conversation on pause really quickly and head over to Yahoo Finance's Jared Blickery, standing by with breaking news on Netflix's earnings. And Jared, that stock is down. What's the cause?
Yes, the outlook for subscriber ads pretty weak here. I'm looking for the first quarter. Now, this is the current quarter projection. They're saying that they're going to add 2.5 million subscribers. The estimate was for many times at 6.26 million. So that is the headline number that we're looking at after that big headline miss. The stock right now, you're looking at a chart on the Wi-Fi Interactive of Netflix stock. You're not seeing the aftermarket's reaction here, but it is right down to 450. And that is that round number that has been in play before. So some pretty significant declines here for Netflix. Let me go over some of the other numbers here. Fourth quarter revenue came in exactly in line, 7.71 billion. Fourth quarter EPS coming in at $1.33, handily beating the estimate from the street of 81 cents. But again, that streaming paid net change number of 2.5 million projected for the first quarter, really a big disappointment. Also seeing, let's see, we have fourth quarter global streaming paid net additions for the fourth quarter. Those come in at 8.28 million, and I believe the estimate was for a bit lower than 8.13 million. So managed to beat on the fourth quarter numbers, but just not on the projection. Also looking at total US and Canada streaming paid memberships of 75.2 million. And then you go to the paid memberships for the first quarter. And again, that's coming in at 224.3 million. Also, Squid Games got some news here. They decided to comment about that. They had 1.65 billion hours viewed in 4 weeks. That is an incredible amount. I think I'm included in that total as well. And they're also seeing a positive free cash flow for the full year 2022 and beyond. But it's really that headline subscriber number and the projection for it that really missed expectations here. Again, the stock down about 10% in after hours trading to the lowest levels we've seen since about mid-2020, guys.
All right, Yahoo Finance's Jared Blickery, thank you so much. Mark, what's your take when you hear some of these results out from Netflix? And I know that these just dropped moments ago, but putting this in context, we had Netflix's subscriber outlook just missing expectations. Peloton reportedly halting production on its products due to lower demand based on a CNBC report earlier today. What do you think these things are saying about some of these growth and stay-at-home plays that had been so successful earlier on during the pandemic?
Well, for me, it is, in fact, these infamous stay-at-home plays that you made reference to that had been bid up to valuations that get to the point where they're priced for perfection. And anything that is released about the company's investment results or its prospects that don't meet or exceed very elevated expectations leads to gigantic disappointment in the form of a share price decline. In this case, by orders of magnitude that put them deeply into correction, if not outright bear market territory. I mean, Peloton, you mentioned, is down 84% at last I looked a couple of hours ago from its peak. Netflix, as the other reporter had mentioned, down 10% just today in after-hours trading. This is indicative of companies that, again, have valuations that have been bid up by investors who, on disappointment, decide to sell first and ask questions later, and therefore leave huge carnage in their wake relative to declines as valuations compress to better reflect prospects under a more normalized economic climate. It's not necessarily an indictment of Netflix. I don't think they're going to see substantial subscriber, if you will, attrition, even as they've raised prices. But at the same time, the buy-up, the uptake in terms of their product isn't as effective in an environment in which people are wanting to get out and travel and leisure and entertain themselves in ways differently than they did when we were locked in our homes.
We have to say thank you to both of you. Mark Lucchini is Janney Montgomery Scott's president, chief investment strategist, and chief investment officer. Dave Mazza is Direction's managing director and head of product. All the best to both of you. When we come back, we're going to do a deeper dive into those Netflix earnings.
Netflix just moments ago reported fourth quarter subscriber growth and an outlook for first quarter subscriber growth that missed estimates, and the stock is down sharply in late trading. Here to discuss more is Santosh Rao, Manhattan Venture Partners Head of Research, and Yahoo Finance's own Alexandra Canal. Santosh, thank you so much for joining us. Netflix does, as we know, typically trade after earnings based on those subscriber numbers, and those did miss estimates. But aside from that headline number, what were your big takeaways from this report?
Yeah, I think as expected, fourth quarter was good. I mean, they beat everything across the board, which was expected given the slate of content that they had. But the subscriber number for first quarter plays right into the hands, right into the fears that competition is growing. And they may not be able to compete. The good old days may be gone. Now they will really have to grind it out, compete neck to neck in terms of quality of content and get subscribers out there. So the next incremental subscriber is going to be hard to get, that we know. So in the long run, it's still well positioned, but near term, I think the growth story has to be clarified. How are they going to do it when subscribers are slowing down? So I think that's the biggest takeaway at this point. Let's see what they say in the commentary.
Yeah, Santosh, outlook for 2021, clearly very disappointing to investors, but we've seen this slowdown in subscriber growth the past few quarters. In fact, we're nowhere near those numbers that we saw in 2020, and yet Netflix did raise those prices. So in your view, have we reached the peak, at least in the United States, and how should Netflix adjust, or in your words, clarify its growth strategy moving forward? Because the emphasis seems to be more on international markets at this point.
Yes, and that's been the story. International is a big part. I think 40% of their net ads come from APAC region. So I think that's a big part, even though they are low ARPU numbers, but the growth is there. So I think that's the thing. I think in the US, we'll have to see if the price will stick. There is a cap on how much they can raise. There's competition right now. It's full on now. It's game on. All the players are out there. And so they're executing. Netflix continues to execute well, but it's just that the options out there for subscribers are a lot more. So they will have to manage everything, manage their rollout, manage their execution, and keep getting out good content. In the end, they will succeed, which we know they have a lead on that end, but they will have to continue to execute and keep on giving new content.
But when we talk about, growth with this new content overseas and a lot of faith that they'll be able to do that, a show like Ozark, which I'm thrilled is coming back tomorrow. I can't wait to see how they finish this out. Is that going to play so well? I mean, if you're a US citizen or maybe even in an English-speaking country, you might be able to relate to it. But is that the kind of thing that, say, in India or even in China, that people are going to say, gotta watch this, gotta get Netflix?
Not necessarily. I mean, it doesn't translate that easily, but there is a big English-speaking population in all those countries. So I think it will continue to do well there. It'll continue to grab some eyeballs there, but it won't be as big as the English-speaking world. They have their own localized content, which is very good, very catchy, and Netflix has been very good at that, on executing and scaling up their international content. So I think they have competition there. But like I said, most of the countries now have a huge or growing English-speaking audience. The subtitles are pretty good. So I think you can come along, you can follow along. If the series is good, you can pretty much be part of the part of the flow there. So it's too early to tell, but I'm sure it can do well.
Santosh, I want to ask a little bit of a wonkier question here, and that is net subscriber additions going to be the best way to continue assessing Netflix's business? Because especially as Netflix matures in North America, this is inherently going to slow down, even as that total subscriber number is still well ahead of the competition at 222 million. And, we've seen this with tech companies, from Apple stopping its unit sales reporting its unit sales, that is, of iPhones, Twitter switching to monetizable daily active users for its reporting metrics. Do you expect something similar to come out of Netflix?
Absolutely. I think it's not going to be the absolute number. It's going to be more about the engagement level. How many hours are there? How many hours are the subscribers glued to their shows? I think that's going to be a big count. And I think they did mention something like that in 3Q, where they're going to talk more about the engagement out there in terms of the user base. So I think that's definitely the way to go. Now you're hitting the law of large numbers. There's a lot of competition out there. The switching costs are not that many. People go in and out. So you need to manage churn very well. You need to keep the people engaged, subscribers engaged. And that's why you see Netflix getting into gaming or want to. They bought the indie game company, a studio. They want to get that option there also. They're not big there. It's still early, but they want to keep the user engaged and in their ecosystem. And that's the game right now. It's the quality of the subscriber, quality of the engagement, or the level of engagement. That's going to be a big thing rather than the absolute number of subscribers.
And Santosh, real quickly here, we only have about 20 seconds, but obviously there's a lot of players in this space, and we're starting to see the winners and the losers. Just yesterday, Google killed YouTube Originals after more than 6 years. Is this a sign of more drop-offs or consolidations to come in this space?
Absolutely. I mean, right now, everyone's getting in there. Not everybody's going to succeed. You need to scale up. And there are a lot more variables right now. It's still early days in streaming, especially when you consider the global market. So you're going to see a lot of you'll see some kind of consolidation, some kind of drop off, some kind of specializations in kind of niche players out there. So you're going to see a lot of back and forth in there, a lot of jockeying for position. But this is early days, like I said. Netflix is the incumbent leader. They're executing very well. It's their market share to lose, but they will be a tough player to lose. It's a tough player to beat. They're out there, but the players are coming on strong. Everyone wants streaming because that's the future.
All right, Santosh Rao is Manhattan Venture Partners Head of Research, and Yahoo Finance's own Alexandra Canal. Thank you both so much for being here again. Let's head back over to Yahoo Finance's Jared Blickery, standing by with some breaking earnings results out from CSX. Jared, how'd they do?
That's right. A little bit of disappointment here, but let me just go over the numbers. It was a headline beat on fourth quarter EPS. That number coming in at 42 cents, beating the street estimate of 41 cents by a penny. Operating ratio also coming up better than expected, 60.1%, besting the estimate of 58.6%. And also revenue beating the street estimate of $3.32 billion, coming at higher at $3.43 billion. And finally, operating income coming at $1.37 billion, which perfectly matches the street estimates of $1.37 billion. Also saying that they are targeting full year CapEx, that's capital expenditures of about $2 billion. 2022 is going to be a focus on new hires, also preventative technology. And they're also seeing sequential volume momentum building throughout the year. So not a huge beat, but this is a company that's been hitting relatively, actually not relatively, it's been hitting record highs very recently. And maybe just a case that some of the transports have gotten a little bit too ahead of themselves. Guys?
All right, Yahoo Finance's Jared Blickery, thank you so much. We'll be right back. Welcome back. TB12, the sports fitness and wellness brand co-founded by Tom Brady, is out with a new product. TB12 CEO John Burns and Yahoo Finance's own producer and sports reporter Josh Schaefer join us now to talk more about it. John, thank you so much for your time. The new TB12 product is a pre-workout blend, and your co-founder, Tom Brady, has had a pretty incredible and lengthy career now at age 44. How does this new product and TB12's existing offerings help athletes of every echelon get the fuel and fitness into their lifestyles that they have?
Well, thanks for having me, and I appreciate the question. Our business is really based on trying to help people everywhere live pain-free and perform their best. And I think especially when you're talking about the upper echelons of sport, someone like Tom and other professional athletes, everything and anything that they can do to help themselves with their health, with their energy levels, with their ability to perform, and importantly, recover is what we're about. And the great thing is we get to work with people like Tom Brady, but also average everyday people like myself and you all have come to see us in our centers all over. So we can do a lot for people if you're looking to perform your best.
Yeah, John, with that, I mean, I think people watch Tom this weekend at 44 playing in another playoffs and maybe sit there and look at their aches and pains and say, I can't imagine playing in the NFL. Maybe I can't even imagine going for a run at a certain age, right? What is one or two things that people can maybe take away from the TB12 method, some stuff that Tom does, some stuff that you guys do with people that middle-aged people could be doing to kind of keep in that up shape?
Yeah, that's a really important question, Josh. And I think our whole TB12 method really centers around the notion of muscle pliability, right? And we specialize in a deep force tissue work to help you lengthen your muscles and then make your muscles more resilient and allow you to move without restriction. So, anyone out there, as you're exercising and taxing your body through your even activities of daily life, your body has a tendency to get more tense, get more dense, have restrictions of movement. So we recommend to everyone focus on your pliability. If you can't see a TB12 body coach in person, roll out. We have obviously a TB12 as purveyors of the TB12 method. We sell vibrating rollers, spheres, things like that, which can help you. So really focusing on your muscle pliability is probably the number one thing that you can do. Second, beyond that, it's obviously working hard to make sure when you exercise, you don't counteract the efforts to become more pliable and move without restriction. So for instance, when I was growing up, heavy weightlifting was the thing, right? And so, deadlift as much as you can, squat as much as you can. Well, the reality is doing that makes your muscles in your body more tight, more dense, more restricted in movement. So we espouse exercising in a way that supports your sport, supports your activities, but doesn't do it at the expense of pliability. So we're big fans of working out with resistance bands, body weight, things like that. Doesn't mean you can't work out with weights. We certainly complement many power type athletes and especially CrossFit athletes, but really focusing on the pliability and a functional strength and conditioning that is built around your sport, your activities are probably the two key things that you can focus on. And look, it's working for Tom, has worked for Tom for a long time, and he's really our pinnacle case study in it. I mean, he either leads the NFL or close to leads the NFL in every major passing category at the age of 44 this season. I mean, it's extraordinary.
John, what's it like working with Tom while he's having all of this success? I know the last time you were on, you told us, you got a couple hours with him after a game to spend time with him and kind of build the business. I'd imagine when he's on these playoff runs, maybe he doesn't have the time for that, or does he? What does he do from a business perspective while he's on the field in the playoffs? Do you guys maybe just see him at the end of every Super Bowl run, or is he still in constant contact with you guys?
No, Tom is a truly unique and very special person in that regard. I mean, I've said this before, and I live it every day. The TB12 method in our business is really his lifestyle. And aside from the commercial interests, obviously, of building a business, the opportunity to change people's lives is super important to him. So yeah, obviously through the course of a season, the communication cadence can ebb and flow a little bit. But, as you said with that example I shared last time, he's never not been available for something we need. And, I tell you what, he's always proactively reaching out with ideas. Our new product we launched today, which is our pre-workout product, that really came from a lot of conversations with him and, a couple things he was doing and using and, again, trying to push the limits himself. So he's very actively involved. I would be misleading if I say I would reach out to him on a Sunday this time of year during the playoffs. Usually not talking to him much on a Sunday this time of year, but, the other 6 days of the week for sure. And again, he, as hard as he works on the field and as hard as he works off the field for the field, he brings that to business as well. It's extraordinary.
All right, TB12 CEO John Burns and Yahoo Finance's Josh Schaefer, thank you both so much. And coming up, a Yahoo Finance special presentation marking the one-year anniversary of President Joe Biden's inauguration. Stay tuned.
This is a Yahoo Finance special, the Biden presidency, year one. The White House is eager to point to success, trillions of dollars in new spending for COVID relief and an infrastructure bill, a booming economy, and unemployment under 4%. But those wins are outweighed by some big losses. Build Back Better is a bust so far, and his latest marquee pledge, new voting protections, appears DOA as well. If politics is about pocketbooks, soaring prices are also bad news for Biden. And then there's the pandemic. With his problems mounting and the midterms on the horizon, there are predictions of a wipeout for Democrats in the fall. Join us now for this Yahoo Finance special, the Biden presidency, year one. Welcome to this Yahoo Finance special. I'm Adam Shapiro.
And I'm Akiko Fujita. 1 year on, the president faces a very different reality, especially when it comes to those efforts to curb the pandemic. Back in January last year, just 5% of U.S. adults had been vaccinated. More than 3,000 Americans were dying of COVID-19 every day. Those numbers have improved significantly, but there is still a very long road ahead until many Americans are going to feel safe. Joining us now is Yahoo News correspondent Andrew Romano. And Andrew, we're talking about a number of challenges. It feels like things swing from month to month. This month, it's been about testing. It's about getting those vaccines and those boosters. How should we be looking at this year one of the president's performance on the pandemic?
Yeah, Joe Biden came into office saying that he was going to overcome the deadly virus. That has not been the case. He did an excellent job, as you said, speeding those vaccines out. Only 5% vaccinated when he took office. Now we've got more than 3/4 of the public with at least one dose. The problem is the virus itself keeps changing. The challenges keep changing. The Biden administration has said that they did not see the Delta variant coming. They did not see the Omicron variant coming. And with each of those evolutions in the viruses, the virus has presented a new challenge to the administration right now. Testing is that major challenge. We've seen the long lines over the holidays when Omicron took off. The rapid tests were not available. The PCR tests, long waits made them essentially useless. And so the administration now has shifted, focused on those rapid tests, is sending them out, at least 4 to every household in the United States, but is a little bit behind the curve. And I think that has been the thing about the administration. They have not foreseen what is coming next with this virus. You could say that maybe no one could foresee what was coming next, but they have been a little bit slow to respond, a little bit unclear in the communication. And that has frustrated Americans who just want things to get back to normal. They're seeing, a year later after Biden took office, there are still 2,000 Americans dying every day of COVID. And the fact is we're still in a pandemic. So the challenges change. The administration tries to respond. They're a little bit behind the curve, and people are unhappy about that.
Andrew, quick follow-up. I heard from a senior citizen who's upset that the push to have insurance companies cover the cost of an over-the-counter COVID-19 test.
Yeah.
Medicare doesn't cover it, and yet senior citizens are the most vulnerable and perhaps, most likely, unfortunately, to have a severe outcome if they get sick. So this doesn't make sense. Has the administration addressed that?
It's incredibly frustrating. I think when the administration first was trying to respond to the demand, the vastly increased demand for testing, and Jen Psaki, the White House press secretary, came out and said, what are we supposed to do? Send it to every American? They came out with a plan to allow you to go through the cumbersome process of getting it reimbursed that by insurance. That's just not going to work for most Americans. And they've basically realized that at this point with the website to allow every household to order 4 free tests. That's how simple and easy things need to be to actually combat a surge in the virus. We're seeing that now with the N95 masks. They finally come around to the view that you need medical grade masks, not cloth masks, and that you need to provide those, make those easy and accessible for Americans at pharmacies, at community health centers for free, not going online and trying to figure out, is this a fake one? Is this a real one? What Amazon, vendor should I order it from? So they're coming around to this view that they've got to make it as frictionless as possible for Americans. But it's not going to do much to combat Omicron at this point. We're already sort of turning the corner on the surge itself, and so it's a little bit it's the right idea, but again, it's a little bit behind the curve.
Andrew, thank you. We're going to keep talking about this, but we're going to bring into the stream former American Medical Association President, Dr. Patrice Harris. And very simply, Doctor, from your viewpoint, what is the administration doing correctly?
Well, thank you for having me. And certainly we applaud the Biden administration for doing what it can to get the testing out, the mask out, as you just heard, because from the very beginning of this pandemic, and it seems that we would, as a country, focus on one thing. We might be focused on masks, or we might be focused on testing, even though we, of course, from the very beginning did not have the testing capacity. And really, it's about using all tools in the toolbox and not forgetting one and not becoming enamored with one. It is masking. It is testing. From the very beginning, I have advocated for testing before I co-founded EMED, as you know, as president of the American Medical Association, talked about the importance of testing and the frustration with the long lines and the inequitable access to testing. So I believe they're getting it right regarding testing. Again, we've been behind the 8 ball on testing since the beginning, and they're getting it right on mask. And, and funding is the right thing to do.
Dr. Harris, when you think about this most recent surge from the Omicron variant, it feels like there's been a bit of a shift from, trying to crack down or quash the pandemic to actually learning to live with this virus. How does that shift change up the approach for the White House, or how should it?
Well, we had the Delta surge, and now we have the Omicron surge. And it appears, although I tell you, I'm uncomfortable with using words like letting up, as a physician, a former public health official. I think we need to actually keep our feet on the gas pedal, to use another metaphor. Certainly, Omicron is less deadly, more transmissible, but still, again, as you noted in the opening, we have thousands of people dying every day. So we should not be letting up. I've said this virus gets an A+ at doing what viruses do. Viruses mutate. You can't predict how they will mutate, but we know that viruses do mutate. And that's why, again, we need to make sure, again, to be a bit more proactive. We talked about working to prevent pandemics. We need to also make sure we are working through a pandemic to continue to do the things, testing, masking, thinking about testing in schools and in the workplaces, all the public health measures that we know work.
Dr. Harris, you know far better than we do, but we've had guests on the platform who've said, look, by March or April, they use that term, we can let up. What I hear you saying is, no, we need to stay at kind of the level we're at now, but there doesn't seem to be an end.
So let me say this, there will be an end. I do believe, as many public health officials and physicians believe, that we will get to the point where this is endemic, right? And we think about this just like we think about the flu, right? We have the flu season and we have flu campaigns. We want everyone to get vaccinated. So that will happen. However, right now, we are still in the midst. We have the Omicron. So this will end. I am hopeful that this will end, but actions will be required for this to end. I mean, it won't end magically or on its own. We as a society have to continue to do the things. Now, clearly, we are not where we were a year ago because we have the vaccine. Everyone should get vaccinated and boosted. That's eligible. We have masks, and I really do, again, applaud the administration for getting the correct mask out there. Testing works and is a critical piece. We will need to be strategic and targeted in our testing. We will need to make sure we have the data regarding the test results. So we should be able to look back at this investment and say, here's what we know. Certainly there are some opportunities where you just want to test, you just want to know, but there are others where you need the data and you want systems like our platform at EMED so that you can keep up with the data. And if we take those actions, we will end this pandemic, but it won't happen magically, and it won't happen without our action, our collective action.
Appreciate your joining us. Dr. Patrice Harris is the co-founder and CEO of eMed, as well as a former president of the American Medical Association. All the best to you. We're going to take a quick commercial break, but when we come back, unemployment is down, wages are up, but so is inflation. So we're going to ask the White House's top economic advisor for some clarity on the mixed picture regarding the U.S. economy. That's next.
The Federal Reserve provided extraordinary support during the crisis for the previous year and a half. Given the strength of our economy and the pace of recent price increases, it's appropriate, as the Federal Chairman, Chairman Powell, the Fed Chairman Powell has indicated, to recalibrate the support that is now necessary.
That was President Biden speaking at a press conference yesterday, highlighting the Federal Reserve's mandate of price stability. Now, by all accounts, the president has overseen a strong economy in his first year in office. 6.4 million jobs created, unemployment down, wages are up, and yet inflation at near 40-year highs have continued to plague the White House. We had a chance to speak with White House National Economic Council Director Brian Deese earlier today and asked him how the administration plans to tackle that problem of price pressures. Take a listen.
Well, I think looking back with context, 2021 was a historic economic year. The strongest job growth on record, the largest decline in unemployment in our nation's history, and the strongest economic growth in nearly 4 decades. In addition, we saw a 40% reduction in child poverty, a reduction in hunger, and an improvement in households' balance sheets that is unique to America. We're only seeing that happen in the U.S. And so we think that if you're looking back, we've seen really historic progress. And at the same time, we have challenges and work yet unfinished. The elevated price increases we've seen are clearly an issue, and what the president spoke directly to yesterday was the appropriate role for the Federal Reserve to play in dialing back some of the historic support it has been providing to the economy, and the role that he can play in trying to help boost the productive capacity of our economy so we can move more goods and services through our economy more cheaply and build on this historic progress that we've made.
Hey, Brian. It was Will Rogers who said, "I'm not a member of any organized political party. I'm a Democrat." And I quote that from the last century because these days, when we talk about, for instance, Build Back Better, and you've just highlighted the accomplishments of the first year, which include the $1.9 trillion relief from the pandemic, the infrastructure bill. How do you get the Democrats who are, have one part of the party saying all or nothing? You have two senators who are saying we're not going to amend in any way a filibuster. How does the president build cohesion, even if you're going to break out parts of Build Back Better, to get that through both houses?
Well, I think we do it by taking the approach the president outlined yesterday, which is identifying all of the areas where we can get support, build them together, get that done, and then keep working where we don't have it. And the good news is that broadly across Democrats and the American people, there is broad support for taking steps that will help address the costs that families are facing on prescription drugs, on health care, on child care, on reducing energy prices by investing in clean energy. In all of those areas, there is broad support. And to your Will Rogers point, I think that the more striking contrast here is all of those areas are areas where Democrats agree and the American people agree. They're common sense, they would reduce costs, and we don't see any Republicans supporting that. And frankly, we don't see the Republicans supporting any real concrete plan to deal with the price increases that we're facing. So that's the way we're going to approach this. And the president has long experience in bringing coalitions together. It is never easy. It is never quick and immediate. That was not the path that we took in getting a historic bipartisan infrastructure deal done last year, but that's the path we're going to keep at here, and we're confident we're going to get something done.
With that said, Brian, there seems to be an increasing concession here that this large package, roughly $2 trillion, is not going to be able to pass in its complete form. We heard the president yesterday talking about potentially breaking up the pieces. Is the climate bill the priority right now, the roughly $500 billion? If you don't have the support for the child tax credit, free community colleges, is the priority for the White House right now to move forward with at least a big chunk of this bill so you have something to take to the voters and say, look, we got this done?
Well, the president made very clear his priority is identifying all the areas where we can find agreement, getting that done, and then continuing to work where we don't yet have agreement. And so that's exactly what we're going to do. And the need for investing in clean energy, having a more resilient energy system here in the United States that produces cheaper zero carbon energy here in the United States is a priority. Lowering the cost of childcare and health care and prescription drugs is a priority. These issues are hard, but we think we can get agreement on those. And even on an issue like the child tax credit, the president made clear that's going to be tough, but he also made clear he really prioritizes it because what it does is it puts money directly in the hands of American families who are dealing with costs right now and empowers them by giving them a tax cut. So we're going to, wherever we can get agreement, we're going to put this together and we're going to try to get it done.
There are possibilities with Senator Manchin who suggested a deal on climate provisions. What would that look like, hypothetically? You and the president are in the Oval Office having a discussion with the senator. What's that look like? How do you get him to say yes to something as you break it out of the bigger package?
Well, Senator Manchin is a partner, and one of the things that we're not going to do is to try to negotiate this out in public or characterize those conversations. That it's important that we maintain those lines of communications, and we do so respectfully and privately. But what I can tell you is that the core focus is on what are the impacts of these provisions on the lives and livelihoods of the American people, and how are they responsive to the current economic challenges that we face. So investments in clean energy, providing long-term incentives to the market in a technology neutral way that will drive America to be a leader in generating the new clean energy technologies of the future, whether that be wind and solar or nuclear and carbon capture and sequestration. That is a big economic priority and a big win for our economy and our workers if we can get that right. We have an opportunity to do so in this package with provisions that we spent a lot of time working with industry and with other stakeholders to get right. So that's a place where I think we can make a lot of progress.
Let's talk about where things stand in the pandemic, because it feels like there's been a bit of a shift in tone from the president to 1 year ago when he said we're going to beat this virus to today where he's saying we're going to learn to live with the virus. If you look at this from the economic picture, I mean, the supply shortages, price pressures, that's all come along with this. So To what extent can all that be controlled when you've still got the virus sort of looming in the background?
Well, this is a pandemic-driven crisis, and this recovery is marked by the intersection between the pandemic and the economy, no doubt about it. But you also heard the president loud and clear yesterday saying he does not accept the idea that the current normal is what we are going to live with. And in fact, we are making progress toward an outcome where COVID is not affecting everybody's daily lives and constraining our economy in fundamental ways. And we're making real progress toward that goal. We're not there yet, but we're making real progress. And as we progress on the virus, it helps progress on the economy as well. That's been true when we came into office. It was true last month. It'll be true next month as well. But that's why you see the president focusing on things like our supply chains, where working with business and labor to try to open up our ports, open up our railways and our trucking lines to move more goods through this economy. That's really important to do, and it's important to do in a way that helps minimize the impact of the virus and maximize the ability to move goods and services through this economy. I'll say today we're releasing a dashboard that shows that the number of containers that are sitting on docks for a long period of time is down 60% since November. Even during the high holiday shopping season, that was because of hard work by port operators and companies across the private sector supply chain and our administration working in partnership with them. And that's the kind of thing we're going to keep at going forward.
And our thanks to White House National Economic Council Director Brian Deese for speaking to us earlier today. Coming up, we're talking about the 2022 midterm elections, how the Democrats can hold their grip on power come November. We're going to speak to Brad Woodhouse, who's former campaign advisor to President Obama. That conversation is straight ahead. Yeah, Adam, it looks like you're muted. I'm going to pick
Sorry
up
about
here.
that.
You are watching Yahoo Finance's special presentation of the Biden presidency year one. President Biden struggling to deliver on his agenda, his Build Back Better, certainly broken apart, and there could be more trouble on the horizon if American voters produce a red wave come November. Let's bring in Yahoo News chief national correspondent, John Ward. And John, we've always seen the pendulum swing back in these midterm elections. How big of a swing are we looking at?
Hey, yeah, I mean, there is a lot of history behind this. You're right. We saw some of that swing already in Virginia last fall with Glenn Youngkin winning the governorship in Virginia and Republicans taking back the half of the state legislature. I think the big question here is, can Republicans take back both the House and the Senate? The House looks pretty gettable for them. It's a 10-seat differential. They only need to pick up 6, I believe. The Senate is close. Obviously, most people know that it's a 50-50 split, and Vice President Harris breaks those ties in favor of Democrats right now. So Republicans don't need to win a lot of seats to regain the majority in the Senate. One of the things Democrats have going for them is that all 14 of the seats they're defending went for Biden in 2020. So there are a couple seats that are going to be tough for them to win, but they also have some seats where they could potentially pick up what has been a Republican seat. So yeah, it's looking undoubtedly like a Republican wave. That's kind of a foregone conclusion. That I think the question is how big and how much Biden and Democrats can recover between now and this fall.
John, talking about recovering between now and the fall, the perceptions don't necessarily mirror the facts on the table. So if you're a candidate who's running, say, for a House seat, you know what the opposition, if you're a Democrat, is going to throw at you. How do you respond to it? I mean, defund the police is going to get thrown at some of the candidates. How should the Democrats respond?
Well, I mean, if we're talking about House races, those are always pretty specific to the district. Senate races are more statewide, more nationalized. I think one of the big things Republicans are going to hit Democrats for is, just basic kitchen table issues. The inflation issue is going to be massive. So that's kind of an X factor for Democrats. How much can they get that under control? How much, control do they even have over it? That was obviously a big part of your conversation with Brian Deese. I know Democrats are going to do their best to avoid stepping into culture war hot button issues like defund the police. I'm sure that will come up to some degree. I personally don't sense as much of that right now from Republican messaging. I think, Democrats are going to need to focus on what they've done that makes a difference in people's lives. And that comes back to the same type of issue that inflation hits, which is, quality of life, pocketbook. They're going to have to talk about ways that the recovery plan from COVID and the infrastructure bill have made a real impact on people's lives. So far, they haven't done a lot of that. And I think you're going to see a big push to correct that.
Okay, John Ward, I know you're going to be all over that story going into November. Yahoo News chief national correspondent joining us there. Let's bring in senior DNC advisor and former Obama campaign advisor, Brad Woodhouse, for more context here. Brad, good to talk to you today. Democrats have certainly been in this position before. If you think about the first term of the Obama administration, what's going to be different this time around?
Well, look, it's tough. I'll acknowledge that. I mean, one thing that seems to be a pattern is that Democratic presidents inherit terrible economies and terrible circumstances from Republicans, and it takes a long time to fix those problems. Sometimes you don't fix them fast enough before the next election. I would say in this case, I think we've made a tremendous amount of progress, and I agree with John that what Democrats need to do, in addition to working on Build Back Better, the chunks or the pieces that we can get done, working on inflation, continuing to work to put the pandemic in the rearview mirror, we got to talk about the things that we've done. We've accomplished a lot, historic number of jobs created. We, of course, got to 75% of people vaccinated. We're literally delivering masks and tests into people's homes. And so we got to go out and talk about the things that we've done. And the other thing that we'll be able to do is Democrats and almost no Republican will be able to stand in front of groundbreakings that are funded by the bipartisan infrastructure bill.
Really?
If we do all that, I think we can do better than people think we can.
Brad, you just opened the door on this, and you talking about what the Democrats have done. What about attacking the Republicans who are now actually taking credit those who voted against, I'm thinking of one, I think it's Iowa and one from Texas, who are taking credit for monies that are going to infrastructure projects in their districts, and they voted against the infrastructure bill. Where's the DNC attack ad?
Well, look, you're going to see it, and I think you're going to see it. You're going to see those ads in those races, and you're going to see those ads locally, and those ads are going to come out of super PACs. We jumped all over that news and really hyped that and tried to get that into the media bloodstream about these members who voted against the infrastructure bill and then go and put out press releases and put stuff on their website trying to take credit for it. And I think the president was right yesterday. We have got to call out Republicans when they do that kind of thing, and then Democrats have got to say to Republicans, "What are you for? Why don't you want to lower prescription drug prices? Why don't you want to lower health care costs? Why don't you want to lower child care costs? Why don't you want to lower energy costs?" And I think if Republicans go into the election only trying to sabotage the president and have no agenda of their own, I don't think they're going to do as well as they're acting like they're going to do.
Brad, you started by talking about the fact that Democratic presidents have, in your words, inherited bad economies from Republicans, but the economy is actually in a good spot under President Biden. If you look at the overall data, we've talked about the millions of jobs created, unemployment at 3.9%, wages are going up, and yet the president just can't escape that inflation headline. Why do you think the message on the positives aren't sticking?
Well, look, I think people are frustrated. The president mentioned this yesterday. There are two things that are going on right now that we have to wrap our hands around. That's inflation, and that's the pandemic and this variant that we need to get behind us. And hopefully we won't have more variants like that. So those two things are, I think, creating this concern among voters, and they're not hearing and seeing the other things. Part of that is that we've all been involved in the hats that I wear. We've been involved in trying to get Build Back Better passed. We've been involved in trying to get voting rights passed. And now we're going to have to split our attention. We're going to have to continue to try to pass those things, but we got to go out and talk about the things that we have accomplished. Yes, the economy is doing really well right now, with the exception of inflation, but it wasn't when we came in, and we got to make that case. We got to make the case that we were 6.5% unemployment and now at 3.9%. That record job creation, more than any other year in history since we've been tracking, and what we've done and what we're getting ready to do to deliver masks, deliver tests, and continue to deliver vaccines. We got to go out and take credit for what we've done.
In the DNC discussions, what are the three top issues that voting Americans care about?
Well, I think it's jobs. It's jobs. It is inflation, so we need to get a handle on that, and it's showing leadership on getting this pandemic behind us. But right below that are issues like democracy and voting rights, and making sure that people have a fair access to the ballot. But I think it's always the case that when it comes to people's economic lives, whether it's the jobs they have, the wages, which we do see going up, healthcare costs. I do think the number one issue we see over and over and over again in the polls is the high cost of healthcare, particularly prescription drugs. And you got like 90% of Americans want to deal with that, but every Republican is against it. So we've got to make that contrast, and that's one issue we really do have to get done in whatever the future is for Build Back Better.
Brad Woodhouse, thank you so much for joining us today for this special on the one-year anniversary of the Biden administration. Up next, why Texas Congressman Kevin Brady says President Biden is helping raise the cost of living in America. Brady will join us right after the break. And the latest CPI reading when we talk about inflation shows it was up a whopping 7% over the last year. And many are laying the blame squarely on President Joe Biden. Now, this comes as the White House continues to make the case for its Build Back Better plan, which some people say will drive inflation higher. So joining us now is Texas Congressman and House Ways and Means Committee ranking member, Kevin Brady. It's good to see you. And I just want to quote, the title of a note that you put out to your constituency is that President Biden's first year, America's economy was poised for greatness in 2021. How did Biden bungle it this badly? Where would you like to begin? Because we just had a member of the DNC defending this first year.
Yeah, so we obviously have pretty significant differences with your previous guest here, and here's why. So look, the bounce back from 2020, which was a tough year, so the economic rebound beat expectations, was very strong coming into 2021. The other advantages was life-saving vaccines. There were trillions of dollars of bipartisan COVID relief coursing through the economy, and major regions of the country were finally reopening. So 2021 should have been a banner year. But what got delivered was the president fell short of expectations each of the 3 quarters. And I predict a fourth when those numbers come in. He's about 1.1 million jobs short of his promises from the COVID stimulus in March. Inflation has wiped out 3 years of wage gains for average Americans. That's crushing. I mean, we've still got a serious worker shortage that is really damaging Main Street businesses in a big way. Economic optimism has really plunged, both from small businesses and families here over the last year. And so right now, every poll seems to show that Americans are questioning the president's ability to lead on the economy. And I think there's good reason for it.
Let's talk about the worker shortage specifically. I mean, if we're talking about unemployment at 3.9%, no question businesses have said, look, we just can't find the workers there despite the incentives in place. But you're talking about 3.9% near full employment. So what do you think the Biden administration is doing wrong? What more can they do or should they do to improve the labor market, given where things stand?
Yeah, that's a great question. Unfortunately, 3.9% is low for the wrong reasons. It's because we've got between 2 and 4 million people who've left the workforce voluntarily. That's not a good sign. As we've talked before, there were a number of provisions in the COVID stimulus that discouraged Americans from reconnecting to work, including a new revamped tax credit that for the first time no longer required Americans to have earnings at all. That, our local business told us, became another barrier after those very lavish federal unemployment benefits. The ACA subsidies, the Affordable Care Act subsidies, were equally untied to work and went up to $500,000 or more. That became another barrier. If made permanent, experts have predicted that could incentivize about 2 million Americans to exit the workforce permanently. And so I think they made this worker shortage worse. We are still rebounding from it. And just as inflation, they initially denied it, then dismissed it, now blame it on the Fed. But the policies the president in Congress in this one-party rule worsened inflation as well. And what I'm worried about right now is we have the makings of a wage price spiral that is very tough to tame and usually ends badly. And no one in either party wants to see that happen.
When we talk about inflation, one of the things that Republicans have pointed to is the tremendous amount of spending. You just alluded to the $1.9 trillion relief bill that was passed at the beginning of the administration. But then there's the $1.2 trillion infrastructure bill. And I think it was only 13 Republicans in the House actually voted in favor of it. Some called it socialist liberal spending. And I'm thinking of a colleague of yours from Texas who's now touting the fact that some of this money is going to be used to build projects in her district. What do you say to Republicans who voted against infrastructure, calling it socialist spending, but are now saying, woohoo, we got some money, let's go?
Yeah, so I would note in that case in Fort Worth that Congresswoman Kate Granger had already passed earlier in a Republican majority funding for that project as well. and so it has a long record of delivering there. And secondly, I think as Republicans, we're kind of familiar with this, as we saw Democrats, everyone of them who voted against giving seniors a prescription drug program take credit for those medicines, life-saving medicines for our seniors. So this is unfortunately not unusual. And I think at the end of the day, Republicans in the House were, overwhelmingly willing to work on a bipartisan infrastructure bill. We weren't asked to do that at all. And in the House, unlike the Senate, it was tied directly to $2 trillion of tax hikes, which obviously is crippling the economy in America, landed on small businesses and job creators, and I think would have driven a lot of jobs overseas. So unlike the Senate, the roads and the higher taxes on small businesses were tied together.
Congressman, really quickly, we heard the president yesterday step up his attacks against Republicans, saying it really is all about obstruction, but there's not a unifying message here that Republicans take to voters. What do you say when people say, what do the Republicans stand for come midterms?
Yeah, well, one, we would be happy to work with this president on a number of issues, including a trade, making America medically independent from China in a number of areas. I think there's work on retirement security and making America more internationally competitive as well. But we haven't had a single invitation to sit down from this president or Speaker Pelosi in the House to do exactly that. And so I disagree with his claim that no one will work with him. He's been very clear. He's not very interested, and certainly Speaker Pelosi is not as well. I think our message will be that we have to have a country that doesn't lurch from crisis to crisis, that we have to resolve the crisis on the border, which for our states like Texas is just so damaging. We have to address this crime wave in a significant way. We've got to address inflation and the worker shortage, or we'll never see the strong economic growth we had pre-COVID, which I'm convinced we can restore, but it won't be from higher taxes and huge government spending. I think it's going to be smart spending, a trimmer budget, and frankly, continuing to reduce taxes on job creators.
Well, Congressman Kevin Brady, we always appreciate you joining us here on Yahoo Finance. Thanks so much for the time today.
It's good to see you again.
Well, coming up, we are going to continue to have that conversation about the president's inflation challenge. My interview with Arizona's Senator Mark Kelly is on the other side. We'll be right back. And welcome back to our Yahoo Finance special, the Biden presidency year one. Growing price pressures have continued to plague the president with his approval rating now at just 40%, despite a strong labor market. I asked Arizona Senator Mark Kelly about the president's inflation challenge and what he thinks the president needs to do to bring down those costs.
I mean, these rising costs are really hurting Arizona families and families across the country. But it's not just here in the United States. I mean, we've seen European countries, experience similar issues when supply chains get disrupted, like they have over the last couple of years. I mean, that contributes to shortages. And as we know, that's going to result in rising prices.
You've pressed the administration specifically to take steps to lower the cost of food. And you've spoken specifically about what you've described as corporate price gouging that's happening. Is that what you think is happening here?
For some issues, yeah, absolutely. Just this week, the Secretary of Agriculture, Secretary Vilsack, came out to Arizona a couple of days ago. I was with him, meeting with some ranchers in Glendale, Arizona, but the ranchers came from all over the state. Ranchers are getting the same amount for their beef that they did, before the pandemic, but the prices have gone up. So what is causing that? They're not getting more for their product, though consumers are now paying, in Arizona anyway, about $5 a pound for ground beef. So something is happening in where the product goes from the ranch to the market. So I have the administration looking into this. I mean, is it the processors? What is causing prices to go up? And, food is it's really challenging for many Arizona families to buy groceries right now, and it has to be dealt with.
What are you hearing from those constituents, the ranchers that you just alluded to? How much have they seen costs go up, and what's the reality for their businesses?
Yeah, I mean, the price of corn and alfalfa, the price of diesel fuel. So their expenses have gone up, but their revenue is flat. They should be, benefiting, from some of the price increases. I mean, we don't want the prices to go up. We want Arizona families and families across the country to be able to afford groceries. This has been really challenging. But there's something specific to this, and I think this is going on in other industries where you have big corporations that are taking certain steps to increase their profits on the backs of the American people.
So let's talk about the steps that you have proposed to try and bring things down. You talked about bringing down the cost of food, but also addressing the snags that we're seeing in the supply chain, specifically in the labor shortage in the trucking industry. You've called for the need to expand the pool of prospective drivers, but how do you actually do that? This is something that we saw even before the pandemic. And some would argue there's a bit of a generational shift that's happening. Not enough people wanting to get into this industry anymore.
Yeah, it's true. These are good paying jobs, but they also require that you leave your family for, in some cases, good periods of time. It's challenging work. And right now, we've got a shortage of employees across the country. The workforce, we had over, I think about 1.5 million additional Americans retire than expected during the pandemic. That's a lot of people that just disappeared out of our workforce. There are certainly some things you can do. You can provide training opportunities that are more readily available to young people. You can reduce the age for folks to get jobs where they're driving on interstate highways from state to state. Right now, that age is 21. We are looking into reducing that to 18. You got to make sure you have the right people. You got to make sure you train them well, and they're going to, do the job in a responsible way. But there are steps we can take to alleviate that supply chain issue.
And you can catch my full conversation with Senator Mark Kelly on our website, yahoofinance.com. Coming up, we grade President Biden's foreign policy in his first year in the White House, the tricky path he faces as he looks to navigate some of those geopolitical landmines. That's up ahead.
President Biden's first year in office has been littered with one foreign policy headache after another. There was the messy exit from Afghanistan, the ongoing tension with China, and of course, Russia's growing ambitions in its own backyard, its aggressions towards Ukraine. To discuss the challenges ahead, we invite into the stream Professor Susan Ashton Thornton, former Assistant Secretary of State for East Asian and Pacific Affairs and a professor at Yale. Thank you for being here. And what is, not looking back, but looking forward, the most urgent foreign affairs issue for the Biden administration? Is it Russia, and is it the situation with Ukraine?
Yeah, I think it's safe to say, Adam, that it is the situation with Russia right now. I mean, we've got Tony Blinken is in Europe trying to solve this problem. It's really unfortunate that this crisis has been sort of generated by the Russians. The timing is a little bit odd, not really explainable, and they've given us a very short deadline. So they're manufacturing basically an atmosphere of crisis. And so I think it is something that is going to take the full attention right now.
What's the report card you'd give the administration on its handling of this issue?
Well, I think this is an issue where the administration's been pretty reactive. I mean, this crisis with Ukraine in some ways has been going on for quite a long time, probably really since the end of the Soviet Union, certainly since 2014 when Crimea was taken by the Russians. But, you know, the reason that it's coming up now in such an urgent way is really driven by Vladimir Putin. And I think what I'd like to see is a little bit more sort of scope for diplomacy being given from both sides. I mean, both sides have kind of said that their positions are immutable, and that doesn't really leave much space for diplomacy. It's not really clear how we can get out of that without the conflict that Vladimir Putin seems to be promising us he has up his sleeve.
So let's move a little bit south from Russia and take a look at China. The relations with China, troubling. And a lot of people, you would know better than those of us who worry about it, but there's talk that maybe China makes a move on Taiwan. Where do we stand in that, and how would the U.S. respond? Is it even a real potential threat?
Well, I think the Chinese have a lot of reasons to be looking to try to maintain some stability in the Taiwan Strait over certainly the next year and several years. They're not looking for a fight in Taiwan. And I think there's been a lot of chatter, if you will, kind of mutual recriminations about Taiwan between the US and China. But I think after the last meeting between President Biden and Xi Jinping in China, there was a certain stabilizing effect where basically Xi Jinping said that China will be patient and wants to pursue peaceful efforts there. And the US has reiterated its longstanding policy, which has been so successful with respect to Taiwan for the last 40 years. So I'm hopeful that certainly this year in 2022, there's big things on the domestic calendar for both the US and China. So I'm not looking to see that there's going to be a conflict over Taiwan in the immediate future.
Specifically on China, on the one hand, it feels like the Biden administration has continued the policies of the Trump administration, maybe not with the same rhetoric, but along the same path. And yet we've heard the president say consistently, this is about competition, but there are areas for cooperation, like issues on climate. You think they can continue to toe that line, especially given Xi's growing power? When you think about the end of the year, he's up for a third term yet again. Can the U.S. continue to sort of navigate this in the way they have, at least in the first year of the administration?
Yeah, I mean, the way I kind of characterize what's happened in the first year is it's a sort of a drift between the U.S. and China. Really, the Biden administration has focused on domestic strengthening and rebuilding relations with our allies, following on some damage that was done by the previous administration, rejoining international institutions like the Paris Climate Accord, for example, and really hasn't, been very specific about what it's going to do with China. We have a lingering trade war, really, that's not been altered in any way under the Biden administration. The tariffs are still there. So it's really kind of been minimal communication, working in these other areas and letting the China approach kind of drift. I think in the next year, in 2022, and maybe even following that in 2023, there may be some chances to do a bit more substantively in terms of with China on issues that you mentioned, like climate change, maybe some other transnational issues. But for right now, I think the Biden administration's really focused in on, the domestic strengthening, working on some, aspects of support for U.S. industry that they feel, needs to be more competitive with the view toward China's future, developments in technology, et cetera. Working with the allies on that project, trying to sort of work with others to build a coalition to kind of contain and isolate China in areas that they're concerned about. And so it seems to not really be working with China so much at this point.
We appreciate your joining us for this look at not only the first year of the Biden administration, but also a look ahead. Susan Ashton Thornton is a former Assistant Secretary of State for East Asian and Pacific Affairs and a professor at Yale University. We also want to thank you for joining us. This does it for our Yahoo Finance special. We appreciate your watching.